like this.
Scratch is so nice, gotta hear it twice. Kick it.
Let me hear you say, hey!
Welcome everyone to, I know, the music gets me really hyped up too. Welcome to DC Fintech Week 2022. I am Chris. We made it through the pandemic. We are back here in person. It is amazing. We are going to have a great day with lots of interesting speakers, thought leaders, movers, shakers, and hopefully, as we try to aspire to do every year, my team, we hope to paraphrase Rousseau, delight and instruct. So hopefully you're going to have a little bit of fun, as well as learn some new issues, and hopefully appreciate a little bit more in terms of the nuances of the conversation here in Washington, D.C. about financial technology and policy. I will, throughout the day, continue to sing the praises of my team, from Zainab Ahmed over at Georgetown, Mariano, also over at IIEL, Trish Fauché over at the Institute for Financial Markets. There's Amanda Russo. I want to thank Sheila Warren from CCI. It takes maybe not a billion people, but a gazillion people to put this on for free for everyone to get access to, again, a lot of the ideas that are shaping the regulatory policy landscape. Thanks to our many friends in the press who are here. Hopefully we're going to create some news that will be interesting and also worthy of the American public and the global public. Okay, I really don't ever give, as everyone knows, like lots of introductory talks before, bathrooms in the back, foods to the side. If you need something, you can always go to our team and you can ask them logistically about things. We had mentioned, because this, believe it or not, it will continue to get full over the day, which is why we try to gently warn people to get in at 8:30. It looks like my advice was correct. If you do get up out of your seats, you don't want to possess, the adverse possession, the laws of adverse possession do not work here. But as people rotate in and out, you'll eventually be able to find, hopefully, some really good seats to get a view of all of our many guests. Okay, with that, I think we're going to just jump right into our first panel with my colleague and my friend Mike Hsu, the acting comptroller of the currency, where particularly for some of our law school students who had the opportunity to ask him a couple of questions, what I like about the acting comptroller is that he is one of the most thoughtful people that I know, and he reads things both from industry and from academics, and I've been really quite proud of the conversations that he's had both on and offline. The acting comptroller will be giving some brief remarks, and then we'll go to some Q&A. Okay, Mike Hsu.
Thank you, Chris. Thank you, Chris, for inviting me to speak at this year's DC Fintech Week conference. I'm really honored to be here to open one of the leading gatherings globally of academics, officials, and practitioners on financial technology and regulatory issues. So, a lot has happened in the crypto space since last year's conference. Back then, the crypto industry seemed unstoppable. Financial regulators were working to keep up with the pace of change. On some days, it felt like the primary risk facing us was the risk of being left behind. Today, things are quite different. The collapse of Terra, the associated crash in crypto markets, and the demise of numerous platforms exposed severe weaknesses in the risk management practices at a range of crypto firms. The events also revealed the scope of risk to consumers, the hidden interconnectedness between many crypto participants, and the risk of contagion. To protect consumers in the financial system, regulators must be able to identify and monitor crypto risks efficiently and effectively. With my time this morning, I'll be discussing 3 lenses which may help in that risk identification. Lens number 1, skeuomorphism. The crypto industry arose out of a desire to disrupt and disintermediate the traditional financial system, what some people call TradFi. I'll use that for simplicity today. Yet crypto has mimicked TradFi concepts to market itself and grow. This reliance is understandable. Few know what a distributed ledger is, let alone how it can store and transmit value. But everyone is familiar with a bank deposit, and many are invested in stocks and bonds. Referencing or analogizing to what is familiar can help make what is novel less scary. Once users engage, the theory goes, then they can discover, learn, and use what is actually new. This approach has a name, skeuomorphism. Skeuomorphism is a design concept that was generalized and made popular by tech leaders like Steve Jobs at Apple. When the iPhone was released in 2007, it was novel. The public at the time was used to mobile devices with physical buttons, maybe a scroll wheel for those who are BlackBerry enthusiasts. Apple faced a challenge. How would it get consumers to interface with a touchscreen? Apple designed certain functions to look familiar, even though it didn't have to. The keypad, the keyboard, clock face, calculator, and other features looked and operated like traditional devices. These skeuomorphic designs enabled the uninitiated to pick up the iPhone and use it immediately, without having to invest time and energy learning how to use a whole new kind of technology. In short, skeuomorphic design helped bridge the past to the future. Technically, it wasn't necessary, and to some Apple engineers, probably seemed unduly dumbed down, but to the public, the device's interface was intuitively understandable, which made it immediately usable and provided a path for rapid adoption. In this example, skeuomorphism served as a bridge, which was positive, a catalyst for transformational change. This may be how crypto advocates see crypto's reliance on skeuomorphic TradFi concepts. The problem, however, is that crypto is not TradFi. The skeuomorphic representations are, at best, facades. The real thing is quite different. Take, for example, something as simple as ownership. Owning a traditional asset like a stock or bond is well understood and clear. The legal frameworks for establishing ownership, exercising control, and perfecting a security interest are well developed and have been pressure tested. Representations of ownership via bank and brokerage statements, for instance, are fairly standardized and familiar, due in part to a host of disclosure and investor protection rules. Crypto borrows heavily from this. The language and online experience of owning and trading crypto matches that of traditional assets. The reality, however, is very different. When you buy crypto through an app or a centralized exchange, what exactly do you own? Where is your private key? Note, even the key is skeuomorphic. Is possession of the key the same as ownership? How does one distinguish between possession and control? These are foundational issues. Yet the crypto industry's skeuomorphic tendencies elide these basic questions, which need to be answered if the industry wants to mature and sustainably scale. Custody is another example of the industry's reliance on skeuomorphism. In TradFi, custody is well defined. Customers know what they're getting when they ask a custodian bank to safekeep their traditional assets. The scope of those custodians' responsibilities and the legal frameworks and operational requirements for establishing ownership, demonstrating control, transferring, rehypothecating, and safekeeping assets are well known. The same cannot be said of certain crypto custodians. The manner in which centralized crypto exchanges, trading and payment apps, and others, quote unquote, custody their customers' crypto holdings, I'm going to use a lot of air quotes, apologies, is quite different from what banks and brokerages do for their clients in TradFi. Under most centralized crypto platform agreements, user assets are commingled directly with platform assets, a practice that would not be acceptable or deemed to constitute custody in TradFi. While customers could read each crypto platform's terms of use, those platforms' descriptions of their custody arrangements make something novel and complex feel as familiar and safe as TradFi. Another example of skeuomorphism in crypto are crypto savings accounts, air quotes again. Until recently, platforms like Celsius and Voyager Digital encouraged consumers to unbank themselves and promised rewards for crypto assets deposited onto their platforms. Returns were paid in additional units of crypto, and sometimes referred to as yield, quoted in terms like APY, borrowing a banking term with a regulation behind it, and the suggestion of a stable, predictable return. In some cases, users were assured that they could reclaim their assets at any time, even if the crypto firm failed. As many are now learning the hard way, the risks of those arrangements are materially different than their representations. In these examples, skeuomorphism is not a bridge, but a disguise. Using the familiar to introduce something novel can downplay or mask the risks involved and establish false expectations. In time, people get hurt. I encourage everyone to read the letters that Celsius clients sent to the bankruptcy judge in his ongoing case to get a sense of the real-world impacts when skeuomorphic marketing gives way to harsh reality. Lens number 2, commingling. In addition to being the acting comptroller of the currency, I'm a member of the Financial Stability Oversight Council, or FSOC. My views on financial stability issues are highly informed by my experiences as a financial regulator during the 2008 financial crisis. This past July, FTX, one of the largest centralized crypto exchanges in the US, submitted a presentation to the FSOC in response to outreach on the Digital Assets Executive Order. The arguments in the presentation caught my attention because they presumed that integrating crypto and TradFi would enhance financial stability. I could not disagree more. Crypto today is an immature industry based on an immature technology. I'm not saying this disparagingly. In a recent interview, Vitalik Buterin, founder of Ethereum, called crypto today a, quote, nascent baby. His words. The promises of programmability, composability, and tokenization are intriguing and could, in theory, help solve a range of problems in the financial service system while unlocking significant efficiency and economic potential. But that promise cannot mask the lack of clarity on basic things like ownership, the ever-changing landscape of consensus mechanisms like technology, and the unabating volume of scams, hacks, and fraud. Integrating an immature crypto industry with a mature TradFi system without guardrails and gates would be imprudent. Any incremental gains in efficiency and convenience would be heavily outweighed by the increase in cross-contagion and systemic risk. Even integration within the crypto industry itself warrants attention from financial stability regulators. The largest crypto players today want to provide an increasingly broad range of services seamlessly under one roof for their customers. Digital wallets, buying and selling crypto, crypto custody, staking crypto for yield, crypto margin lending, trading crypto derivatives, holding fiat, borrowing and payments with a credit card, direct deposit of paychecks, facilitating peer-to-peer payments, issuing stablecoins, and creating, collecting, and connecting to NFTs. While commingling these activities may offer convenience for consumers and cost savings for crypto firms, conflicts abound, and the riskiest activity threatens the whole bundle. Consider the recent failures of 3AC, Celsius, and Voyager. All three engage in a range of crypto activities, from custody to borrowing and lending to prop trading. Each failed due to imprudently managed concentrations of risk, essentially prop trading bets, which only became fully evident after the bankruptcy filings began. They were only as strong as their weakest link. The more links there are under a single platform, the higher the risk of contagion across them. So for the financial regulators in the room, skeuomorphic description, and I say this unironically, a skeuomorphic description may help put this in perspective. The risk of contagion within a crypto platform is akin to the probability of default of a bank, PD. The risk of cross-contagion between crypto and TradFi is akin to the loss given default, LGD. The systemic risk posed by crypto is PD times LGD. To mitigate systemic risk, PD and LGD need to be limited. In layman's terms, until crypto matures and appropriate guardrails and gates are put in place, it would be wise to limit the scope of activities commingled within a single crypto firm, PD, and to limit integration of crypto and TradFi, LGD. Finally, lens number 3, data. Step one of risk management is to identify risk. Looking for skeuomorphism and commingling may generate productive results in this regard. Step two of risk management is to monitor risk. To date, regulators have relied on supervisory processes to monitor banks' exposures to crypto and to gain visibility into their crypto activities. At the OCC, institutions seeking to engage in any of the crypto asset activities that we've deemed are permissible must first obtain a supervisory non-objection. To receive a non-objection, an institution must demonstrate that it can conduct the proposed activity safely, soundly, and fairly. The FDIC and Federal Reserve have adopted a similar approach, helping to maintain a level playing field across the banking system. While this approach has been effective in monitoring banks' crypto-related activities, further enhancements may be needed to track the risk of cross-contagion. A structured and recurring gathering of quantitative data focused on the nexus between banks and crypto could help ensure that regulators have an accurate and complete view of the risk. The OCC is considering ways to support periodic and ongoing information gathering so that we can continue to understand the prevalence and scope of crypto asset exposures and interconnectedness at our supervised institutions. In addition, gathering data from crypto firms and platforms on their activities with TradFi institutions like banks would give financial stability regulators a fuller picture of what's going on, thus enabling more effective surveillance of financial stability risks. In the US, such monitoring could be conducted by the Office of Financial Research. Given the borderless nature of crypto, international coordination on this front could also be warranted and helpful to consider. So in conclusion, my job as a bank regulator and member of the FSOC is to identify risks to banking and to the financial system. With crypto, looking for skeuomorphisms, commingling, and data caps can help in that endeavor. Until crypto matures, we need to be careful and cautious in how we allow TradFi and crypto to interact. Some have argued that, quote, bringing crypto into the regulatory perimeter would help tame it. It depends on whose terms. Later today, I'll be providing remarks to Harvard Law School in the program on international financial systems. There, I will explore this topic in more detail and argue for an approach that utilizes guardrails and gates. In the meantime, I'm looking forward to the Q&A with Dr. Brummer. Thank you. I'm following on.
All right. Thank you so very much for that really engaging conversation. Always, when I talk to you, I learn something different, and we challenge each other. I did not know the word skeuomorphism, so I had to actually look it up and to familiarize myself a little bit more. Just one other little note for the audience. Again, we have in the back with the Latham Lounge where you can talk. This is a big open space, but particularly around the coffee areas and then the entries. If you guys, if anybody wants to sort of talk with colleagues and to network and just catch up, feel free to do so in the back. All right, so as I understand this conversation, and as I was listening to your remarks, it's interesting because when you think about the history of finance, I mean, the problem or the challenge of skeuomorphism isn't really germane to crypto, isn't it? I mean, when you think about banks or the release of new products by banks, you know, there is a desire and an interest, and sometimes they would be argued a need to simplify what that product is. So you know, maybe you can talk to us a little bit about what skeuomorphism means for finance.
Sure.
As compared to the specific issue of cryptocurrency.
So I think in banking, it's often flipped around. And so I think of skeuomorphism through the lens of the underlying technology. So in banking, think about small dollar lending. Small dollar lending is just small dollar lending. It's just lending to folks in small amounts. There have been lots of flavors of it. In some ways, banks have to come up with new ways to package old things. And so it's almost like reverse skeuomorphism, where the underlying technology is not changing. And in fact, if you think about payday lending, overdrafts, early wage access, BNPL, a lot of these are just variants on the same thing. Whereas with crypto, at least, or with blockchain, DLT technology, the technology itself is quite different. And so the skeuomorphism that's needed is to say, well, it's too scary to jump all the way to the 22nd century. Let's package that in a way that's familiar so people just start using it, and then we can move on. Like, remember the first Apple iPhone, the books were actually on shelves, which makes no sense on a phone if you think about it. But it's just a way to just make it familiar and usable, and then you can do fancy things with it afterwards. I think in banking, it's often the other problem is that they're taking something that only has so many degrees of freedom, lending money at an interest rate, and then coming up with new ways of packaging it. And sometimes those innovations are good because they meet the needs of the time. But sometimes they're just, those are disguises too. So I think that disguises abound everywhere. And as a regulator, it's something that we just have to keep our eyes out for.
Well, when you use a word like disguise, it will tingle the spidey senses of some of the members of the SEC who are probably watching, and it reaches and it touches on issues like disclosure. So is skeuomorphism a complex way of dealing with the concept of just a material misrepresentation or omission? I mean, if in short, bringing it within the regulatory perimeter is the objective, would that in and of itself deal with the skeuomorphism problem?
So the disclosure, I have to give Dr. Brummer credit. Like some of your writings have opened my mind as to thinking about disclosure in a more holistic sense. I think our tendency is to, when I say our kind of regulators' tendency and the industry is to think of disclosure as a very binary state, which is convenient. It's like a bright line. Either I disclose or I don't, and it's either good enough or it isn't. And I think it's helpful to think that disclosure is a means to an end. It's not the end in of itself. And so, as some of your writings have pointed out, well, what's the point of the disclosure? Well, the point of the disclosure is to provide insights to the public on certain things, to level the playing field. There's a whole bunch of set of reasons there. And then, well, if you ask, well, what's the point of all of that? It's to ensure and enable trust, because these things are very complicated. And so, like how many people can actually read a 10K with a lot of facility? Not many, but there are folks out there who do. How many people can read Ethereum Solidity code? Very few. And yet, the industry likes to talk about look how transparent it is. Well, again, there's some similarities there. Yep. And I think it's good to try to move beyond just is it out there or not? Is it fulfilling the purpose of enabling that trust so that people feel like they can use it in a way that's not going to hurt them?
Is there a tension there, though, between skeuomorphism and then the inherent complexity of some financial products or infrastructures, right? Because I think a lot of people are going to say, well, look, Mr. Regulator, ultimately, our job, in order to make it accessible and as safe as possible, we have to simplify things. Because if we don't simplify things, they're just not going to understand what the technology is supposed to do or what that product is. And so, is there a tension between the inherent need? I see this all the time when I teach concepts to my students. Sometimes I'll, give 90% of what's needed to simplify it maybe a little bit so that it can be more easily digestible. Yeah. Wherein does that practicality, the necessity of consumption, of being understood, rub against the risk of misrepresentation?
So there's definitely a tension. And it's not easily solved. I think this is one that is going to constantly evolve because of the way people digest and act on information. Here, I think maybe the skeuomorphism analogy has limits. Just like skeuomorphism itself. And I think it's good to think just in terms of standardization. So how do we feel about standardization? And in a way, again, the purpose of the standardization, it makes it very legible. When I come across something that's been standardized, it's just easy for me to read it and understand it. But information and other things get destroyed in making that legible. So then you've got a trade-off there. And I think what is really hard as a regulator is the day one standardization is easy. Easy in the sense that we can debate, how many fields, how granular, what should the definitions be. But once we agree on that, we can move forward. Then what happens? It's like, how does that evolve over time? And I think this is where, I use this analogy of those rules are akin to kind of speed limits, right? What should the speed limit be? 70 miles an hour, 65 miles an hour, you post that. But that doesn't ensure safe driving. Like safe driving is behavioral, it's cultural, it really depends. And so, if suddenly everyone's texting while they're driving, that speed limit may or may not serve the purpose. You need people, supervisors in the field, talking with practitioners and others saying, okay, where is this line between safety and soundness and fair? How is that shifting based on behaviors? And how do we get to a better trade-off?
Well, let's roll with that analogy. I'm killing them this morning. I'm killing them. Thank you very much. Okay, so you're in your car, right? Just because there's some speed limits doesn't necessarily mean that people are going to drive safely. Right. In which instance, that's why we have licenses, why we have driver's licenses, right? To presumably make people safe drivers. I mean, we're going to pull them into the perimeter of supervision from the DMV gods or something, right? Well, okay. What happens if you try to bring crypto into that perimeter? I mean, you had mentioned TradFi earlier. Does bringing crypto within the existing regulatory perimeter render it TradFi, or is it something else or different?
Right. So that I should say that's not the purpose, right? So I am. I think we as regulators need to be technology agnostic. We need to be objective and dispassionate about impacts on incumbents. Like this is not, because otherwise if you weren't, then we're just basically locking in the status quo forever. And that can't be the right answer. So there has to be openness to these, to everything based on what? Based on, for me, safety, soundness, and fairness. And so within that parameter, how do we ensure safe driving? So the analogy to roll on with the, right? So you've got EVs with different levels of autopilots, et cetera, et cetera. Some of these can be quite good over time if they're implemented and exercised in the right way. Totally open to that. Like that's a benefit. But what we can't do is simply say, great, the technology's here. We should all just bend to that and just let these guys just run. Because there will be accidents, and then people will lose trust, and then they'll set things back further. So there's a way to do this, excuse me, in a way that I think is both moves forward, but it's purposeful. I like to use the analogy, you want to ready, aim, shoot. That should be the order. And I think with crypto, there was a time where it really felt like ready, shoot, aim, figure it out later. And I think my hope is that with crypto winter, that it's just gravity has asserted itself. Like, okay, let's order this in the right way for long-term sustainability, because otherwise we're just wasting a lot of time chasing things.
Okay, I'm going to go back, and be a little professory for a second, and with this skeuomorphism issue, because it's really kind of fascinating. I always make the joke when it comes to crypto. Maybe you've heard it. The West Coast makes it, New York trades it, DC regulates it, and they all hate each other, right? And it's very fascinating because when you think about any kind of particular product, embedded in a financial product is, as you've noted, like there's a legal regime behind it, right? Like when you use certain kinds of financial products, it's not just the technology, it's not even the technological infrastructure. Embedded in that infrastructure and how it's supposed to operate, there's the law, Yoda. It's everywhere. It flows within us or something, right? So the question is, is then any financial product, ultimately, again, getting to this question, like necessarily skeuomorphic, right? And as someone who's now been teaching for 15 years, I find the idea of simplification necessary in order to use, but ultimately, there's always going to be some kind of inherent gap, right? But between what it is and the customer's engagement with that tool, and there's a long history of that. I mean, in fact, you could easily make the argument, and I don't think any regulator would disagree. Like there are, one of the points of regulation is to enable people to make certain kinds of assumptions without even knowing everything that's happening in the background, right? So it's that becomes much more difficult and much more challenging when you're in a technological environment where everything is rapidly evolving, or where you have shooting and the like first. I mean, as a regulator, how do you think through just creating the context for navigating this sort of inherent tension?
Yeah. So maybe two thoughts on that. First is, if the thing that is being kind of discussed or being experimented with is not that big, I, as the acting comptroller of the currency, am probably not going to care that much about it. Right? There's a materiality threshold, which I think provides plenty of space for the kinds of experimentation that folks want to do in terms of innovating with products. So that we're not the innovation police. We get involved where things are getting to a point where safety, soundness, and fairness at a federal level get implicated. And so I think stablecoins is a really good example of what you're talking about, where stablecoins, on the one hand, are very innovative in how they're set up and the rails they run on and all of that. So no need to talk about to kind of go into all of that. This audience knows it. But it's highly skeuomorphic in the sense that they want to borrow ideas of bank deposits and this idea that you've got this thing that functions just like money, but on the internet. And so I think to your layperson, they're like, well, I understand money. I understand a bank deposit. So therefore, boom, I just go over here and I have all the same expectations. And I think if we're not careful, that's not right. If you could not use the term stablecoin to describe it, how would you describe it? I think it's a good just kind of thought experiment. You'd have to use other words. And then you start to get at what I'm worried about is that this concept, which is useful as shorthand, especially when you're developing the product and you're talking to your venture capital firm and things like that, is great. But when you're talking to the public and setting expectations of how it's going to function, now we've moved into the world of disguise. And that's where I get worried. And that's kind of, if we're going to move in that space, be real. So, either make it what it's purported to be. And I think the PWG report is kind of moving in that direction. So if you can say you're going to be a stable coin, then here's what you need, because we have a lot of experience with money. That's what we do. And if not, then call it something else. And then we can, but don't try to be half one and half the other. I think that's where danger happens.
We are going to run this thing on time, no matter what. I don't care how powerful. No, but I did want to say, just literally 1 minute. I think it's been quietly, you've been making history yourself. You've been making history as the first person of color to head the OCC, something that people don't always write about, but you've been doing the job. In what way does that in any way inform how you view the space?
I think it's subtle, but I think it does. I do think a lot about those who are underrepresented, the underdog, those who are typically forgotten, who should not be. And I think that's just something I grew up with. And it makes me very attuned to trying to understand the different perspectives. If I could tell one really quick story. No.
Okay. You got 58 seconds.
Okay. I remember in college when I was graduating, and a lot of my friends were moving on to banking consulting firms, and I was with a group that was not a group of color. It was mostly white folks, very very close friends of mine, and they had shared an email, and they were laughing about it, like in a good humored way, and saying, "Oh, it was an email. It was amongst an Asian American group saying, here are the TV shows you have to watch, and here are the things you need to do to get ahead in the professional world. You have to watch The Simpsons, Seinfeld, and Friends. You have to be able to follow football. You have to learn how to play golf. You have to do all these things. It's like the secret handshake." And they're like, haha, look at this. And to someone of color, that was a really important email, right? And it's a very different, I'm very lucky. I can code switch between these two things, so it's not, but not everyone can. And having that sensitivity, I think, does inform how you think about a lot of these issues. In the crypto space, fintech, I personally love the focus on inclusion. I am very frustrated and disappointed at how little of it is actually carried through. There's a lot of talk, not as much action. And I think that's something that's, conferences like this help to kind of shine that spotlight, and it's something that I think all of us should be working towards.
All right, thank you so much, Acting Comptroller. All right, we'll have our next session. So we will have our next session come to stage right now.
I was like, do I have a script? Okay, perfect. All right, excuse me. Good morning. I'm going to sit down with you guys after. I've got the podium for a minute. I'm feeling like Professor Chris over here. Great to see you guys. This will be a really fascinating conversation. I'm Kate Rooney. I'm a tech and fintech and crypto reporter at CNBC. I'm based in San Francisco, but it's great to be here in DC, where it feels like a lot of the action is happening, and these three will walk us through it. Really strong panel. This will be a great one. I'm very excited. Jeremy Allaire, Circle CEO. I'll let them also introduce themselves a little bit. We also have Sheila Warren of the Crypto Council for Innovation, and Hung Sung Shin, the Bank of International Settlements for Economic Advisors, and the head of research there. I'm going to sit down so I get a little more comfortable. But you guys, this will be great, and thank you all for being here. All right, I'm coming over to you guys. All right, well, like I said, A-list panel. This will be wonderful. And we were just out at the Circle conference, so it's good to do a little bit of the Silicon Valley tech side, and then now get some of the policy and DC side. Okay, the name of this panel I failed to mention, Building a Crypto Ecosystem, the Necessary Pieces. I want to start there and talk about what's missing. So you've got most of the pieces, it feels like. What do you feel like is still lacking in your mind and to really build this whole puzzle piece? Sheila, maybe we'll start with you, and you can walk us through kind of the jigsaw piece that you maybe feel like isn't quite there yet.
Yeah, thanks, Kate. So I think there's a couple of things. Certainly there's been a lot of activity in this space, and I think everyone here certainly understands this is not the nascent industry it was a decade ago. There's been a lot of activity, a lot of differentiation in products and services, and all of that. But picking up on something the acting comptroller said, there's a couple of things I think that we need to have that foundational base in place. And the first I'll focus on, because I'm the CEO of the Crypto Council and we work on policy and regulation, is of course regulatory clarity. And you hear the industry talk about this and call for this all the time. What does that mean? It just means rules of the road that are more consistent, perhaps standardized, like the acting comptroller was saying. Just some idea of how you do more apples-to-apples type comparisons within the ecosystem of what these different products and services are, what they mean, what the offerings are. And certainly we think about that as a global phenomenon and a global need. But even more than that, I think, Kate, what we really need is comprehensive narrative. I think that there's a little bit of challenge in this space because things emerge so quickly. It's such a rapidly developing ecosystem, and the pace of innovation is like unlike anything we've ever seen, in part because the last kind of thing that exploded was the internet. Now we have the internet to accelerate the awareness of everything that's being built. But without a comprehensive narrative that kind of articulates at a level that consumers and users and participants in these systems can understand, we are, I think, lacking a little. We're prone to, I think, both the hype cycle, to things being over-talked about, maybe before they're really quite ready, but also to a lot of what we call in the industry FUD, fear, uncertainty, and doubt, and just misperception or misinformation about the industry. And both those things can promulgate because the industry itself is not landing, I think, a very comprehensive narrative frame.
And very much a global industry as well. I'd be interested to get your take. What do you think is missing? Maybe we'll start with you. On the global side, it is so fragmented on the regulatory side. This asset class is very, very global. I wonder your take from a macro, more global side, what's missing?
I think, Kate, I think the previous session with Mike Hsu was a really, he left us with a very important point, which is that so far the impact on real-world finance has been very limited. And I think what's missing is how do we take some of the technology, actually make it useful for the real world. And one of the things that we've been doing at the BIS is to see how the technology can be applied in a way that actually makes a difference for real world transactions. For example, when you buy a house, why don't we do it in a way that actually expands the possibility set that actually reduces costs and actually reduces the time taken. And there are two things that are crucially missing there. One is that we need a unit of account to actually underpin all of this. Now, stablecoins are one way of doing it, but that's an attempt to piggyback on the unit of account. But why do you need to piggyback if you have the real thing? If you have a CBDC, if you have tokenized deposits, I think that's one route that I think we can definitely take. And for that, what you need is to have a system, let's say a DLT system that uses real names rather than private keys. So it's something that's based on personal identity rather than simply a private key. And I think for that, the conventional financial system, it's more about the architecture, the data architecture of the system that we have, but raise that to another level where we can apply these techniques. And DLT definitely is an extremely useful technique. Whenever you have many, many different interested parties with intertwined interests, what you want is a way of reconciling all of those interests in a way that's transparent. And decentralization, through some version of DLT, is a fantastic way of achieving what economists call common knowledge. And that's not simply a matter of transparency for its own good. It's a way of expanding the universe of possible outcomes as well. So I think that's what we need.
I'm sure Jeremy has some ideas on usability and in the context of stable coins. What do you think is missing here, Jeremy? And maybe speak to that point as well in terms of making crypto more viable for everyday use cases.
Yeah, it's something we think about a lot and are often asked this question sort of like, when is this going to be accessible and usable at mass scale? And my view on this is that we're actually very close. And there's a few pieces that we see that are really critical. The first is sort of at an infrastructure level, which is, and maybe just stepping back also, just first principles from our perspective is we're building on open source software, open standard protocols, and public good infrastructure on the public internet. Not controlled by governments, not controlled by corporations, but public goods. And that's what public blockchains are. So as a first principle, we're building on an internet architecture for this, not a closed system architecture. And I think that's what has brought hundreds of thousands of developers and has brought tens of thousands of startups and hundreds of billions of capital into this space, is building an open internet model for the financial system. So I think we're firmly in that court as opposed to governments and the like building this. But within that, just take that for granted for a moment. On that public infrastructure, the infrastructure layer itself is sort of going through what I like to think of as the dial-up to broadband upgrade cycle. So if you all remember when we had dial-up internet, it was the worldwide wait, as people used to call it. And there was a lot of hype about all these things you could do with the internet, and the dot-com bust actually happened in the context of the actual usability wasn't there. It was slow, et cetera. So blockchain infrastructure itself is going through that upgrade. The pipes are getting wider, and we're now at a point where we're seeing this open public layers that can support hundreds of millions of active users potentially with very, very inexpensive transaction costs, not just for payments and financial applications, but for a huge array of apps that can be built on this infrastructure. So that's one. We have to solve that, and I see a very clear path to solving that, and that's going to kind of compound sort of like Moore's Law in computer kind of productivity improvement. The second piece is that regulatory clarity, and I think what's really exciting is that most mature regulators basically believe that payment stablecoins are a here and now issue, that the private market has solved a problem of representing tokenized cash and building a regulatory model to safely execute on that as a new financial primitive in the global financial system. And we're seeing laws being passed everywhere. And that's going to happen many, many years ahead of CBDCs. And that's going to achieve large-scale adoption well ahead of any government-run initiatives. So getting that regulatory clarity is really key so that corporations, households, other financial institutions understand how to use these tokenized cash instruments at scale. And then the last piece is basically user experience. My background is in user experience software. Right now, crypto infrastructure needs to kind of go into the background So most of us don't think about which SMTP server we're sending a mail message through. And similarly, most people don't want to think about, which public key address they're sending to, or the risks and complexity involved in a browser plugin to connect a wallet. And so there's a lot of usability things. So that, that is an area where I would say there's an enormous amount of innovation happening in identity and user experience. And from a Web3 perspective, I think that's going to be a place of significant innovation over the next couple of years. And I think in the theme of building a crypto ecosystem, I think we'll see on the other side of the next 24 months an infrastructure layer that is truly ready for internet scale and has the necessary legal basis as well behind that.
And you said something interesting when it came to private keys, and I wonder if you feel that the industry, who really is focused on privacy and some of the fundamentals in this technology, and working with regulators and things like we've seen with Tornado Cash, working with sanctions, working within the existing regulatory guidelines, do you feel there's a sense of conflict with some in the industry that want full privacy, they want this technology to work the way they envisioned it, maybe without government control or sort of free from some of this intervention, and then the governments in all of these various jurisdictions who want to make sure that they're following the laws? Any sort of conflict there that you're finding?
I think there is a certain amount of tension, Kate. But I think, to be useful for the real world, what you want is to be able to actually have the assets that they're actually out there, traded on these platforms. Now, take a very simple example of a security. We have now centralized securities depositories, and these are specialized financial firms. I mean, in the old days when you were actually selling a bond, you'd actually have to deliver the paper certificate for that to settle. I mean, thankfully now we have centralized securities depositories where you just have a book entry, transfer, and then that ownership is transferred. You need a legal framework for that, of course. Now, what you can envisage is to have that and put it on the DLT platform, and thereby reap all the benefits that I talked about. So, I think the challenge is not technological. I think it's more about how do we actually harness the technology in a way that is useful for the real world, not simply in a self-referential way for trading crypto. I think it's fine, but to actually expand the applicability of that technology, you need to have these two conditions that I mentioned earlier. You need to be able to use real names, because all these other assets are in your real names, not a private key and not a public key. And secondly, what you need is a unit of account that is actually already out there. And it's not CBDCs necessarily, Jeremy. It's also tokenized deposits, because that's really also part of the monetary system, and that's much closer to being rolled out. And it's actually something that is very much a familiar part of the current two-tier monetary system.
Sheila, how are you seeing bringing both sides to the table? You hear something like using names instead of private keys. I don't know if everybody would be in on that.
Well, I guess we're being forced, I think, to ask ourselves as a society, who needs to have access to what and why? Why should we be giving centralized platforms access to a lot of pretty private information that's not actually necessary? To some extent, we should be rethinking, what is it that the banking system or the formal financial system actually needs to know about us, when, for how long, and again, why? Why is some of this information necessary? So I worry that, if we try to port everything into our existing system without engaging in a reckoning, I think a critical reckoning, with how that system has disenfranchised a significant proportion of the world's population because they simply don't have access to some of the identity markers that we've deemed essential, when there are, in fact, other identity markers that could be substituted in a meaningful way and in a safe way, I think. I think we have to ask ourselves, what is that balance? And how do we imagine a system, a regulatory environment, a policy environment, user experience, all these things that I think is creating a more healthy balance as the world has shifted and changed from where it was even a decade ago.
Yeah, and Circle especially, I think you guys have towed that line.
Yeah, I was just going to add on this sort of identity and privacy issue. It's something we care a lot about. we've put forward a set of open source, open standard protocols for decentralized identity that works with existing digital wallet infrastructure, that works with every blockchain, with every digital asset. It's an open source project called Verity. We announced that with a huge number of companies, including Coinbase, FTX, Block, MetaMask, Consensus, many, many others. And that just went into production last week and allows a financial institution or other type of entity that can verify identities to cryptographically prove an identity. So I can prove to the blockchain that I've been KYC'd. But I don't have privacy leakage. I don't have to leak my PII. And there's a huge issue in the existing financial system, and frankly on the internet as a whole, where we're either giving a lot of our private information to centralized entities who don't really need it, or even giving identity information to entities. I mean, the classic example is, I have 2 daughters. My daughter goes into a bar and has to give out her home address to get a drink. Like, that doesn't make any sense. So why can't we have identity proofs that can prove things based on cryptographic proof? So crypto is actually the key to both proving identity and preserving privacy. And so I think taking the building blocks that we have and building standards, and then allowing people to more seamlessly interact and more frictionlessly interact while preserving privacy at the same time.
And Sheila, you've done some work on this as well.
Yeah, so I think this is exactly right. And I think we have to be really mindful of the fact that we are giving away this kind of ridiculous amount of information that is not actually necessary, and we're doing that in ways that we don't have any control. And part of the reason that we've done that is our system has created an attached liability to leveraging that information. So one of the reasons, and that wasn't necessarily intentional, but one of the reasons that every bank needs to go through the analysis, et cetera, is because they have, depending on where you are in the world, they have liability around that information. That's a system we created. And we could actually say, using blockchain technology, you have access to the points that you were making to a similar pool of information. Cryptographically and otherwise, you can actually demonstrate and indicate that there is sufficient information to cross a threshold category, threshold, whatever it is, analysis, right? And that's what's important. It's not all that information. It's some of it that is needed to be pulled at different times in different places. And with a blockchain, you actually have the ability to do that in ways that don't have the liability necessarily have to sit in all those places, which is, again, a decision that we have made, that we think that that's important, but is it really?
That's a great point, and a use case we don't talk about all that often. I wonder, Hugh, as well, from the global perspective, bringing it back to sort of these different jurisdictions, do you see that working and being portable across of all of these different networks?
It has to be.
It has to be.
I think it has to be. But just to answer Sheila and Jeremy's question, it's not as if banks and credit card companies out there don't have that personal information. They have a lot of personal information already. However, there are rigorous legal safeguards to actually safeguard your information. So what we're saying is, what we're thinking about is not simply, just making everything public, everything that that is open to prying eyes. If you go down the route of tokenized deposits, it's exactly the same system with the banks. They have an obligation. They have a duty to safeguard your personal information. The central bank also needs to safeguard your personal information. And the same kind of legal safeguards will, of course, have to carry over to CBDCs as well. So it's not a kind of qualitative difference. What we're talking about is using your real name for real-world financial transactions. And I think what we need to do is to make sure that the technology can be harnessed in a way that is not simply not simply a kind of self-referential tool only useful for trading crypto. I think what we've seen with the crypto winter is that although the sector trades under the banner of decentralization, there is a lot of centralization here. And I think the kind of maturity mismatch and the run risk that we're very familiar with the global financial crisis, it seems to be here as well in a very centralized way. And I think once we come out of this, I think what we'll see is that there is a core of useful technology that can be harnessed in a way that actually broadens a set of possibilities rather than simply directed towards trading crypto. And I think this is something that has received broad recognition. We have 63 member central banks around the world. And of course, these central banks are at different stages of internal discussion, different stages in the domestic debate. And we're not here to foist some kind of agenda. But what we'll do, of course, is to point out what's feasible. And there has to be the public consultation, including on how to safeguard privacy. And I think, as we keep pace with that public debate, I think what we'll see is that at the end of this, that's going to sort of keep pace with whatever emerges after crypto winter. And what we'll see is something very useful. I think there is a role for stablecoins, in this ecosystem. But as Mike Hsu was saying in the previous session, we have to think about where that fits in the ecosystem. If it looks like a bank deposit, if it actually works like a bank deposit, then it should be regulated as a bank deposit, right? And I think that's a very, very important way forward. And I think the PWG report that he mentioned is a very important piece. The Financial Stability Oversight Council also published a report last week, which I highly recommend. And I think this is where the regulation has to be pointed towards what actually makes this work, and in a way that actually improves the public interest.
And let's stay on central bank digital currencies and stablecoins for a moment. How do you see the private sector, companies like Circle, interacting with central bank digital currencies? Is there room for both?
Absolutely, there is room for both. And in the ecosystem that we outlined in the annual economic report this year, what we describe is, essentially there is a base layer, which is the settlement layer. And there are also these very interesting ideas now from the commercial banks, like the Regulated Liabilities Network, like the USDF consortium. These are essentially messaging systems, but in a decentralized way. And the settlement takes place either through the conventional RTGS system, the real-time gross settlement system, or through the CBDC network itself. So, and within that, we can definitely have stablecoins or more money market fund-like structures that are actually ultimately anchored on the unit of account that is provided by the central bank. We don't need to piggyback on that. Why do you piggyback if you have the real thing?
The other point that we've heard before, on at least comparing this to the internet days, is that it may be advantageous to have this built by the private sector. I guess your argument on that, Jeremy, and the idea that the internet flourished because it was built by private companies. What's the analogy here as we see the proliferation of stablecoins?
Yeah, I mean, I think there's a lot we could learn from the last 30 years of the build out of the internet. And I think at the advent of the internet, I think giant communications companies thought that they would be controlling through regulated infrastructure how people communicate. But it's actually free software we download and freely use, and billions of us use that every day. We use it peer-to-peer, whether it be email or messaging apps or others. I think the large media companies and television distribution companies thought that their kind of regulated role in controlling the pipes and controlling how people access media, that was turned upside down as well by open internet distribution, where literally anyone can become a global talent and build a business. And those are a scale, for example, the scale of communications that happens in the world today, the scale of information publishing that happens in the world today, the scale of media distribution that happens in the world today are like 100,000x what they were prior to the open internet model. And so if we believe that an open internet model for money and for value exchange can happen, which we firmly do, and we're seeing that built out, and we pursue that architecture, which is built on open public infrastructure, interoperability, and the like, I think we can see not only private sector innovation happening, driving this, but also, very importantly, it's the combination of private sector activity and open intellectual property and public goods that are out on the public internet. That's what fueled the internet. That's what we need to preserve. And I think efforts to kind of put the genie back in the bottle on that are very challenged. I would add one other piece on this, which is, at least from our perspective, we feel very strongly that an internet-based financial system needs to be built on a full reserve banking model. We feel very strongly that tokenized cash, which represent the most direct form of government debt obligation money, is the safest foundation to build a financial system on, and that it's possible to build credit intermediation on top of that. And so we're nervous about tokenized deposits, meaning taking fractional reserve money and tokenizing that and having that be the basis for the internet-based financial system. And so I think, in our view, it's really critical that stablecoins, and I think the legislation that's working its way through Congress right now in the United States, this kind of payment stablecoin legislation that's actively being considered, I think does a very good job of establishing what this new form of digital currency money is. And I think it's the best shot that the United States has right now to compete in dollar digital currency and to compete rapidly on a global stage in dollar digital currency, and to allow a flourishing market of private market competitors to actually drive the innovation cycle there as well.
And Sheila, your thoughts on this? I'd also love to get the regulatory side. Jeremy mentioned some of the stablecoin legislation working its way through some of these bills. What are the other priorities as we kind of pivot to bigger topics too within crypto and within regulation here? What do you think from the industry? Is there a consensus on what needs to happen first to build this crypto ecosystem?
What are not the priorities? I think is the question, right? Just to go back a little bit, though, I think we're already seeing, to your question about will there be an ecosystem where we have CBDC, stablecoins, and crypto all operating, in the same environment. We already have that today, and so that's not a hypothetical question. It's not theoretical. That is exactly what we have. We have digital yuan in production, very actively used. We have USDC, we have Tether, we have active stablecoins, we have numerous different crypto options. So that happens now. So I don't think there's any question about that. I think that is a landed point. I don't think any of that is going to shift or change. I think the question is going to be what is the mix and what is the use of each of those different options and opportunities. And that, I think, is something that is very unsettled at this point in time, apart from possibly within mainland China. Then to your question about regulatory priorities, well, it depends who you ask, where you are in the world. State level, are you at the national level? Are you in Europe? In Europe, we've seen some stable coins. There's caps on stable coins and trading that's kind of working its way through the Markets and Crypto Assets Act, which is a very active discussion in Europe right now, which I think is interesting, somewhat odd, frankly. There's stablecoin legislation that is bubbling up here in the United States that we all think is going to sometime next year really solidify and really come to probably fruition. There's questions around taxation, probably the most well-settled. Usually the taxes go first, right? So in most jurisdictions, you have some clarity around how do you tax the thing, how do you tax the growth, how do you tax the use, all those kinds of things, but still work to be done there. But I think the biggest question that's on everyone's minds at the moment is asset classification. And that's, of course, because in the United States, we're thinking about the SEC's jurisdiction, the CFTC, how does the FDIC, how does our alphabet soup of agencies play in this space? And this isn't necessarily settled anywhere else either. So I think there is this question around the extent to which we are pushing this over into looking at it like a security. We're looking at the secondary market, we're looking at liquidity, we're kind of focusing on some of those aspects of it. To the extent we think about it as a commodity, we're maybe taking a different approach. And so there's a philosophy underlying that I think is not yet settled in even industry minds, let alone in the minds of policymakers and regulators. Yeah.
You alluded to this, the liquidity issues we've seen earlier this year, bankrupt companies, really huge issues in crypto with a lot of individual consumers getting hurt. What were the big takeaways, and what can the industry learn from that when they are trying to build this new ecosystem and improve on it? And will that affect the way that regulators now approach this? Are they a little more hesitant based on what we've seen and some of these high-profile blowups?
I think it was a very revealing sort of events that we saw earlier in the spring, especially in May with the Terra Luna blow-up. I think there was a little bit of a gap, to say the least, between the kind of the messaging, the propaganda, if you like, which is all about decentralization, versus what was actually happening. This was actually pretty centralized. There was a lot of maturity mismatch and leverage that was there. And the kind of financial stress that we saw in the sector was very familiar from the GFC, from the deleveraging that we saw. And I think what we need to do, speaking both with the sector, both with the technology sector and from the official community, is to see what is really at the core that's really useful. Our belief at the BIS is that there is certainly a lot that is extremely useful, that we can actually bring and adapt. And I think just going back to your previous question about what is the role of the private sector versus the official community, the private sector has an absolutely critical role in this, in whatever central bank-based system might be. It's worth remembering that most of the money that's out there is issued by the private sector. The M0 is just a tiny portion of the monetary base. Most of the money that we use is actually issued by commercial banks and other payment service providers. And so what we're thinking here is, so what we need to do is to make sure that the private sector is given full scope to use their ingenuity, to use their creativity to serve customers better. And what that means is let's harness this in a way that's useful when you buy a house, when you trade stocks and shares. Now, I think it's very, very important. What do we gain from going from simply a centralized securities registry to something which is based on DLT? In economics, the idea that somehow, when you have lots of different interested parties, the interests intersect, there's a lot of contingency there. So, I would like to perform this action provided that these other people perform their action. And escrow is a very, very simple example of solving a kind of, bilateral incentive problem. But in supply chains, in many other more complicated transactions, buying a house, for example, is a very good example. The reason why that's not very amenable so far to these very simple sort of bilateral transactions is that there's more than one interested party. You've got the buyer, you've got the seller, you've got the mortgage lender, you've got all the people who assess the quality of title, are there any additional liens on the house, et cetera, et cetera. That's why it takes 6 weeks to actually transact a house. And if you actually can have a system where all of these things are on the same platform in your real name, and we do need real names because the house is in your real name. We need to have a platform where all of these things happen together. And so in a way, I also, when I speak to some of my colleagues, they say, well, why do we need a CBDC? Why do we need tokenization? And I think, in a way, that's the wrong question, in a way, because if you think about those kind of transactions that are not taking place, because we cannot actually bring that within the feasibility set, I think that's where the technology can really expand that possible set of transactions.
And Jeremy, you had a front row seat to this as well. How did what happened with Luna and Terra, let's take as one example, something that was calling itself a stable coin, how did that affect your conversations in DC with potential investors and really the semantics around what is a stable coin and should that change? Should that be a little more clear going forward?
Yeah, I mean, I think there's been a pretty dramatic effect. I think, the first is that I think just broadly, put policymakers and regulators aside for a moment, the market itself very quickly, was basically saying like, where is risk? Where does risk exist? And not just in stablecoins themselves and understanding like, is this actually U.S. government treasury bonds and cash? What are these things? And so there has been a sort of a shift in the mindset of just what risk exists and more, significantly more market-led initiatives around transparency, disclosure, and so on. So, we ended up ramping up massively the amount of kind of trust and transparency disclosures and other things that we've done. I think a second is, very clearly the narrative of not all stablecoins are created equal or stable in name only kind of concepts became pervasive. And I think that has translated in a number of ways. As I like to say, we didn't choose the word stablecoins. The sort of people impose that on what we do. I think if you look at the way we talk about things, we usually talk about dollar digital currency, euro digital currency. We talk about things a little bit differently. And increasingly, I think this gets to a point of we actually need some definitions that we can agree to that actually potentially are even statutory definitions. And I think you're seeing that in the payment stablecoin bill that is being worked on. It attempts to define a payment stablecoin as essentially this kind of tokenized cash model very clearly, whether it's a bank or a non-bank, what these assets are, what is the fundamental risk, and what is the liability, and what is the promise that's being made. And defining that in the United States, if you want a dollar to have these characteristics, this is the definition. And I think that kind of statutory definition will be helpful. People can use whatever names they want. It's hard to like make a law that says that word, it can only be used, although bank is one of those where you get in trouble if you say you're a bank, but you're not a bank. But I think that's very important. Those kinds of definitions, and we've been playing around with and promoting the idea of tokenized cash as a concept where you take what would effectively be cash at the Fed and 3-month Treasury obligations and say that's essentially a cash equivalent instrument, and can we have a digital version of that that is truly transactable as a medium of exchange on the public internet, and that's effectively where we're headed as well, I think, as an industry.
We are running up against the shot clock, but Sheila, I'll give you the last word. I'd love to get your take on this. And then also as the takeaway of what we talked about, everything that happened in the spring, the balance between consumer protection, making sure investors aren't getting into these risky projects, but also allowing the freedom to invest in something and in this new ecosystem. I wonder how you think about that balance.
Yeah, well, I'll pick up on something Jeremy said, which is it was remarkably fast for policymakers, regulators to understand how isolated Terra Luna really was and is, that is not reflective of anything that was called, to your point, it's a good one, that was called a stable coin, that was a pretty isolated example. And so that was not a big lift on the part of industry, quite frankly, and I think that's probably important to understand. Similarly, with some of the other meltdowns is the only real term we can use, I think, accurately, that happened, there's a really clear understanding that those were particular projects that had particular motivations or structures or whatnot that are not indicative of the rest of the industry. And I think you can see that because there wasn't actually contagion from those to others, which is just factually accurate as well. So I do think that most of those who have even a baseline understanding of this, let alone any sophistication in the policy and regulatory space, are looking at this very closely and are saying, how do we ensure that we are dealing with asymmetric information, we are dealing with multi-parties needing to have access to similar kind of rules of the road, this kind of thing. But I think, Kate, the critical question, the critical balance is exactly what you spotlighted, which is how do you balance wanting to give users and participants the ability to engage in these systems, but also providing sufficient, the right kind of transparency. I loved what Mike Hsu was saying earlier about, and something I've been saying for a long time, including, we did a whole paper on this when I was at the World Economic Forum, basically saying that transparency in and of itself does not create accountability. That's not how it works. I was never a litigator, but I'm a former lawyer, and let me tell you, the data dump is a tactic that is used by litigators, right? I can give you reams and boxes and rooms of information. It's all transparent. It's all there for you. If you can't parse it, if you don't know what is the important piece of paper in that sea of information, it's useless. It's basically useless. So creating some meaningful accountability via a disclosure regime, via standardization, via user experience, via all of those things is really important. So what I don't want to see happen, and the nightmare I kind of live with that wakes me up in the middle of the night, as weird as that is to say, is that we're going to create yet again another stratified, divided system where we basically say this group of people are too unsophisticated, usually it's too poor, right, too whatever it is, to engage in these ecosystems. This group of people, do whatever you want, we're not worried about you, which is, if we're honest, kind of what we have today in our banking and financial system. So replicating that, in my mind, would be a horrible wrong and one that I don't want to see come into being. But I think that we are faced with many challenges to get to a world in which consumer agency, consumer empowerment via education, via knowledge is something that we are we're creating a user-centric vision of what this ecosystem should be like, how it should operate. And we're just not there yet. But I'm hopeful. We're on a good path.
Great point. Well, Sheila, we'll end it on that. We could, continue this for hours. This is so interesting, but we have to get on to the next panel. Thank you all, and we'll hand it back over to Chris. And thank you guys for listening.
We are actually up for a quick break right now. Please feel free to explore the lounge in the back, and we'll be back in 15 minutes. Okay, if everyone could please take their seats. In the immortal words of Rocky II, or is it Rocky I, when Apollo Creed says, ding, ding. If anyone would like to continue their conversations, we have a wonderfully soundproofed area in the back where you can meander and continue the conversation with your friends. We have to, in order to provide you with a wonderful experience, we need to run this like a train and get you guys on. I'm gonna welcome our next panel onto the stage, where we will be talking about pricing, risk, and opportunity in crypto winter. When you think about this particular session, I think it's good to have a little bit of scene setting, and we're going to have, to begin it, Robert Lee from PitchBook to provide a bit of an overview. But we're also going to welcome right now both Lily Frankus, the Chief Investment Officer of Novi Lauren, and Colleen Sullivan, the co-head of private investments over at Brevin Howard, to maybe sit by and come on the stage. You guys can sit in the middle, and you, sir, can come here on and deliver your initial thoughts and educate us a little bit about making investments in crypto winter. Thanks, Rob.
Just waiting for the presentation. There we go. Hello, everyone. My name is Robert Lay, and I'm a research analyst at PitchBook, covering the fintech and crypto markets. And for those of you who are not familiar with PitchBook, we're a private markets financial data and research provider. So today we have a very short agenda for the presentation. Hopefully it'll set up nicely for the conversation Chris is going to have. And so we're going to look at VC investment activity, which is looking mainly at venture deal flow and some of the venture capital dollars that's going into the different stages of crypto startups. And then we're going to look at valuations and where it's trending. And last, we're going to look at what startups are still getting funded right now during this crypto winter. So let's dive right into VC investment activity. So as you can see, venture investments this year has still remained elevated. So even though the public crypto markets has cooled significantly, in the private markets, there's still a lot of venture capital dollars going into startups in this space. And so last year, there was $25 billion invested in crypto companies. This year, we're expecting that to surpass that. So the $23 billion you see there is through the first 9 months of the year. And I'll caveat that a little bit in that the bulk of that capital was raised in the first 4 months of this year. So before the Luna Terra failure that led to widespread fear in the crypto markets. So about 70% of that $23 billion was raised before the Terra USD depeg. And then so double clicking into that, we can see which stages of startups in the crypto space are raising the most capital. So I want to clarify a little bit and tell you what we define the different stages. So the seed stage is the first institutional round that a startup receives. Early stage is Series A and Series B, and late stage is Series C and beyond. And as you can see here, seed stage startups are seeing the greatest increase in the amount of capital that they've received on a percentage basis. So about $4.2 billion have been invested into seed stage crypto companies this year compared to $2.1 billion last year. And it's not really surprising, crypto is still a nascent industry. So typically when you see any new technology verticals, a lot of the capital goes into the younger companies first. And as that space begins to mature, that capital shifts over to later stage companies. Fintech is a really great example. Fintech is fairly mature. Over the last 2 to 3 years, the bulk of the capital went to late stage companies. And then this is the monthly chart for venture capital dollars into crypto startups. And as you can see that I mentioned earlier, the bulk of capital went into the companies at the first 4 months of the year, and you saw that drop off starting in May of 2022. What's interesting about this chart is that it mirrors very closely to the market cap of crypto tokens. So as the market cap goes down, venture capital a few months later decreases in terms of the activity going into the space. Historically, venture capital and the market cap of crypto tokens didn't really correlate, but since the beginning of 2020, we started to see a tighter correlation between the two. And the last thing I want to look at for VC deal flow is the median check size that each stage of startup are raising. And as you can see, late stage startups were trending downwards until last year when there's a huge uptick in the check size that each late stage companies were raising. And there were a lot of large deals last year. Circle, Fireblocks, BlockFi, all raised really large rounds. And so that's where you saw the uptick. But late stage companies this year, you're looking at that light blue dot on the far right, has decreased. So late stage companies this year are raising 20% less capital than they were last year. Earlier stages is trending the other way. So seed stage companies are up, earlier stage companies are up in terms of the check sizes that they're raising per round. As a matter of fact, seed stage companies this year are raising more money than early stage companies in 2020. And early stage companies this year are raising more money than late stage companies in 2020 as well. So just an interesting data point. Next, we'll move on to valuations to see how they're trending. So here's the valuations chart. And as you can see, it looks very similar to the previous chart. So it makes sense. Check sizes correlate with valuations. And same thing, late stage companies had a valuation huge uptick last year, and this year they're down just a little bit, down 3%. So not as much as the 20% decrease in check size, which means that founders in this environment are selling smaller portions of their company when they're going out to the market to fundraise, which makes sense, right? They don't want to sell equity at a discount in this market, so they're selling as little equity as possible. On the other hand, seed stage companies and early stage companies, their valuations are up. Seed stage valuations are up to $20 million post-money this year compared to $11 million last year. And early stage companies' valuations are up 6 to 8% to $92 million this year. And I want to just shift over a little bit to the public markets, looking at public trading multiples for some crypto exchanges, because due to the opacity of private markets, it's really hard to get that data of revenue multiples. So I wanted to showcase what the exchanges are looking at. And I'm comparing some of the decentralized exchanges, so Uniswap, SushiSwap, and Balancer, with a centralized exchange, Coinbase. And what you're looking at here is the free-floating market cap to the trailing 12-month revenues. And as you can see here, the decentralized exchanges are trading at a premium to Coinbase, which is the centralized exchange. And so what we think that means is that public markets are viewing decentralized exchanges as either having better growth prospects, less risky, or a combination of both. And lastly, I want to showcase what is getting funded over the last quarter or so. So these are the top 10, probably small font that you probably can't see, but I'll dive in a little bit. But these are the top 10 venture deals since July 1st. And all 10 companies fall under just 3 buckets. The first is layer 1s, which are the base blockchain platforms. The other one is gaming and metaverse. And the last is infrastructure, which includes things like custodians, staking services, security, and compliance. And we really expect investors to continue to be bullish on these spaces, especially around infrastructure that's enabling institutional participation, as well as L1s, L2s, and these cross-chain bridges, which will help increase the security, the scalability, and the interoperability of the crypto ecosystem. And with that, I'll shift the conversation over to the panelists.
All right. Thank you so much. That was wonderful in helping us to set the scene. Joining us as well, we'll have MC Ladder, wonderful and on time from Uniswap, to help us dive into some of the issues that we saw in the data and in the pitch book. I guess I'll start off with Colleen. You've seen a crypto winter before and lived one. How do those data that we've seen, how do they compare to what you've experienced, both in earlier iterations and obviously from your perch now over at Brevin?
Yeah, so this crypto winter to me is pretty different than the last one. So the last one on the trading side in January of 2018, it was pretty clear that we had a problem. All of the big ARBs from the back half of 2017 were gone. Prop trading firms had entered the space and had really brought prices across various assets in line. And then it took until about the third quarter of 2018 to see that on the venture side. We didn't really know we were in a proper bear market until about that time, which is why on the slides you see that uptick in deals from 2017 to 2018. This time, it's quite different. While we saw some fragility at the growth stages in mid-Feb and March, we thought that was primarily related to the global macro environment and what was happening with tech stocks. And then, as Robert noted, you hit May 9th, Terra depegs, and it's like you've gone from one realm to an entirely different realm. And it was just a violent repricing across all stages, all the way down to pre-seed, so quite different. And then from there, we have some cascading, unprecedented events, which were spoken about earlier. You've got, the total disappearance of the 7th and 10th crypto assets. 60 billion goes away with them. 2 trillion in market value comes off. You have bankruptcies with Voyager, Celsius, and Three Arrows. It's kind of remarkable, I think, a little bit that Bitcoin and Ethereum have held up the way they have. But it was very different. It was much more abrupt than the last one, I would say.
Scarier?
Yeah. I mean, I never worried that crypto was going away, but it was definitely scarier because you have, institutions that you thought had better risk management than what it turned out they had. So we had a lot of, these were not crypto problems per se. They were bad risk management problems and some fraud mixed in.
So, MC, I think that particularly at your perch, you'll appreciate that one of the, distinguishing features of this crypto winter as compared to the last, and maybe taking cue from Colleen's statement, is the existence of DeFi in and of itself. What does crypto winter mean for DeFi? Does it mean something different for DeFi as compared to other nooks and crannies of the crypto ecosystem?
Well, as you said, this crypto winter has been different in that DeFi does exist. And frankly, I think it's been a validation of DeFi. So just a quick reminder for those in the audience, DeFi or decentralized financial services are essentially protocols that have either some form of decentralized governance or may operate in a decentralized technical architecture. So they may be self-executing smart contracts on a blockchain that don't require or depend on human operation. So in the same way that the Bitcoin blockchain, Satoshi Nakamoto is unknown to the world and it continues to operate. So the Uniswap protocol, which allows people to swap any two crypto assets for each other. So the Uniswap protocol can operate even if the core team that invented it and built it goes away. And what we saw for the past year, as all the events that Colleen was describing happened, was that the big challenges were, as she said, traditional risk management challenges, that they were often organizations that had centralized risk management functions, centralized liquidity management, that were not engaging in the practices that are well known in traditional financial services to be critical in stewarding people's assets. And so in contrast, in DeFi, you have full transparency as to what's happening to your assets, whether you're an individual and retail trader and investor or a large scale institution. And so I think that over the past 6 to 9 months, what we saw was that these protocols really held up. And so now in crypto winter, the challenge is to focus on building and using this time of less frenzy in the market and less enthusiasm around specific crypto assets to instead make those services available to more people. So today, it's still too hard to use DeFi. There's too many points of friction in the user experience. It's too complicated to explain how they work. We in the industry haven't done a great job of explaining why the ability to hold your own assets or the ability to swap in transparent and reliable infrastructure like I described is any different or better. And so I think the opportunity in crypto winter for companies like Uniswap Labs and others in DeFi is to make it easier to use those services and to better explain why they have advantages in reducing systemic risk, in reducing other kinds of market risks that otherwise are replicated in the centralized financial infrastructure that we saw really suffer over the past 6 to 9 months.
Yeah, we're going to have later a panel that really tries to get to some of those issues that you raised, looking at what contagion and systemic risk looks like, and what parts of the financial system, TradFi or other, can contribute to that risk. But I think I'll just keep along on the pricing and an investment sort of theme for the moment before we return to it. And Lily, you are the quant's quant, to say the very least. Also hilarious on Twitter. But when you go about trying to gauge risk and to think about what's important, when investing, right? What kinds of metrics do you think are important when trying to quantify, risk or opportunity in crypto markets?
So it's very interesting. We actually were talking about this right before the panel on the lack of industry accepted as well as regulatory accepted metrics and frameworks for understanding risk. And previously, before I did, on the investment side, I was more on the corporate credit risk side. So a lot of the issues we've seen this year in the crypto markets are pretty well paralleled by what has occurred in the traditional markets previously. I think the long-running joke is it's almost like the ants discovered space travel, that they just speed ran the history of the traditional financial markets in, 10 years? So a big downward pressure we saw, especially in May, was that all of these institutional players had hidden exposures to counterparties that were now either functionally insolvent, as we saw, unfortunately, with 3 Arrow, Voyager, Celsius, or they were pretty badly damaged by the blow-up of Terra, in the Luna ecosystem. So one of the downward pressures on valuations now is just the lack of leverage. You saw massive delevering in the May period, where not only on the visible space, so if you look on the exchanges, of course, when you look at perpetuals, you saw significant negative funding as people went on the short side. That's kind of dying off because it hasn't been as prolific and profitable over the past month or two. But on the institutional level, a lot of these larger players, the Genesises, the Galaxies, have pulled back a lot of their leverage that they've lended to these counterparties. I joked on Twitter, especially when I was still working corporate credit, that this would be a fantastic year to start understanding risk in crypto. We then saw the blow-up of Wonderland in the January period, which kind of was the harbinger of what would come much more painfully later, that during a bull market, risk is completely discounted. You see not only on the venture side funding of teams without proper due diligence, but even on the institutional or on the lending side, that a lot of these players that were considered the blue chips or the centralized players in the crypto markets were not managing their loan books properly. They were generating fantastic yields because the markets were full of dumb money. And if you could do a basic cash and carry and get, let's say, 10%, then of course you can provide to your depositors 10%. But what about when the market turns? There wasn't enough understanding, and part of that comes from the relatively short history of the crypto markets, but part of that also just came from pure greed.
So I must say that I actually did not expect so many things to sound so lawyerly coming from this panel on risk and opportunity. I feel special, and I hope my law school students who are watching do as well. Right now, the last couple of comments that I've been trying to get into was to ask those sort of metric-related questions, whether or not you're looking at liquidity, whether or not you're looking at the positions of different parties and counterparties in different kinds of markets. But again, risk management seems to be the overwhelming theme. But MC, I'll try to put you on the spot as well to ask you about metrics. When you look at a DeFi project, what kinds of things should an institutional investor be looking at? When trying to gauge the likelihood of success or failure in a project, what are the metrics that tend to rise to the top of your list?
Well, I can tell you the one that I think is most misunderstood and the least important, particularly in automated market making, which is total value locked. So when people talk about the size, the metrics in DeFi, the size of the market overall, they often like to talk about the total value locked in some of the protocols. And that means either collateral in the case of a lending protocol or liquidity, capital that's available to provide, to make markets in an automated market maker. And at least in the case of automated market making, the technology is getting more efficient. And so it's really not the best metric. You want to have less total value locked for more kind of total volume of swapping. So I think that's one that's still kind of a little bit misunderstood. For an investor looking at whether to invest, I think it depends whether you're looking to use a protocol for your own capital, so to be a lender or a borrower, or whether you're looking to invest in the project itself and in its associated token. For tokens, every token has different tokenomics. So I think a couple important things to look at are the distribution of ownership of that token. So how broadly at the outset are the set of people who are invested in its success. The broader, frankly, probably the better. User communities and broad distribution of ownership is part of what has driven some of the success of some of the layer ones, and also some of the breadth of participation in Uniswap, for example. Another key thing to look at is, of course, users. So many of these projects are very small. They're not set up like corporations with big marketing teams. And so usage tends to happen somewhat organically. And so looking at the initial usage is pretty important. The different lending protocols or options protocols, all are pretty specific. So to be honest, I don't think it's really helpful to generalize across and say that there's specific metrics that you can think about to look at all of them. I will say there's one thing that we're doing now to do token safety warnings that we're going to launch actually tomorrow on Uniswap. And these will be sort of red, yellow, green kind of warning labels that indicate a level of risk associated with the token. And we had like a highly technical team of many quants and many people with PhDs working on this. But at the high level, what they measure are a couple things. One is some of that distribution of ownership. Two is the frequency, some of the volatility of the price, some of the likelihood that there are rug pulls, which are essentially when people push up the price and then pull their assets or pull liquidity and leave people holding the bag, so to speak. So there's a couple of different things you can look at, but I think those are some of them. And then the last thing I'll say on metrics overall, just to get back to your point on crypto winter and what's different. I mean, a lot of the usage of DeFi has tracked the market, has tracked ETH pretty consistently. So Ether, the token associated with Ethereum, the price of Ether is still, frankly, a pretty good indicator of usage of DeFi protocols and the size of the markets participating in them, overall lending or swapping. So I'm hopeful that over the next couple of years, we'll see that diversify more. But so far, that's still proven a pretty overall useful indicator in the size of the market.
So Ether is the Apple of I guess, crypto markets. Colleen, how closely does that track to you? I mean, number one, a couple of things that just popped into my mind. A couple of PhDs used to track, the distribution of ownership. Is just sort of, again, for a securities lawyer, sort of tingles your spidey sense because you're thinking, oh wow,
I want to correct that. I didn't say your technique requires PhDs to see the distribution.
Oh, sorry, you broke up.
Ownership.
Sorry.
I just want to correct that. The distribution of ownership, so when you say tickles your spidey sense as a securities lawyer, it's not that it's hard to find the distribution of ownership. That's something that's actually quite transparent and easy to see. And that's an example where I think having these publicly available protocols is helpful. You can have that kind of real-time disclosure. What I said we had several PhDs for is coming up with the many different kinds of factors that might drive risk. And that's no different than in any financial organization. So I just want to be really clear, Chris. It's not that finding distribution of ownership is so hard. It requires a PhD.
Don't worry, MC. I totally had your back there. I was going to go into the public ledger part. I've written on disclosure and also the transparency available in open public blockchains. But where I was going to go was to say that other aspects, and this is something that Mike Su had mentioned early on, of that ecosystem are a little bit harder to be able to engage and figure out if you're not an institutional investor and if you're not a sophisticated investor. Colleen, with that in mind, when you think about those metrics, number one, do any of those metrics sound right to you? I guess most of them do. Are there any other kinds of metrics that you think are really useful? And then are there any kinds of metrics that you think maybe a little bit harder for the non-geniuses to be able to access that you think about when you think about the larger evolution and scaling of the space?
Yeah, so everything Lily and MC said, we definitely use when we're looking at investing in the space, all of these metrics. But sometimes where PhDs are unhelpful is you also have to think that memes are fundamentals in crypto. So there's a whole nother area that models just aren't built for right now. And part of that is because of the heavy retail participation in this space. So an example would be, let's say that we need to value an NFT representing a piece of metaverse land. Well, what are the factors you would put into your model? I would probably want to know what ecosystem is that metaverse in, what type of liquidity does that ecosystem have, what kind of infrastructure has been built up, what do the customers look like. I'd want to know how many people can visit my property in that land in the metaverse in one instance, 100 or 1 million. It's probably more valuable if it's 1 million. I'm going to want to know who is that property by. Is it next door to Snoop Dogg? Maybe it's more valuable. So I think you get my point that these models aren't here yet. So it's just a completely new scheme. That said, when you're looking at early stage venture, it really is quite similar to traditional venture, except when you get into also having a token. So some of our investments are pure equity, some of our investments are pure tokens, and some of them are equity where you have token warrants. And again, there's no models for this. You really have to think through where's value going to accrue, to the equity, to the token, how's that going to work? And all of that is still really unsettled.
Lily, I know you have some additional thoughts here, but I also wanted to challenge you beyond the metrics question to also give us a little bit more about how do you price not only the value proposition, whether or not you're close to Snoop Dogg, that has to mean something, metaverse or otherwise, but also regulatory risk.
Yeah, that's a big one, and accounting risk, definitely. Regulatory ambiguity and accounting are pretty significant barriers, I'd say, to institutional adoption of a lot of these DeFi protocols, as well as liquidity concerns. Given the retail dominance, there are a couple large players like a Uniswap or an Aave, which have enough deep liquidity that they can be part of a traditional, let's say, prop firm's systematic process, or even on an institutional level. There's been some pretty major wins recently with the MakerDAO and Compound working with these traditional financial players for fairly sizable loans. But the issue is it has a very long tail distribution in the sense that a lot of this liquidity is captured by these large protocols with significant drops once you get out of the top 10, top 20, down to maybe 500,000 of TVL. And I actually joke when you mentioned TVL that total value locked is great because it's neither total nor value nor locked, in the sense that a lot of these metrics, and we saw this pretty painfully in the 2020-2021 bull run and the ensuing bear market we're in, is that a lot of these valuation metrics are extremely price reflexive, in the sense that everything looks fantastic when price is going up. People are trying to game airdrops. You see a lot of users. You see a lot of, however you want to slice it, TVL, daily active users, monthly active users, messages, social media. All of those look phenomenal when people are being paid to use your product. That doesn't mean to say that a lot of these protocols haven't achieved actual market fit. Uniswap, for example, was the original large AMM, as well as Aave was, and still is quite, I think, by far the largest lending protocol. But that said, on the long tail, a lot of these different protocols that raised and looked phenomenal during the bull market did not achieve product market fit and saw their user base pretty significantly dwindle, as have a good chance of actually dying out completely due to the token price not achieving expectations. Once people weren't paid to use it anymore, was it actually worth it? Another one goes back to your point about memes, in the sense that, especially in the 2020 and 21 period, as well as this 2017 and 2018 period, the crypto markets were highly, volatile and looking for the next narrative, essentially. So you saw the scaling and massive bull run on alt L1s last year, for example, going into the early part of this year, before that DeFi summer. And if you kind of look at these markets as a giant hot bowl of money, to borrow, the 2008 period in traditional markets, then the success of one of these narratives meant the diminishing of another one of these narratives. So in the bull run periods, of course, you see that there's still inflows of actual dollars into the crypto ecosystem, but as that dwindled due to the ensuing bear market, it became very much, to borrow a crypto term, player versus player, in the sense that are alt L1s doing well, then metaverse is no longer the hot category, and you see a drop in usage there. So when you consider the actual fundamentals of a lot of these projects, you need to understand what are the actual sticky users, have they actually achieved product market fit, versus who's kind of, like myself, would be mercenary liquidity. Are you here for a good time, or are you here for a long time?
All right, well, we're already starting to run out, but we have a little bit of flexibility with the break. So I'm going to ask you guys, all three of you, the same question, starting with Colleen, which is, we've seen some differences in crypto winter. Whenever crypto spring comes, do you expect to see any other differences in terms of how that's going to play out, or what it would look like as compared to previous crypto springs?
For sure. I think Robert's slides were telling here in terms of what people are investing in now, and a common theme is infrastructure and games. I'll stick with games because I think it's more fun. So really quick, we've got 1 in every 3 people globally is a gamer. You have 81% of Gen Z playing games. You should assume that every single baby born every day, so 140 million people annually, will be a gamer. 75% of kids, United States, UK, Australia, New Zealand, and Canada play Roblox aged 9 through 12. The market's just massive. And when you add crypto to it, it really accelerates what games can do. So I think crypto spring, and we see a lot of this under development right now, we're going to see some fabulous games.
Very well. I like to play. Lily?
Yeah, to add that, there's a lot of L1s that seem to cater more to the gaming side. One of the biggest roadblocks on Ethereum, although, there has been efforts by their developer community to kind of reduce the gas prices and make it more horizontally scalable, but, Avalanche, I believe, is a pretty strong game community, as well as, if I remember, I think there's a couple on Polygon as well, too. I do think on the infrastructure side, it's kind of a catch-22 here, in that infrastructure, by definition, presumes the existence of a strong product market fit in other categories. Going back to the analogy of the 1850 period in California, with a gold rush, you could sell shovels and make a lot of money to the miners, but if the mines close, then so does your shovel business. So I do think that, one of the things I'm most excited about personally is better support for deep liquidity and liquidity sharing across a lot of these DeFi protocols. I do think DeFi, once there is more regulatory and taxation clarity, you will see more interest on the institutional side, just fundamentally from my own experience, as well as looking at it compared to the traditional financial setup. There are a lot fewer barriers here, and it lends to a lot of interesting workflows, as well as you see a lot of progress in the design space with automated market makers, some like Primitive. One interesting one I remember actually is built on a combination of Uniswap and Maker called Gelato, or Oasis app, that you see a lot of this interesting designs, and but people from traditional finance may kind of like roll their eyes here, but this ground in this new market is really a good experimentation ground for new financial products. Or another one was the Power Perpetuals from Paradigm that are now live on Open. That's something that is a derivative product that is pretty novel compared to what you see in traditional markets.
MC, what spring? Will it look different than before?
I think so.
Yeah.
From different springs, or what do we think is most exciting in the
No,
spring?
whenever the crypto spring to come, whenever it comes, do you think it will look any different from crypto springs that we've seen before?
I think we've learned a lot about some of the risks. I know we've talked about market risks, but also there's a handful of technical and security risks that have been exposed and made all the more acute in the past few months. And so we have a small effort to invest in other crypto protocols and companies, and we've invested in a number that are trying to make crypto safer. And so that includes everything from companies that help scan for spam NFTs so that you're less likely to have phishing attacks through your wallet, to companies that are trying to hedge what's called impermanent loss. So I think I'm really excited about companies that are going after clear, acute problems that will make it easier for more and more people to participate, whether they're institutions who have to address some compliance concerns or retail investors who don't have the bandwidth to be managing investments day to day or who are concerned about technical risks. So I'm definitely optimistic that Crypto Spring will feel a lot more user-friendly, perhaps, than even the most recent bull market.
All right, well, this was a wonderful panel. We're going to take a very brief break, and then we'll have CFTC Chairman Russ Binham, who will clear up all regulatory uncertainty, and we can get spring going. But thank you so much to the panel. Hi, everyone. Hello, everyone. Ding, ding, ding. For our next round of conversations. Again, if anyone wants to continue their conversations, we have our wonderful lounge area with little TVs where you can watch the conversation from there. But we've had some really great conversations thus far, and it is a distinct pleasure for me to welcome my friend Russ Benham to the stage, the chairman of the CFTC. You can come up on stage, Mr. Chairman, where we will be having the honor of hearing all regulatory. We'll provide, as I said in the last group, 100%. Yeah, thank you.
I heard that, and that every kid born today is going to be a gamer. So
that is exactly.
I'm not sure about my three daughters.
The crypto winter is going to bring all kinds of new things. I just never thought of that. Okay, I know we are in Washington D.C. We are finally back here and in person. And when thinking about this conversation, I guess I'll start with some of the more obvious questions that I know everyone wants to sort of get to, and then some of the questions that I have thought a little bit more about as I've watched you in the international financial system. I guess the first question is the jurisdictional question of regulatory competence, especially when it comes to cryptocurrencies. After all, most of us today are sort of trying to kick the tires on regulatory risk and policy relating to crypto. The CFTC has really had a very interesting moment, one that we really haven't seen really since the financial crisis, and tried to sort of fit in and to think through where and how the CFTC can lean in on issues of risk and regulation. What do you think, in a nutshell, when you are asked this question, and for the audience, especially for those coming from out of town, where do you think the CFTC can lean in most effectively when it comes to the integrity of crypto markets?
Thanks, Chris. It's great to be here. Always a pleasure to sit next to you and talk about these issues. I would say if we're talking about the resiliency, the strength, the integrity of the crypto space, and I think we all have a different perspective. Me, certainly as a regulator, my priorities are integrity or customer protections, but we are a civil enforcement agency, right? So we have been quite active in the enforcement side on crypto with a very limited jurisdictional hook, which is a very DC term, going back to 2014. So we've been doing everything we can to protect customers and use that authority. And that authority is extremely important, right? Because we assess penalties, which ultimately the goal, I think, from a policy perspective is to deter future wrongdoing, whether it's fraud or manipulation. Through disgorgement or restitution, we can get money back to people who have been defrauded. So if you talk about the integrity and the success and the quality of the markets, that's a hugely powerful tool that we share with the SEC, obviously, and Justice and some other regulators as well. The other element, which I think is extremely important, is we're a market regulator, right? And as this market has, we talk about being born recently, right? But it's not too old. It's matured a bit, maybe not as much as some of us like, but it's matured for sure in the past few years. And my observations are that the market, amongst some of the larger trading platforms, is very similar to the markets that we oversee, right? It's your traditional, for the most part, central limit order book, bidders and sellers. And the components of making a market fair, efficient, transparent are not, very different, regardless of the financial asset that you're trading, right? You want pre-trade transparency, you want post-trade transparency, you want an orderly, order book with liquidity. You want participants who meet governance standards, who will not list contracts that are readily susceptible to fraud or manipulation. You want to make sure conflicts of interest don't exist. These are core principles that we have at the CFTC and that we've been imposing, overseeing, and regulating for decades. And that's why I think when I think about our role vis-a-vis crypto, between the enforcement and the market oversight and that experience and that expertise really, I think, gives us a strong opportunity to be a very effective regulator in this space.
Yeah, you know, one of the really interesting aspects that I've followed, because I'm more of a, well, securities and derivatives kind of guy, and I'm teaching securities law, is that when you look at the specific array of issues involved with something like regulating the Bitcoin spot market, right? It's an area where, on the one hand, the CFTC could have a very interesting place, a very interesting role, very important role for establishing integrity for markets. But getting to that transparency part, you know, like transparency is typically associated with securities law. You know, we have to file certain kinds of documents, and those documents then are used, sometimes read, sometimes not read, but you know, are at least supposed to be designed to introduce transparency into markets. You know, it's not normally a concept. Disclosure certainly is not usually a concept that's associated with derivatives markets and the CFTC. How would the CFTC be able to lean in on that particular issue?
Yeah, I'm glad you asked that question, because it's one that I get asked a lot these days. And I think if you spend some time and learn a little bit about our rules at the CFTC and our regulations and our requirements, yeah, we don't have the traditional securities-based disclosure regime. But there's a reason for that, right? And there's a reason for why you want to bridge that. I use this term a lot. I think it's probably been used by others, information gap between the issuer of a security and the investor, the purchaser of the security. We don't have that issue in the commodities space because commodities are largely decentralized, and you don't have those core components of a security, which is, you know, a management team, perhaps a headquarters, audited financial statements, risk analysis, a lot of these things that we see in 10Ks and 10Qs and prospectuses. So what I've advocated for and what I've asked Congress for is very clearly spot authority over commodity digital tokens. There certainly is an extremely important role for the SEC to play on the security token side, but I don't think that putting the commodity tokens, which in my view, at a minimum, we have a clear decision by a federal court for Bitcoin, several federal courts for Bitcoin. I've advocated or articulated my belief that Ether is a commodity and several other tokens are commodities as well. These commodity tokens should be regulated by the CFTC. Getting back to your question, though, to disclosures, you think about, you know, we have exchanges, which are called designated contract markets. We have our version of brokers, futures commission merchants. We have pool operators, which are like investment managers and investment advisors, commodity pool operators, commodity trading advisors. There's a pretty rigorous and deep disclosure regime around what these entities, these regulated entities, need to do and the information they need to share with their investors. It's not security specific or about the underlying commodity. It's about the risks associated with investing. It's about the risks associated with derivatives markets and leverage and the infrastructure of the market. And that's what we need to focus on, I think, in the commodity space, because those are the issues we need to bridge, not the management team or the centralized entity.
Yeah, it's really interesting because that dovetails a bit with Acting Comptroller Mike Sue's comments a little bit earlier in thinking about, well, is the purpose of the disclosure, right? And how do you actually achieve the goal? And what tools do you use to get there? And that's obviously going to be something that the CFTC is going to be thinking about.
I would say, Chris, sorry to interrupt, but you know, we're going to have to adapt, right? Yeah. Like, there's no doubt about it. This is not a very like in the box moment where everything is clear and perfect. This technology is very different. Yeah. It's very new, and all agencies are going to have to adapt the current structure we have, because if not built decades ago, we are moving in an evolutionary time in markets.
Yeah, I would not to go into the comment because you're much more interesting than that, but it's very fascinating. I mean, because ultimately, you know, the CFTC is going to get called upon. It's done it before. Regulatory agencies are called to do it from time to time to innovate, precisely to meet the very specific regulatory challenges that are before them. The CFTC has done it before in creating swap data repositories. They'd have to do it now, you know, when it comes to Bitcoin spot markets. One thing that the CFTC is continuing as well is also enforcement, and trying to adapt and think through what enforcement means in different contexts. I know a lot of folks here are aware of the recent Okie Dow case, and DAOs have really taken off since 2021. I have in my notes that there are about 5,000 in operation with almost 4 million token holders. So that's not nothing. Now, no, you can't speak to any particular case, but are there any lessons in your mind that token holders should be taking into consideration when voting in DAOs? Or are there any lessons for non-voting token holders from the standpoint of the CFTC?
You know, and there are parts of this case that I can't discuss, but there are parts that I can discuss. And for those of you who are familiar, you'll understand why there's elements of it that were settled, others parts of it that are ongoing litigation. I've said this before, but the DAO space, I don't think anyone who's creating a DAO or part of a DAO should think that this is a free pass from regulation or enforcement. And that's just the bottom line. This is a very unique technology that is being driven by the moment of the day, and the fact that we have technology that enables a potentially decentralized entity or organization does not mean it's going to be free from some sort of regulatory framework at the state or federal level. And I would encourage those who are in the audience to take a moment and look at this case that Chris brings up. It's on our website, it's available, it's quite public information at this point, but it was hardly decentralized. There were a few individuals who were very much at the center of establishing the protocol. I think that's the right way to frame it. And it was just clear fraud, right? And not only was there a statement to suggest that we structured this in a way to avoid and evade CFTC regulation, but there was a solicitation of retail customers for leveraged derivatives and on a trading platform, or something that essentially mimicked or looked very much like a trading platform. So these cases where, and this is, I think, an extreme where it's so egregious and so obvious that we would be essentially objectively failing to do our job if we didn't bring this case. Things are, facts and circumstances matter as they are in litigation and enforcement. But in this particular matter, I think it was pretty clear that a few individuals were clearly trying to evade our rules, understanding the scope of them, and to offer contracts that are regulated by our statute and our rules to retail customers. So going back to what I said earlier, yes, this technology is new, it's unique, it is not traditional in the sense of what our statute intends or expects, or the rules behind the statute, but I would say for anyone out there who's participating or who's creating or innovating, don't expect this to be a free pass.
Well, with the DAO in and of itself, there are sometimes those who think that the absence of a legal wrapper is somehow a pass from escaping liability, and sometimes it's just the opposite, that incorporating or obviously registering with your authorities can be essential. But getting back to this larger regulatory conundrum or challenge, right, of trying to figure out how do you adapt, how do you keep enough room in the system to be able to adapt while at the same time carrying out your essential mission for market integrity. It naturally brings up a longer conversation that's been around really for 20 or 30 years. The question of principles-based approaches to oversight versus more prescriptive forms of oversight. How much flexibility and adaptability does a regulator need, and how much precision does the rulemaker or even the market need in order to function properly? I mean, when you think about the principles-based aspects of derivatives law, of CFTC oversight, how do you think that maps on to a subject or an area like crypto?
So I think it's well suited, but I want to turn back a little bit and pivot to answer the thought, because I think there's a misconception about principles-based regulation. I think some will come at principles-based regulation and think, oh, the regulators just looking at things from 50,000 feet. You know, they're just monitoring from a very, very bird's eye view. And that's not true, right? If you look at our rule book or our you know, we get these statutes every year. The statute's actually not that big. It's not 20 some odd sections. But there's, you know, a very thick prescriptive set of rules that are built on the foundation of the core principles. And it gets very prescriptive to entities and activities about what conduct and what activities can occur. And these are all driven by and through the principles themselves. So going back to your question, I think it's actually well suited, particularly for this technology, but writ large markets, because markets are constantly changing, they're constantly evolving, many times driven by technology and technological advancements. And it allows us as the regulator to adapt and evolve with the market. We're always going to be a step behind. I mean, there's just no doubt about that. For us to keep pace and to be able to adapt using this framework where there's a foundation of principles and we can amend the rules at the commission level without the need for more statutory authority or a tweak in statutory authority, I think gives us the flexibility to not only be a better regulator from an enforcement standpoint and a transparency and integrity standpoint, but ultimately to give clarity to the market about what the rules of the road are and how they need to comply with them.
So when you look forward and you think about the challenge of cryptocurrencies, the CFTC is in an interesting position. I mean, you know, we traditionally view the markets that the CFTC overlooks as largely institutional markets with institutional players. But when you think about crypto and you think about the participants in crypto markets, it's also very much, and as we heard in our last session, there are a lot of retail players in the crypto market. What does that mean from your perch? You know, when you look at literally the different kinds of participants that are increasingly in crypto markets, given the traditional institutional focus of the CFTC.
Yeah, you know, I often bring up this anecdote. We all remember the meme stock movement, which in many respects is still going on, right? But that sort of peak of it in, I think, February 2020. Obviously very focused on the equity side of our financial markets, but there was quite a bit of a move in silver markets. And there was some generation in the social media space around the movements that we were seeing in silver markets. And silver markets, commodity markets are hard to move. They are deep, they are liquid, and you have, as Chris pointed out, heavy institutional participation. So for retail participants to move them around is not insignificant. All that to say is technology is disrupting markets, it's lowering barriers to access, and we have an increased level of interest by retail participants across the globe. I think this was, you know, given a shot in the arm by the pandemic, right? These storylines we hear of people at home with a little bit of extra cash because they're not spending it on vacations or other things that we typically do, and then markets become this very interesting way to allocate capital because they're very volatile and lots going on in the world. And I think that momentum has driven, obviously, a lot of excitement in the crypto space and invited a lot of new participants in our markets as well as the traditional equity space. So we've been experiencing this for quite some time. We have a number of retail participants in our cash-settled contracts on the pure derivative side. And I think it's been something that I've been thinking about, I know my predecessors, about how do we change the tilt and the sort of approach from an agency perspective so we have broader outreach to the retail market participant. And in many respects, it's about information and it's about making sure we are getting information to these individuals in a comprehensive way about what risks exist and what risks lie in a leveraged market. And that really puts weight on our shoulders to take action. And I've done a few things within the agency. I've reorganized our Office of Customer Education within our public affairs. We have an Office of Proceedings to help and support retail participants. I've created a Chief Diversity Officer, which actually is a huge, I think, advancement for the agency itself, given some institutional inertia, of reaching out to a broader constituency of investors so that they understand what our markets are. And as we continue to see this retail growth, we are doing our job, right? We are making that information available to everyone.
Yeah, on that last part, I always sort of say, if the space scales, then you have different kinds of participants. It creates a burden on the industry to make sure that if they want to continue to scale, that they understand who these new participants are, and also on the regulators to make sure that they have the staff to make sure that the rules in place are being written in a way that speaks to all of our very, very diverse stakeholders. I guess when you look to the future, again, okay, that's maybe not. I want to talk about prediction markets. So I guess I'll say you're looking to the future, thinking about prediction markets. This issue of prediction markets is one that's kind of lurked around. It's certainly created lots of interest. What policy questions do prediction markets pose for the CFTC? I mean, just from a first. It's a fascinating area, and a lot of times people don't take the time to actually start with what are the initial areas of friction and interest and opportunity.
So another good question and something that is high on my sort of priority list. I think the sort of base layer I'll start with is it should be known that for many years there was in statute a requirement that contracts listed on our registered markets have an economic purpose, right? So the idea was that if you're hedging, or if you're a designated contract market, if you're an exchange in our marketplace, that contracts you list have to have an economic purpose, right? So there has to be a commercial hedger using or utilizing that contract, whether it's in the agricultural space, the energy space, the metal space, and then in more recently, now a couple decades, but the financial sort of derivative space. But there was always an institution needing to hedge that risk, and there was that correlation or that relationship with what is the economic purpose of that contract. Not dissimilar to my response to your previous question, markets are changing. Technology is enabling a whole different cohort of investors into our market. Risks are changing and adapting, right? One of the major participants in this space, I remember having initial conversations years ago in thinking about what are the economic risks that small, medium, and large businesses face. It's not just agricultural risks, right? It's not just energy risks or metals risk, right? Think about COVID. I think this was a good example, right? What is the risk of spikes in positivity rates to large retail food chains across the country, right? Obviously, it could be positive, it could be negative, depending on how things play out with people getting out of the house, going to restaurants, drive-thrus. You can imagine a number of scenarios where any number of issues that we deal with in the country, whether it's geopolitical, domestic, social, could have risk management impacts on someone's business. So I think with that in mind, it I think forces us to be open-minded about moving away, or at least creating a tandem sort of road with these traditional agricultural, energy, metals products that we have listed for decades. That said, there is something that it is our statute that is very specific about the type of contracts that we can and cannot list. We can, and just to name a few, cannot list contracts associated with war, terrorism, assassination, gaming. It's very clearly in our statute prohibited to list. There is some flexibility around public interest, and I think this is where the rub comes with this particular space. It's not the platforms that are the policy issue. It's the contracts that are being listed. And I think with all that's going on in the world, because this is really an issue that's popped up in the past decade, and it has really accelerated in the past 2 to 4 years, where you're starting to see registered platforms wanting to list a variety of contracts that are outside of the traditional derivative space. And it's forcing us, and it's on our unified agenda, where we're going to tackle this issue and get a little bit more prescriptive in terms of clarity about what contracts can be listed and what contracts can't be listed. Because this is an important policy question for the country. Like as we see this shift in gaming and gambling, right? The 2018 Supreme Court decision has obviously shifted our approach to online gambling. We see this every time we watch football on Saturday or Sundays, right, depending on what your flavor is. And do we want to shift that type of activity, not specifically that, but you can imagine from a general sense, onto federally registered financial markets? And then the political question, it's a very important question, right? And a lot of people will say this is going to be better than polling. But you can imagine a lot of people would have strong opposition to political outcomes and elections being driven or being predicted in a federally regulated financial market.
We only have 5 seconds left. Yeah, but which was well, unfortunately, time is up. There are so many great questions. I really appreciate you coming by, Chairman.
My pleasure.
And let's thank Chairman for his views.
Thanks.
Good. So we're going to have our next great panel coming to the stage right now on community-based crypto. You're with
Should we, 1 minute, right? Should I go? Go start? Mine's on. Hi, everyone. Our panel today is on community-based crypto. So I'd like to thank all of the panelists first. I'm glad to have you guys here. We have heard a little bit already about Circle and their platform, but Fenny and Robbie, how about you tell us a little bit about your companies and what they do? We've heard a lot about there being use cases for crypto, so it'd be interesting to hear about the use cases of your platforms.
Good afternoon, or good morning still. My name is Fenny Wang. I am the founder and CEO of Humanity Cash. So we're a startup building a platform that allows communities to have their own community currencies, working in conjunction with their community banks. So we're creating these local stable coins for real-world payments to support local economies and to support community finance as well. So our first project is called Berkshires. It's a digital currency that circulates in Berkshires County in Western Massachusetts, working with 2 community banks there to hold the underlying dollar reserves. And we have about 90+ merchants ranging from the local food co-op to Main Street shops and farmers markets that accept this as a form of payment.
My name is Robert Greenfield. I'm CEO and co-founder of Umoja Labs. Was formerly the head of social impact at Consensus. And we build crypto-enabled payments infrastructure primarily focused on enabling the digitization of humanitarian aid programs with major NGOs, but also increasingly also supporting smallholder farmer financing programs. So we work with the likes of CARE, Oxfam, Save the Children, World Vision, and many others, and have deployed in contexts including Haiti, Venezuela, Tanzania, Ecuador, and Kenya. And increasingly, are starting to focus on how we can integrate responsible, regulated, decentralized finance protocols to originate financing for microfinance, and starting to pull away a little bit more from the humanitarian aid side.
So, Dante, you have been doing grassroots work with Circle. What's the most difficult and challenging aspect of grassroots work in the crypto space?
Well, first of all, it's great to be here. And it's great to be joining a stage with folks that are thinking about it the right way, which is that technology on its own is not a panacea for social ills, especially social ills that have taken centuries to ossify and will remain unchanged unless something from the outside starts to spark that change. But what it does do is it lowers fundamental cost of financial inclusion and access. And that, for me at least, and for a lot of what animates Circle, our vision is to raise global economic prosperity through the frictionless exchange of value. We're not going to achieve that by just making that nice words on a wall, but we will achieve it, and we can achieve it, partly by demonstrating and being completely unapologetic about demonstrating the art of the possible when you could connect all the dots for internet-connected payments and device-centric financial lives. And that's not a technological innovation, but where the technology comes into play is that if to be banked hinged on brick-and-mortar banking, then billions of people would remain unbanked. In the same way that if to have had access to telephony hinged on fixed-line infrastructure, then there would be billions of people who are on the margins of the internet revolution and the democratization of access, information, and knowledge that it has engendered. We're still early yet, but I'm sure both Fenny and our panelists today will be able to articulate what is the art of the possible around financial inclusion. We've seen this in Venezuela with more than 60,000 doctors who use USDC for corruption-resistant instant device-centric payments. And then think about the use cases domestically. In the COVID-19 pandemic, we moved more than $600 billion of taxpayer-funded money. If you have a Social Security number and you're a taxpayer, you paid for it. And we may have lost up to $400 billion due to leaky, antiquated, backward-looking pipes in the traditional banking system. And now I'm not saying crypto can fix it, but I'm saying it would have been really, really nice for the most vulnerable among us to get fast payments that were auditable in real time, and we couldn't do that in the United States of America. So what is the job to be done? Advocate, agitate, not waste any moment on a stage, and then go demonstrate it with real-world projects and real-world deployment at scale is what's keeping us preoccupied.
So speaking of scale, Robbie, do you think that we can scale crypto but still have bespoke crypto solutions for local communities?
Yeah, I absolutely think we can, and I think it's on the basis of, one, in making an interface that individuals who are normal, non-crypto natives can use. I think that's going to be the first, aspect of scale. But then, two, scale is predicated on, how pragmatic, the solution is. And so increasingly, and unfortunately, I don't think there are enough entrepreneurs within this space, we need to see pragmatic protocols, pragmatic decentralized applications that are actually attending to real-world problems rather than predicated on someone trying to generate yield or some type of financial return, which we've seen from the recent crypto winter is getting the entire industry in a lot of trouble, right? You're seeing, collapses of other stable coins, thankfully not USDC, because it's fiat collateralized. And this is actually making it more difficult for, the entire ecosystem to mature. And that's why Umoja, focuses on humanitarian aid, something that's very simple. It suffers from, the issue of transparency. That's something that you can very easily solve with blockchain technology, and you don't need to do it while, mitigating the risk of potentially, creating a security. Same thing with microfinance, right? Loans, it's a very basic thing. It's existed for thousands of years. Sourcing capital from, more wealthy communities and having a lower cost of capital to provide them into, more rural communities is a very simple use case that doesn't need to skirt, any regulatory, considerations. So I definitely think, it's something that can scale. I think the usage and prevalence of stablecoins is central to that, because another issue that I see with a lot of these solutions is that they're not only trying to interface, rather low technical literacy consumers with a new technology altogether, but they're also trying to introduce them to new currencies, be it not stable coins or not their local fiat currency in addition to that. And that just adds to confusion as to, someone's willingness to actually use a lot of those applications. So those are both some of the obstacles that I see in terms of preventing that scale, but also some of the use cases that I think can scale very quickly. And obviously with USDC, you've seen that in a lot of different ways.
Fenny, do you agree?
Yeah, I'd love to also pull a little bit on Dante's comments about financial inclusion. So here in the States, the role of community banks and credit unions are very important to actually ensuring that last mile liquidity goes to local communities. So we have almost 10,000 community banks and credit unions in this country, but they represent a tiny fraction of the deposit market. So the top 4 banks hold almost half of US banking assets. So we have a very, very concentrated banking industry, and does it make sense to have a decentralized technology but heavily concentrated financial and banking industry? The role of these financial community institutions like credit unions and community banks is to provide small business loans, local farm loans, so they play an outsized role in delivering those kinds of loan capital to develop local economies. And so we've been seeing, over the last 20 years, community banks, credit unions are dying by the hundreds every year. So over half of all community banks have disappeared in the last 20 years. It's increasingly difficult to compete with fintechs and big banks that aren't accountable to that local economy, especially if you're a fintech. You're not regulated as a bank. You're not accountable to the Community Reinvestment Act. So to Dante's point about how do we use these tools as a way of lowering that cost of entry for allowing these community banks and credit unions to participate? It's both a potential threat if they don't respond, because we could see more centralization, but it's also an opportunity that allows these local financial capacities to go and fund regional economic development, productive capacities, and ensure that liquidity goes to the folks that need it the most, because those bankers understand, they live and work in those communities, right? They're from those communities. And that's been really part of our experience working with our first project, just the transformation of the attitude of the community banks that in the beginning didn't want to do this, and now they're really excited and they see a pathway. These are risk-averse community banks. They've been around since 1850. So they're not out there to do anything speculative. They have the community interest in mind. Some of them are mutual banks, so they don't even have shareholders, but they're owned by their depositors. And now what they see is here's a tool that allows us to gather safe, sound deposits. We see a pathway to how this technology can allow us to improve our back-end banking rails in the future, that allows us to be more dynamic and offer more competitive products that serve our communities. And that's been really, really exciting to see. But there are challenges on the grassroots. So there's a lot of resistance to crypto. And part of that is, am I there to convert people to a religion? No, right? Many of the folks, these are community members, are very skeptical about crypto. And the messaging here is, this is about community finance, because that is what it's about. And here's just the underlying technology tool. And if we do want to get to that mass market, that's what we have to focus on. It's not about the crypto or the DeFi or blockchain. It's what is the actual thing that we're trying to help people with that speaks to what people want and what they need. And then invisibly, behind the scenes, this is the technology we're using because it does all of these things, lower the cost of entry. You don't have to pay transactions fees, that 3 to 4% every time you swipe your credit card. That helps small businesses, all of that, right? So that's really like our learning, being on the ground, embedded in these communities. And I think more we should be focusing on what is the actual thing we're trying to help communities with, and then here's just a set of tools that best enable that.
If I could, I was just going to add one tiny adjoinder to Fenny's points. So in Chairwoman Waters' hearing once upon a time in 2000, I don't want to date myself, but I've been talking about stablecoins for a while. On the Libra hearing, one of the questions that she asked, I think then Mark Zuckerberg in the hot seat, was where do you bank and where do Facebook's assets go? And I said to myself, if ever I'm in a chance to be in that same hot seat once again, I never want to get asked the question of, why didn't you do the right thing from the outset? And so lo and behold, we launched a program called Circle Impact. The first of the pillars was to allocate a share of USDC reserves to community banks and MDIs. We launched that in October of last year. Today, we've allocated more than $1 billion to that program. following exactly the same model that Fenny's describing, that if you strengthen the balance sheet of banks and community banks, thereby you strengthen their communities. The difficulty, and this is why it matters that we're speaking at a policy conference in Washington, the difficulty is that for these very banks to bank the dollars that back USDC, they're treating it like it's a criminal offense. And so I had to write letters to the Senate saying, I should have a waiting list of banks wanting to partner with us so that all ships rise and it's not just fintechs gobbling up the bank's territory and vice versa. We just simply can't even do that well. And that's a frustration that a program that ought to scale and that ought to leverage the very distributed governance and distributed nature of what the technology thesis is all about is labored. The last quick point is the failure of any one bank erodes confidence in banking. And yet the irony is that every bank in the United States has to keep up with JP Morgan, which has a $12 billion digital transformation budget. And they're at the mercy of 2 or 3 back office and middle office vendors. Wouldn't it be great if non-proprietary open technology, while improving, not perfect, but improving, could be a part of the regulated banking stack? We're literally at war with ourselves on improving outcomes for people, banking, and communities, and the tech is the easy part. That's the irony.
And this is a question for all of you. Do you think that there are policies, a regulatory framework would assist with any of these issues in the inclusion space?
Absolutely, and actually, like to that earlier point, where there's a lot of disjointedness when it comes to, crypto, traditional regulation, and traditional banking, is that there are a lack of policies and recommendations as to how protocols should exist, right? To the earlier point, right, open source technology that can lend itself to creating, decentralized or decentralized tilting systems that are still, very much regulated and still very much responsible can exist. Those two things don't have, that's a false dichotomy, that a decentralized protocol by in and of itself is something that is, illegal, right? Or is something that is only transacting securities. There are a lot of great design patterns that have been introduced by the Aves and compounds and others that can be reused in a regulatory framework and also be used by existing financial institutions. But what doesn't exist right now is okay, which of those design, mechanisms, should be legal, which are ones that we don't want to support, right? Like a lot of the ones. And again, I'm going to be like a complete villain when it comes to yield generation today, because yield generation is messing everything up right now. There are certain design patterns that shouldn't be used, right? Yield generation is one of them. You shouldn't see, algorithmic stablecoins or crypto collateralized stablecoins in their nature exist only to generate yield for their holders, or are rent seeking to put capital in a particular place and just hold that capital there for no pragmatic purpose. But there are also, some aspects of, staking, right, that should be included, right? For example, if you wanted to provide lower cost loans in rural areas for farmers, you can, lower collateralization rates by having people decentrally stake collateral on behalf of that person, right? Therefore, spreading the risk of creditors, right? That's a design pattern that actually can be very helpful to afford vulnerable communities access to financing. But you see this, in the reverse as well. So, to the point, I think that's the biggest gap. And in order for that gap to be bridged, we need to start seeing, both regulatory teams, have more technical individuals that understand these protocols, which I know that's already happening. But vice versa, you also need to see protocol and DApp, decentralized application building teams, have people who are keeping up with the policy so that they can work in lockstep with what is to be expected. And in that way, you're going to have, a great resource of open source, protocols, technologies that can be used by multiple banks, fintechs, whichever, in ways that, are incredibly productive to, helping communities thrive, rather than it be some, versus, mentality.
I was just very briefly, sorry, Fanny. We have to remember, our markets regulators do not have a financial inclusion mandate. Forget the tech. The tech is jargon-ridden, and by virtue of being jargon-ridden, it's designed to perhaps exclude people. But the systems that the tech is competing in and against and with have regulators of record that have not evolved since the 1930s, and who under the guise of consumer protection are doing with enforcement what could otherwise be solved with disclosure. General point number one. General point number two is that if you want access to the things on Wall Street that create wealth, you have to have wealth in the first place. And there's something really, really powerful about the idea of device-centric banking and payments and always-on software-intermediated capital markets that lower the fundamental cost of access. That doesn't mean people should be subjected to internet funny money, but the paternalism that is inherent in the Washington discussion and the regulatory discussion is missing the script. And we're sort of protecting with 1930s post, Great Depression regulatory regimes an unevolved banking system that is desperately in need of regulated rules-based competition. And so that's the issue. It's not the tech. It's that we're stranded in the policy conversation. We're punting, frankly, stuff that should be pretty easy.
And I was going to follow up on...
Thank you.
I was going to follow up on your point about how, the regulatory scrutiny. So our banks are undergoing their annual FDIC exam, and they're simply holding a deposit account. Like it's a checking account for a business that they know because they've been in the community for decades. And we're not talking even millions of dollars here, but the amount of scrutiny about what, these deposits that you're holding, what are you doing, right? And it would be impossible for anyone else to bear with that, just the legal expenses of answering those questions. And I just happen to be a lawyer, right? So I can answer those questions. So I think to that point of where is that sort of proportionate commensurality for how we think about, I'm a lawyer and I absolutely agree that we need to have a sound regulatory framework. I've worked in DeFi. I've seen a lot of shenanigans, right? So, I've seen a lot of shenanigans, and so I do believe that we need to have that kind of prudential regulation, but it needs to be commensurate and risk appropriate, and allow a platform for these other types of smaller banks to be able to experiment safely in those areas without needing to hire very expensive lawyers and so on. So that is a competitive issue around financial inclusion. How do we create those kinds of sandboxes or frameworks that are actually tailored to the amount of risk?
So people always ask, what keeps you up at night, right? But I think I'm going to keep it a little bit more positive and say, what are the success markers for each of your platforms? What would make you sleep like a baby at night?
Yeah. Well, I'm happy to jump in. I mean, look, I think we're making real-world progress. I think the opportunity today, USDC is available in 191 countries. This is a 5-year-old innovation, about $50 billion of digital currencies in circulation. And what we're seeing, candidly, is a Cambrian explosion of responsible innovation on the edges of that. And that's driven by the piece that is, I think, the most critical, which is all of the movement of money, irrespective of its form factor, depends on trust. A lot of the companies in this market are starting to enjoy a little bit of sunlight, but our company was born in it. We've been regulated since the very first instant. We're now starting to see this. The dots are being connected in very powerful ways, which will drive fundamental improvements in financial inclusion, which will drive, in our view, a normalization of the use of these innovations in humanitarian use cases and disaster response use cases. Think about what does it mean to move money after a hurricane strikes Florida or Puerto Rico or any part of the world. The ability to do so in a device-centric manner is just adding optionality to the payment system. It's not substituting the banking and payment system. And I think that is starting to sink in a little bit. And if we keep doing that, one day, 5 years from today, the very conference we're sitting on today won't be about the tech nor the jargon. It'll be about the outcomes. And that's when we know we've succeeded. And I'm starting to see the little green shoots that we're on the way.
And if I may add to that, sorry, Robbie. If I may add to that, so part of it is we have to demonstrate actual policy outcomes through programs. And so one of the programs that we're hoping to launch here in DC on an HBCU campus next year, working with Connected DMV, is can we provide a universal basic income type program, so cash grants to underserved students in the form of a local dollar. So part of that is to say, is it more efficient to do it this way because you'll get a higher money multiplier impact if folks are spending it with local businesses, small businesses, instead of at Amazon and Walmart. So if you look at, for example, the SNAP program, which is the federal food stamp program, even though 80% of SNAP vendors are small businesses, the corner bodegas, 80 cents of every SNAP dollar is spent with a large corporation. Specifically, 53 cents on every dollar is spent with a superstore like Amazon and Walmart. So that's literally tens of billions of dollars a year that are going to large corporations instead of trickling down to the small businesses that are vital to those local economies as well. So can we get a greater bigger bang for the buck if we did stimulus checks, right, to the point about PPP loans, because that was a policy failure. Shouldn't cost $200,000 to save one American job when the average salary is less than $60,000. Something's went wrong there. But if we had these programmatic design in place, and we're using these tools again as efficient ways of ensuring the execution of those programmatic goals, can we have better outcomes, more efficient outcomes, more transparent outcomes around cash policies, or in conjunction with these tools? And that's what I think we need to demonstrate and prove out. And the other thing that I think is important around governance, and it's really about stakeholder capitalism. So I've worked at DAOs, and I've struggled with those things, and finding it's like, these should all be like, some kind of mutual, financial mutuals or cooperatives, right? Can we see stable coins in the future be cooperatives or mutual institutions whereby the ultimate owners are the stablecoin holders, because they're essentially the depositors, right? We need that kind of alignment. And I think what this space has done is kind of open up those possibilities again to think about how do we actually have those kinds of alignments around governance, economic outcomes, and who we're trying to serve, the policies and the people we're trying to serve. And so that gives me hope, and hopefully be able to demonstrate that to show those outcomes, and so to kind of shift that story a bit.
I would say like 3 things that I would love to see, that would be outcomes for success, not just of the ecosystem, but just for the world in the context of financial inclusion. One, just outright acceptance of, certain fiat collateralized stablecoins, as the bedrock for future protocol development in a lot of ecosystems. Obviously, USDC is at the top of that list. And I didn't get paid to say that, right? I just think that they do a very good job in terms of, being at one with regulators and how they operate. And I think that's a huge, foundation for trust for the entire ecosystem. The second is the usage of protocols by traditional financial institutions, right? Everything does not need to be as centralized as it is. And in fact, there is more risk, as it was said earlier, in it being that way. And you have to sandbox the usage of DeFi protocols, in a regulated context, right, to show that these things work. Otherwise, it's just conjecture, right? So to at least test and experiment, I think is very important. And I would say the third is the development of more sandboxes in which you can test things further down the road. Earlier we heard about, predictive markets, other things that are on the fringes, of, regulatory guise, because they're just so apart from what we're traditionally expected and used to that we just don't have any, type of policy opinion on it yet, or one that's close enough to become a law. That also needs to exist. Because on the basis of those 3 things, we actually have a foundation to maintain steady innovation and not fall behind. Because, to be candid, the US is falling behind in that context. And you see other countries taking advantage and really creating, an economic competitive advantage by embracing either the extreme, which is just no regulation at all, which we obviously shouldn't do, or somewhere in between where the cost of compliance is lower so that you can at least test these things out. And that's where a lot of these early startups are making a lot of their traction, right? And then they raise off of that traction, and they continue to grow and can pivot. So I would say that those 3 things are going to be incredibly important.
Thank you. We heard Sheila Warren say earlier that one of her concerns for certain communities was stratification within the crypto system. How do you 3 feel about that possibility, given your different platforms?
I think it already exists within the crypto space today. I mean, if you were to take all of the wallet addresses, I believe in Ethereum is around 4 million or so, right? And of course, let's just assume that every address is mapped to an individual, even though there's probably some people with like 100. And then you look at the total value locked across, multiple blockchains, ends up being about 38,000, and of course, the math changes all the time because TVL changes all the time. Ends up being about $38,000 per address, right? Which clearly tells you that only people with expendable income are actively participating, in, the DeFi space. And it also clearly shows you that a lot of, what we see in lending protocols and other protocols aren't being pragmatically used, right? If you require 80 or 120% collateral to access a loan, you didn't need the loan. You could have just waited another month and saved 20% and bought whatever you needed to buy. And so right now, there's stratification because the goal of a lot of major adopted DeFi protocols is not to serve those who are being stratified, right? Who are on the other end of that extreme. I think the other thing that is, that could push stratification, you see this a lot in the sub-Saharan African context, are the traditional transaction fees associated with being banked or even using mobile money accounts, right? So recently in Tanzania, and they recently got rid of this, but the government added levies to transaction costs to using mobile money, and the entire mobile money market rescinded 12% within a single year, right? So if on the one hand, you have individuals who are barely banked or using things like mobile money who can't access financial services because of transaction fees, and on the other hand, you have a market with a great deal of potential in DeFi and crypto that is solely focused on yield generation or the advancement of those who already have capital, that stratification is naturally going to occur. And this is where I think, again, policy is incredibly important because there are certain things that are happening within the crypto space that should be illegal, just point blank. And I think that guidance, it shouldn't be too strict and heavy-handed, but I do think that that guidance is going to push pragmatic uses of the technology toward the forefront, which are likely going to focus on those who are most financially vulnerable, because that's where the greatest problems exist.
Yeah, and I was just going to say, there's no question that if you took finance and technology, two domains that don't exactly win the scorecard for diversity, equity, and inclusion, and you married them together, that you wouldn't particularly have great outcomes unless you added something really important, agency. Neither a dollar nor a digital currency left to its own devices does anything good for anyone. It's an instrument. And so as a result, what Circle did as a part of Circle Impact, and some of the folks in the room today are the architects of the real work, is we've said, look, we need to accelerate a program around digital financial literacy. We've partnered with HBCUs across the country. We've opened up what was originally an internal learning tool, Circle University, to the planet. We aim to roll that out over the course of the balance of this year and into years to come, because the knowledge base and the technology base, unlike the first generation of the internet, where all the value went to a few postal codes in California, it's open source. And so instead of expecting people to just be beneficiaries of lower cost payments or the pragmatism that is being described, we also have an opportunity to put people in the builder's seat and to have guilds and communities and folks developing on the infrastructure itself. Crypto, ironically, is over-indexed, and some of the champions, Clev Messidor, for example, are in this room, over-indexed in its use and its utility value for minorities who are otherwise literally blocked out of the brick-and-mortar banking system. And so I think companies and organizations with academia at the table have an obligation and, candidly, a generational opportunity to stop doing the same things expecting different outcomes and to make it more inclusive at the design table, this panel included, where you could start really having conversations that are not being had elsewhere. And so I think that's one way we're seeing, we're addressing the sort of inherent stratification of the industries that crypto absorbs. But I think we'll also make measurable outcomes over the long run in terms of what this means for real people.
So if I may add to a little bit different perspective there, sometimes what I'm concerned about is, are we trying to be very technocratic and pushing crypto technocratic ideals on people as a response to the stratification question? For example, how do we get grandma and poor people to use self-custody wallets? And it's like, well, is that really the most important thing, right? It goes back to who are you actually trying to serve? What problems are you actually trying to solve? Listen to that, and how do these, again, my point, how do these tools then effectuate that instead of we gotta go push people in this direction. If you're poor, you gotta get in on crypto if you wanna create generational wealth. I think that's a very, very scary thing for me versus how is it that we can create a better kind of infrastructure for all? And these are, constant battles that I've dealt with, like active, conversations, like, well, is it really what people want, to have as a non-custodial wallet? Is that actually the thing versus they need, access to this or that? So, that's sort of my gripe. And even within the community currency space, which is, kind of adjacent to crypto, there's plenty of stratification there. Berkshire's, it's a very wealthy, predominantly white community, and therefore they have the time and space to think about what is money and what is, community currency, and I want to support local, and supporting local means more expensive things, right? So these are very, very real, not sugarcoating any of it. They're very real and difficult entrenched problems. So, it's hard work to think about all of these things coming together, and it's not just about here's these, technocratic ideals that crypto's gonna solve all these issues. We really have to come back down to thinking about what are the user needs and how can we solve those holistically.
So what do you think are the barriers for the communities themselves? What are the barriers to underserved communities using crypto?
I can start from some of the realities that we see in like Morogoro, Tanzania, or in like Uganda. The first is user experience. User experience is still awful in the crypto space. Again, it's another indicator of who's actually using a lot of these decentralized applications, and that we actually haven't seen that much evolution in user experience in terms of a lot of these applications over the last few years, when we already know that it's pretty terrible. And what I mean specifically is that there are a lot of device constraints to using certain decentralized applications. Most of them, are completely laptop-based and completely computer-based. Some of them are now gradually transitioning to smartphones, but only the latest smartphone operating systems can support them. And in a rural context, right, when you're in Tanzania or Uganda, you don't have that. And people need to understand that when they're looking at these statistics in terms of smartphone penetration in some emerging markets, smartphones have existed for 2 decades. What is a smartphone 2 decades ago to now is not the same phone, right? So you're really limited. You have a lot of device accessibility constraints, right? You're limited to a text-based menu that's either USSD, which is similar to what M-Pesa uses, on a feature phone like a Nokia, or very old Android. And again, a lot of, even the crypto exchange interfaces, have favoritism toward iOS. So that's one. I think the second is technical literacy, right? You cannot introduce, especially to vulnerable communities, ticker symbols of cryptocurrencies. You just can't. It needs to be done in their local currency, right? And there needs to be mitigation plans that if you are presenting someone a value in their local currency, and there is an exchange difference between the underlying currency of that value and their local currency, how are you gonna manage that? Because their balance can't be changing all over the time. And we've seen this actually in Haiti. And we've also seen this in Nigeria as well. And I would say, the third is that, to the earlier theme of this conversation is whatever problem you're solving, you need to educate them on that specific thing. They shouldn't be signing transactions. I don't think that, to Finney's point, like self-custodial wallets is not even a thing in this context. It's not possible. You can't have a self-custodial wallet on a feature phone unless it's a part of the feature phone's hardware itself. And so in that interface, you need to educate that person as to exactly what they're trying to do. And I would add another one is risk. There's systemic risk in a lot of these protocols, and the main reason is because a lot of these protocols are using their own governance tokens as collateral to protect the system. I mean, that's like me trying to, put a down deposit on a house in Robbie tokens, right? That's just not gonna work, right? And so Yeah, I appreciate you. I appreciate the vote of confidence. But, so we need to use hard collateral, oftentimes, fiat collateral to, be the security underneath, a lot of the systems that we're trying to expose people to so that they mitigate as much risk as possible.
Well, I think we are just about at time. Actually, we're 1 minute early. My dad always says if you're early, you're on time. So thank you very much to all the panelists. I think this is a really important conversation that we're having about inclusion. And so now we're going to shift over to enterprise crypto with Allison Vesperl and the CEO of Ripple, Brad Garlinghouse.
All right. Well, we have a limited amount of time here, so I'll go ahead and just get us started. I think we'll start with an update on where Ripple is with its lawsuit with the SEC, that little-known lawsuit. So for anyone who hasn't been following the case, the SEC sued Ripple in 2020 for allegedly raising money by selling its XRP token, which the agency said should have been registered as a security. You recently won access to some documents you were seeking. Both sides have also asked for summary judgment. So maybe give us kind of an update.
State of the state.
The state of the state. Where do things stand, and what's the significance of where we're at?
Well, it's great to be here. It has certainly been a busy couple of years. As you said, the SEC first filed a lawsuit against Ripple and actually myself and Chris Larson in December of 2020. So it's been almost 2 years. And, look, I think at the beginning of this, we actually made the public statement that, this isn't just about Ripple. This is really about the whole industry. And I think at the time, in December 2020, people were like, no, it's not about the whole industry. Today, I think everyone acknowledges how important this is for the U.S. and the U.S. leadership around crypto. This is obviously, I think everyone would agree now, a pretty bellwether case. Where the case stands now is both sides, the SEC and Ripple, have filed motions for summary judgment, which basically means, hey, we don't think we need a trial. This isn't a question about the facts. It's a question about the law. We think the law is very clear, and the judge, those will be fully briefed in front of the judge by mid-November, and then the judge will take as much time as the judge wants to take to make that decision. One thing you commented on that I think is worth spending 1 second on, the judge, so there's some notes associated with for the crypto industry, a very well-known speech that Bill Hinman gave in June of 2018. And in this speech, he said that ETH I'm paraphrasing, but ETH perhaps had been a security, but it transitioned to not be a security because of its decentralization. And that's not actually what the law says. What the law says, there's no mention in the Howey test about decentralization. But that speech was really, really important. And the judge now, over the last 18 months, has ordered the SEC to turn over the notes associated with that speech 6 times. So the recent discovery ruling that went our way is just the 6th time. And the only reason I mention that is because the SEC obviously celebrates disclosure. It celebrates transparency. Why can't we do the work as the SEC and as a federal government to actually define and provide clear rules of the road? And if we had those, I think everyone would actually, the industry in the U.S. could thrive, much more easily than what we're dealing with now.
So, in kind of the order that you were talking about, are you expecting that to help, even in the case of summary judgment, or is this more of something that you're looking to help in the slim chance that the judge denies those motions and this goes to trial?
Well, I think the question we're asking is, what are they trying to hide? What is it in these notes that they have been ordered 6 different times to turn them over to us, and we still don't have them? Each time they've, filed appeals or, new derivations of attorney-client privilege. And, so for me, as much as anything, it's what is in these notes that they are so committed to not sharing with the world? And Look, I think most people who look at this situation, I mean, by the way, I have no idea. I can't wait. I hope we get to see them. We'll find out, I hope. But if you step back and just think about this from the big picture, at the time, XRP, and people forget this, but at the beginning of 2018, before that speech, XRP was the second most valuable digital asset after Bitcoin. And then the SEC kind of anointed ETH, and ETH obviously has benefited from that. And then not too much longer, another year and a half later, the SEC filed a lawsuit against Ripple asserting that XRP is a security. And the nuances and the distinctions between, is something adequately decentralized to make it not a security, which again, isn't what the law says. And again, I'll digress and maybe pontificate for 1 second. I think we all have to remember, the SEC only has the power that Congress gives it by statute. Right? They don't just get to go and take power. Congress gives them that power, and in this case, it's the 1933 Securities Act that says, here you have to have an investment contract. And then eventually there was something called the Howey test, which we can talk about if it's, in the weeds, but interesting maybe.
We want to get into the intricacies of the Howey test.
Georgetown law professors will find it very interesting, and yeah.
That's true. So are you getting any indication of when this lawsuit will be concluded, when you'll get some sort of resolution?
So I do think it'll be fully briefed in front of the judge by mid-November. Federal judges work at their own pace, and I think it's very hard to predict. Maybe optimistically you're talking about a few 3 to 4 months. Pessimistically, you're talking longer than that. I generally have tried to guide when people ask internally at Ripple. I kind of say, look, I think we'll have an answer the first half of next year. Whether that's the first quarter or second quarter, we shall see.
And at this point, would Ripple consider a settlement with the SEC?
It's a good question. I mean, as long as the settlement includes clarity that XRP is not a security, yes, absolutely.
Do you feel like the SEC is?
Well, I mean, in my opinion, the SEC's kind of painted themselves into a corner because they are resolute. They're taking the position, and Gary Gensler has gone out and said that the crypto industry is the Wild West, and virtually all tokens he thinks are securities. So any settlement, why would we settle if you're not saying that XRP is not a security? It's so clear to me in terms of how, and even the amici briefs that have been filed on our behalf in the court, people who have nothing to do with Ripple, who never heard of Ripple, they're participating in the XRP ecosystem as an open source, decentralized software. And so I just think that the settlement opportunity has to start with the idea that XRP is not a security. Beyond that, I think everything's on the table.
Got it.
But if Gary Gensler's of the mind, and the SEC seems to be of the mind that, hey, the vast majority of tokens are securities, that creates a conundrum for how to settle anything.
If, let's talk about the hypotheticals here. So if Ripple loses the case, what's kind of the next step for the company, and maybe what do you think would be next for the industry as a whole? Yeah. And then I guess opposite, if you win, what's kind of the effect of that you're anticipating?
Well, so something that's actually, I think, been kind of misquoted. I've commented on this publicly once or twice, and it's been misquoted. The thing to understand is today, when the SEC sued Ripple, basically every exchange in the United States either halted trading of XRP or delisted XRP. So for all intents and purposes, XRP does not have liquidity in the United States. Ripple as a company, we have grown gangbusters over the last 2 years, but we've signed hundreds of new contracts with financial institutions globally, and very, very few here in the United States, because in the United States, most financial institutions will say, hey, let's wait and see what happens here. So when people ask me, what happens if we lose? I'm already operating as if I lost, right? The XRP doesn't trade in the United States. It can't get worse, right? So, I mean, look, it is kind of funny. It's also what the problem is with having a regulator who, in this case, they're kind of being a bully. And they're kind of, the reason why they're able to get a lot of settlements is because people don't have the financial resources, the commitment to really fight it. And would we be in a better position now had we tried, been more flexible in settling way back when? Maybe, but the whole industry would be in a worse place.
Gotcha. So let's talk about, I mean, I think kind of in the absence of specific regulation, I know the SEC has said that they think the rules are clear and you just have to follow them. You mentioned the Howey test, which I believe was citrus orchards to start with.
Yep.
But in the absence of specific rules, people have been looking to the enforcement cases, what's happening in the courts, statements from Chair Gensler. And he recently talked about the transition of the Ethereum blockchain to proof of stake, which is basically you get rewards if you put some of your assets up to help validate transactions, at least that's my understanding. You've had some choice words about that. I mean, how should the industry take those comments, and what are your specific thoughts on that?
Well, when you first started to say, Gary Gensler's had some recent comments, I thought you were going to talk about Kim Kardashian. I do think this is an important, relevant thing. So again, the SEC would portray to all of us, I think, hey, the rules are clear, but then they won't publicly state, is ETH a security? I mean, Gary Gensler's been asked point blank, is ETH a security? If the rules are clear, answer the question. Like, it shouldn't be that easy. If the rules are clear, so what you're saying is the code, the technology underlying ETH is the determinant as to whether or not something is a security? Wait, and you're telling me the rules are clear? Like, that doesn't make any sense. Let's not look at what the code is doing. Let's understand, I mean, because whether it's a proof of stake or proof of work or consensus, I don't understand. I mean, certainly the Howey test says nothing about that, right? So this is now getting into, I think, the SEC taking power as opposed to doing the work, right? Like, there's a rulemaking process where you do rulemaking, you have public comment, you go back and forth, and you do the hard work to create clear rules, potentially even new legislation. That's not what we're doing in the United States. What we're doing is we're hiring more enforcement lawyers. We're going after, in my opinion, kind of edge cases, and because we went after Kim Kardashian and got a settlement, does that mean ETH Max is a security? I guess it is. It does mean that because the SEC did the settlement with Kim Kardashian. It's the same problem with the former Coinbase employee. That, okay, they're going after a Coinbase employee, but if those were securities, why aren't they going after Coinbase? And so, like, if the rules are clear and the SEC is trying to provide clarity, like, it's mad. I'm pretty familiar with this stuff, and I can't figure it out. So I think that we should all expect, and frankly, we should call upon our elected officials to put pressure on the SEC. Let's make clear rules. The vast majority of people in this room, certainly, and that we all work in crypto, we want to follow the rules of the road, but you got to be clear about what the rules of the road are. And as you pointed out, a Supreme Court case about a citrus grove in Florida from, I think it was 1938. I'm not sure the year, sorry. 1948?
1946.
Yeah, anyway, somebody I'm sure here. Yeah, it was a while ago. Trying to apply that here is tricky. And so let's do the work. Good news is there is legislation that has some momentum. I think Chair Benham this morning from the CFTC had some very, I think, sage thoughts on this point. And I think that the trend line looks positive.
Well, I guess speaking of the CFTC, I know that they recently had an enforcement action that Chair Benham spoke to, the OkiDAO action that also held governance token holders liable as well for the violations. I'm curious, I know some in the industry have been pretty upset about that action, having felt like the CFTC has been kind of an ally for them. I mean, what are your thoughts?
Well, I don't want to confuse being an ally with going after fraud. And look, I don't know the specifics of this particular case. I haven't followed it closely. I think there's no question there have been bad actors doing things they shouldn't do, and whether it's the CFTC or other parts, Department of Justice going after scams and frauds, I think we all should support that and encourage that. What I heard, Chair, I was in the back when Chair Benham was speaking, and what I heard him say is, roughly, if DAOs think they can operate outside of regulatory frameworks, they're going to be sadly mistaken. On one hand, that was a powerful, important statement. On the other hand, I hope that's not a surprise.
Well, and speaking to the enforcement side of things, I think what constantly comes up from the industry side is this idea of regulation by enforcement. But I want to note too this, the president put out a release on all of the reports we've seen out of the March executive order which called for a coordinated approach to digital assets. And in that release, it did kind of sanction sort of the SEC and CFTC. What it said was it wanted them to aggressively pursue investigations and enforcement actions in this space. I mean, what do you make of that?
Well, I think the one interesting thing, my recollection of the executive order was the SEC was never named individually. It was the SEC and CFTC. And so right now the SEC is operating as if they are in charge. And they're gonna protect us from, I'm not sure what, Kim Kardashian. You know, like, I do think, I go back to the executive order, I think is well-intentioned and brings attention to the need for clarity. I think all of us would benefit by continuing to push in whatever way we have available, whether that's through the court process, as Ripple is doing, whether that's through the legislative effort. You know, the Digital Commodity Exchange Act in the House Ag Committee, Ripple has been a big supporter of. I think it provides some of that clarity. I'm not up here trying to pretend that enforcement actions shouldn't be brought. There absolutely have been bad actors. There's no question. I'm not sure that, you know, the irony of the Ripple case in terms of the reality is you have, I think now 75,000 XRP holders who want to sue the SEC. Now, keep in mind, the SEC's mission, one of their statements, is to protect the investor community, to protect, effectively, consumers. So wait, how did they protect that community by filing a lawsuit and driving $15 billion of value out of that ecosystem?
Well, I want to kind of switch gears here a little bit. So, you know, this part of this discussion is about enterprise crypto as well, and Ripple has a lot of institutional clients. Can you talk about, has the sort of lack of regulation in the U.S., has that affected your clients or your interactions with them, or maybe elaborate?
The reality, so Ripple definitely, since this lawsuit started, the last 2 years, we have grown gangbusters. We've signed, you know, I think it publicly said, you know, hundreds of customers outside the United States. Yeah. So it has affected our business domestically, and the U.S. is still the largest economy in the world, and so I clearly care about that. But I also, you know, the problem we're solving is a global, one of the primary things we focus on is this cross-border transactions, payments. And so, you know, most people outside the United States don't really care that the SEC is suing us. I'll tell you a very quick, funny story. I'll keep it short. I was in the Middle East last fall, and we were meeting with customers. I have one of the Ripple team members who's based there. It's really early in the morning. My time zones are all screwed up. We're meeting with the CEO of a payments company, and you know, but the employee from Team Ripple says, well, why don't you give an update on what's going on at Ripple? And I start talking about the SEC. And after the meeting, he very delicately says to me, no one gives a shit. And his point was, if you're not in the United States, you know, the governments in Abu Dhabi, governments in Switzerland, Singapore, UK, Japan, they've provided the clarity how they view and categorize digital assets, and they don't care that the United States SEC has a viewpoint that is, you know, pending in court.
Well, and I mean, you talked about there have been some efforts, at least in the U.S., to try to pass new legislation, though with the end of the year kind of fast approaching in the midterm elections, we'll see how that pans out. But I mean, how much do you think those efforts would move the needle? You talked about the bill to give the CFTC more jurisdiction. We also have a stablecoin draft in the works.
So I think the most important thing in those bills is what are the definitions? Is there definitional clarity? And sometimes I think there's work to be done on some of those points. One of the reasons why we have focused on the Digital Commodity Exchange Act in the House Ag Committee is because we feel like it is clearer. The less clarity, the more we as an industry are going to end up back in, you know, enforcement, regulation through enforcement.
Do you, I mean, what's your sense of something happening this year? And if this gets pushed to next year, where do your confidence levels go?
I am certain there are people in this room far smarter than me to answer that question. I mean, look, I agree with your point. We have midterm elections. What's going to happen? I don't know. I mean, there is some momentum, which is great. And I think there'll probably be some hearings, which brings attention and builds momentum. I think, you know, smart money seems to be the over-under on something passing is, you know, well into 2023. Maybe that changes, but we'll see.
I mean, and how do you see crypto landscape evolving? You mentioned that a lot of your business right now is overseas. We have seen some action, MiCA, kind of the new framework over in the EU, and just curious, like how is the fact that they're maybe a little bit closer on sort of a broad package, how does that affect the industry as a whole?
Well, I mean, I think it affects the industry as a whole, and I have said on stages like this before, if you're an entrepreneur thinking about starting a company in the crypto space, you should go where you have clear rules. And if that means you're going to London because there's clarity in London, then great, go to London. But starting a crypto or blockchain company in the United States where we can't get clarity on what defines a commodity token, a securities token, if these things aren't clear, like if I were you, I wouldn't do that here. As a further example, Ripple will add about 300 employees this year, and our goal has been to make sure that over half of those are not in the United States. So our London office has grown a lot, our Singaporean office has grown a lot. And look, I would rather be hiring people here in the United States and continue to grow our business domestically, but if we can't, because of this lack of clarity, it doesn't really make a lot of sense. One just last quick point on this. It's interesting to me, for those in the room who've been around a while, as I have, in the late 90s, Congress passed laws that made clarity around the internet, as we know it, the internet today. There was clarity around how it would be regulated. And inflows, capital, and entrepreneurs starting all kinds of companies in the internet space. And to this day, the United States has been the beneficiary on a geopolitical basis of the fact that the internet is kind of centered in the United States. I believe that blockchain and crypto will have the same kind of multi-decade effect. And if the US doesn't get this clarity, it will thrive. It'll just thrive outside the United States.
Got it. Are you optimistic about when or if we ever get some sort of kind of broad package? I know we have a proposal from Senators Lummis and Gillibrand that's been out there for a while now.
As I said earlier, I'm not a Washingtonian insider. I don't feel conversant on predicting likelihood of success on some of these things. As I said, I'm a believer that what is pending in the House side and the digital commodity DCEA is something that I'm a big believer in and feel like it would provide a lot of clarity relative to where we are now. It would go a long ways.
We gotcha. Well, we're about almost out of time. I guess any final words of how you think the next couple of months are going to go for Ripple, for the industry?
I guess my final word will be, I think we all should be super appreciative of Chris and the team here for throwing an event like this. I'm serious. Like, having DC focus on this is important. So I think having an organization like what Chris has done here, bringing a group together, bringing a group of leaders to elevate the voice. Maybe the very, very last thing, which if you've seen me speak publicly before, I will say, the biggest thing holding crypto back is the tribalism in this industry. We are all on the same team. We don't have to kill each other to succeed. And I just don't understand why there's so much infighting so often. And I do think events like this help raise everybody, and that's a very positive thing. That's it.
All right, with that, I'm guessing everyone's ready for lunch, so I'll flip it back to Chris.
We can all elevate ourselves to lunch. We have an hour off, and if you guys have seen the agenda between the DOJ and conversations on blockchain forensics and national security, it's going to be amazing. So enjoy yourselves for the hour. Okay, everybody, we're going to start back a little bit early, even though I know we are officially slated for 1:45. As a Georgetown law professor and as someone here who's been doing a lot of work at the Institute, any time in which my boss's 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 boss can be in town, i.e. the president of Georgetown can drop by, it's a good opportunity for us to show off a little bit what we've been able to do, the community that we've been able to build over the last couple of years. And I've asked him to give some remarks since he had the time to stop by. I know people will be coming slowly back from lunch over the next 5 minutes, but at least this gives them a little bit of perspective. Georgetown has been extremely helpful in pulling off this event, to say the very least. We kicked off on Georgetown Law's campus, and it is not an understatement to say that the emails required to pull this off passed through many inboxes, including President DeJoyas. But you're going to give a couple of brief remarks.
Thank you very much, everybody. Thanks very much, Chris. Well, I hope you're all enjoying the beginning of FinTech Week. It's wonderful to have this moment to offer a few words of welcome and greeting on behalf of our community at Georgetown. Chris, we're deeply grateful to you and your team for providing this forum and for ensuring that these conversations are accessible to so many. Each of you are contributing to an important dialogue on the future of FinTech, and this conference represents a cross-sector and interdisciplinary approach that is so important to our understanding of the opportunity and the impact of technology on finance. At Georgetown, we're fostering work related to technology and society across a number of domains, from finance and national security to governance, ethics, and policy. And the institute that Chris leads on international economic law at our law center is at the forefront of regulatory policy relating to international trade, fintech, and blockchain technologies. At our business school, we've recently launched the Passeros Center for Financial Markets and Policy, led by Reena Agarwal, to bring together scholars, practitioners, and policymakers. And their work is complemented by the centers and institutes of our Technology and Society Initiative, 8 different centers focused on a range of work from privacy to governance, digital ethics, and massive data. At the center of our mission as a university is a commitment to the common good. That idea that there is a good that we can achieve together that we could never hope to achieve alone. To understanding and promoting, in this context, how technology can better serve all of us across society. And this forum is an expression of this commitment to the role that each of us can play as scholars, economists, business leaders, technologists, policymakers, regulators, public servants, and global leaders. And for us at Georgetown as educational institutions. And all of us seeking to deepen our understanding of the role of technology in our financial sector and in the future of FinTech. So I wish to thank all of you for joining us for this convening, for sharing your expertise and your perspective. It's an honor for me to offer these words of welcome on behalf of our university. And let me again thank Chris and his team for providing this opportunity, this moment for dialogue. And I hope that you'll enjoy all of the time that you'll have together over the course of this engagement. Thank you very much, and thank you, Chris.
Hoya Saxa. All right. All right, so I guess we are going to then jump right into our proceedings, even 2 minutes early. I'm sort of looking to make sure that everyone for the next panel is available. Okay, they are here. This is going to be an extraordinarily interesting and wonderful panel. It's going to be one covering some of the ideas and issues that were brought up with Russ Binham and our other regulators, and it's going to be addressing the question of interconnectivity and contagion. So why don't my wonderful panelists come to the stage right now, and I'll do a quick introduction, but I'll be moving to the far left here. it is prime time. Anytime in which you have to learn about interconnectivity and contagion, particularly nowadays, you have to have an assembly of the best. And I feel like I have the galactic senate of the top, highest profile people who have been obviously on the front lines of really commenting on some of the latest developments. And just having a combination of folks from Moody's with Fabian Astic, Peter Kirstens, who is maybe the most consecutive participant in DC Fintech Week. This is what, your fifth year? Was a top EU diplomat to the United States on economic matters and is now back in Brussels. Caitlin Long, the founder and chief executive officer of Custodia Bank. And Ryan Selkis, the founder and chief executive officer of Masari. I'm pretty sure everybody knows who all of those individuals are, and so we'll just jump directly into our Q&A. I guess, Fabian, I'm just going to start in and jump in. I mean, you're Moody's, you're the risk guy. Let's jump in with you. I mean, we saw an enormous amount of volatility and risk over the last summer, and especially in crypto markets. I mean, can you give us a sense of the major drivers behind that volatility, at least from your perch?
Sure. Well, first, yes, you're right. The volatility in crypto markets is very, very high. But on top of that, it's very hard to read through that volatility because you don't have much historical data. It's still a very recent a new sector. So it's hard to identify clear trends and patterns, and it's hard to really identify how crypto prices react essentially to other economic factors. So essentially, you have a market that's new, very speculative still, and there's probably going to be a lot to learn going forward. Now, what's interesting is that for the longest time, you would hear, cryptocurrencies like Bitcoin will be a perfect hedge against inflation because, naturally there's a cap on the total number of Bitcoins that can ever be produced, and essentially all those currencies are disconnected from central banks, so that should be nice. When in practice, that's not really what you're seeing. What you're seeing is that pretty much prices have been moving in the same direction as traditional asset prices. So much for the hedge. I think one key aspect of crypto. One more point actually. The cool movement is even magnified. I love to say that crypto assets are kind of like traditional equities with a beta on steroids, because when equity prices go up, crypto prices go even higher, and then when equity prices go down, the other way around, crypto prices go down. So it's kind of a weird environment. It might be just due to the very short history we have. We may see more down the road, but at least that's what you have for now. What's interesting though is kind of the risks that you're seeing are very similar to the risks that you see in traditional finance. So there's that co-movement I mentioned, and there's like events that are specific to the crypto market. Of course, you probably talked about it today, the collapse of the algorithmic stablecoin Terra back in May, and its companion Luna token. So that was very crypto-centric. But what followed after that is kind of the usual succession of events in traditional finance as well, with a bank run, with a liquidity crisis, and ultimately bankruptcies. So kind of the same patterns as we've been observing with crypto hints that are specific here and there, with very little spillover for now into the traditional finance system.
Okay, so you're saying that ultimately it's a replay, or you're seeing some of the same dynamics that you would normally see in TradFi. One of the more interesting remarks earlier was MC Ladder, who had observed that although there was a lot of volatility, she had made the observation that DeFi itself held up relatively well, that ultimately the protocols and other sort of pieces of that financial infrastructure operated well. Ryan, you've talked about this both to me and to the world about these kinds of things. How do you view the performance of DeFi? Has DeFi or did DeFi perform well? And what does well mean? What does working well mean?
Well, you have to look at the performance of the networks themselves and the assets. So you talked about the market beta. Any early stage tech got crushed this past year, ever since the Fed started tightening rates. So whether this is the public markets, the private markets, or the crypto markets, that's kind of true universally. What I do think is interesting is that over most time periods, Bitcoin has proven to be relatively uncorrelated, right? Maybe the last year and a half has been an anomaly. I would argue that it's likely to be uncorrelated moving forward, and it really is a currency versus this kind of like a commodity, kind of like an equity, kind of new token model that represents ownership in these community networks. Those are going to look and feel and act, I think, a little bit more like stocks or like other risk assets, and that's basically what DeFi is. So when you think about the financial performance of the underlying tokens, yes, there's a lot of similarities. Let's talk about the performance of the networks, though, during some of these Q2 crises. The great irony is that this was a centralized services market failure in Q2, by and large. When you think about Three Arrows, when you think about Voyager, when you think about Celsius, these are all due to a lack of transparency of these centralized services. And the greatest irony, if you look at some of the Celsius documents and some of these other really distressed lenders, the first borrowers, the first counterparties they paid back during these cascading liquidations were the DeFi protocols themselves. Why? Because they had to, otherwise they would have been forcibly liquidated as designed by the underlying protocols. So they worked as function. We can have an argument over whether that's a good thing or whether that's a bad thing, but they worked as advertised, as designed. And I think the fact that you didn't see ripple effects into the broader financial services ecosystem or kind of the broader public, if you will. Yes, there are some examples where people got hurt, and obviously we need to regulate around that and make sure that doesn't happen again. This is a lot of house money, though, that got lost. And I think people are losing sight of that. So this experimental industry, this sandbox that has effectively been created over the course of the last couple of years, there was a lot of token wealth in the system that got taken down quite a bit versus real world kind of users that were impacted. And I'm not saying that universally that's true, but I think by and large, a lot of the damages were folks that had already been in the industry for a while and are comfortable taking some of these risks with some of these emerging techs.
So that's interesting. I mean, the acting comptroller, Mike Su, came in pretty pointedly to actually sort of say, well, that's, the sandboxing of the crypto system worked well because it wasn't connected to the larger banking system, which has me bring up Caitlin Long. Number one, I guess, do you feel as well that DeFi operated in a way, in the way that it was supposed to? And what lessons do you take, especially when you think about the questions of how DeFi is regulated, how crypto is regulated, and then the larger financial system?
Well, DeFi is regulated by transparency. And in fact, actually, your observation that DeFi performed better is a function of that transparency. And the fact that we had centralized intermediaries that were not transparent and were clearly running fractional, clearly running a lot more leveraged than anyone thought. I'd been warning about that, but as you know, we've did your podcast together about that very topic. But there's a lot of counterparty risk in especially the unregulated crypto intermediaries, and they were there's just an enormous amount of information asymmetry, and in fact, actually, those were where the real problems occurred. And I would challenge the notion that that was a function of a problem with crypto. It was a function of a problem of traditional finance being applied to crypto. The issues that arose with leverage were just a lot of Wall Street traders, mercenaries coming in and applying the same model that they love to use where they privatize profits and socialize losses on Wall Street and trying to apply that same model to crypto. And guess what? There's no lender of last resort. There's no clearinghouse. There was nobody to bail them out when the time came, and good riddance to all of them. So the markets worked, and DeFi did better because it was transparent. I will say that this relates to Acting Commissioner Su's comments from this morning as well, and it gets to the question of whether crypto truly is risky within the traditional banking system and the connectivity, because there was a major announcement this morning, which is that Bank of New York Mellon, which is, I believe, the largest bank in the United States by assets, has officially now entered Bitcoin custody. And the interesting question that is raised by that is that they are a bank holding company that is regulated by supervised by the Federal Reserve. My company, as you know, has a lawsuit against the Federal Reserve, and I am about to make some news. You will see a filing from my company in that lawsuit pertaining to the announcement this morning, because the Federal Reserve filed filings last week talking about the risk to the financial system from crypto. And then today, a Federal Reserve supervised bank holding company enters crypto. We've been waiting for 2.5 years to do that. And look what the Fed actually said last week versus what it did today.
Well, no one's ever accused DC Fintech Week of having too many shy people not making the news. The natural impulse is to, I haven't asked, Peter any questions, and I will go back to this, because you and I have had conversations. We have had conversations about bank capital requirements, what it means for banking, and what it means as shock absorbers for the larger system, and what DeFi means. But just to sort of complete the queue, Peter, totally different sort of idea here. When you listen to these conversations, number one, you have market participants that are suing the government for basically inconsistency on the basis of inconsistent standards, and trying to sort of move the dialogue increasingly through litigation as opposed to, I guess, a normal standard-setting process. I mean, here you are. Welcome back, by the way, from Brussels. I'm sure this is bringing up all kinds of fond memories. What's your viewpoint? How do you take, number one, maybe an interpretation of the volatility, but also when you're already listening to Caitlin and Ryan sort of think about what the response is, both regulatorily and from the market. What's your first impression?
Well, first, I'm happy to say that the European Commission hasn't been sued yet, and I don't expect this to happen anytime soon, because we are doing our job. We are providing a policy and a regulatory framework which is now agreed, and that sets rules of the road, including on questions like discussed here on the panel. Now, regulation doesn't really cover volatility. We can't regulate for volatility. Many politicians ask us to say, what can you do about volatility in the market? And we say, well, we can't really do much about it, nor is it very desirable to try to regulate volatility. But what we do is provide rules that point out a Finance 101 question, which is, if it sounds too good to be true, it is. And if we've seen some of these failures in recent months, these were clear examples of things that, in retrospect, they were very predictable. But even before that, it was predicted. In the regulatory community, we said, look, these things are going to go down. They are unsustainable. It is just impossible to set up a scheme where there is no value created, but yet it pays out 15, 16, 17% interest. Like, that's just completely unsustainable. Or to create an algorithmic stablecoin, which actually do not exist. They're a contradictio in terminis, to use some Latin. I know law professors love to talk Latin. They're interesting math experiments, but they're not very stable. So to say, well, look, I'm going to issue a stable coin, and it's going to be stabilized by a link to another coin, and then we apply an algorithm, and we buy up and sell out, and that's going to stabilize the value at $1. That can't work. And that's also why, as regulators, in the EU at least, we said, look, it's okay for you to issue an algorithmic coin. It's interesting, but don't call it stable because it's not a stable coin. And we also regulate, of course, firms for the interconnectedness risks, not the volatility, but the interconnections they get. That if you get into deep water, if you get into risky positions, make sure that you have the money to cover yourself if those bets go south. And some of these bets will go south, certainly if you bet on things that sound too good to be true.
So when you, Caitlin, just because to circle back here, I mean, when you when you think about this interconnectivity issue, okay, and you know the question of, on the one hand, Mellon being brought in for crypto asset custody. I mean, what's your theory of interconnectivity? How do you view what the transmission belt of risk looks like in terms of the scene setting for the proper regulatory response?
That is a great question because it ties to both the amount of leverage that's applied as well as the regulatory structure. And we've got a lot of folks here who work in both areas. Digital assets, Trace Mayer used the phrase, Bitcoin is the apex predator of finance. And I love that phrase because what it's getting at is you should never leverage it. The moment you leverage it, the moment somebody ends up issuing an uncovered position, a naked short, an IOU where they don't actually have the collateral to back it up, in hand, ready to be delivered immediately against that liability, then that company is insolvent. And they might be liquid for a while, but they're insolvent, and there is no one who can make more Bitcoin to help bail them out of their position. And so literally, these assets that have finite quantity, it is absolutely dangerous, and it's especially dangerous. I predicted since 2016 that Bitcoin will bankrupt a GSIB. Because the GSIB's positions, and having started 3 businesses inside GSIBs and worked inside GSIBs for 22 years, I'm very familiar with the risk systems of the GSIBs. One of the issues is the way the accounting for secured transactions works, as you know. There's a different dollar of debt against the same asset, and you have no idea how long the collateral chain is, and therefore you don't know if there's really only $1 of debt against the Bitcoin that you provided financing for, or if there's $100 of debt against the very same Bitcoin. And when you end up with a run on the system, 2008 was really a run on the repo market. When you end up with a run on the system, it ultimately will take intermediaries down. And they went down at incredible speed in May and June. That should scare everyone of how fast these intermediaries that looked like they were solvent in the market just were down. Terra Luna went down in the span of 8 hours, okay? So this even should scare folks about how fast these intermediaries can go down in terms of just intraday settlement, because a lot of the banks in the United States only have the capability of updating their books and records once a day. And if they can go down within 8 hours, those two things don't mix. And so then the next piece is, real quickly, the regulatory piece. We talked about this as well. The money transmitters and trust companies, which is what all the US regulators are licensed, or intermediaries are licensed as, money and transmitters and trust companies, they go through the US bankruptcy code when they go down. Banks and broker-dealers have special receivership regimes. We want this industry to be inside banks and broker-dealers for the special receivership regimes, among other things. And as a result, this is something that I've philosophically been committed to for years, and putting my money where my mouth is, and my time where my mouth is, in building a bank that can actually fit within the existing legal and regulatory structure to bring this in a safe and sound manner, non-leveraged, and in my case, in Custodia's case, we applied to become a Fed member bank, totally committed to complying with all the requirements of becoming a federally regulated Fed member bank. But what's fascinating is that the bank regulators and the SEC have just been allergic to this whole concept of having banks or broker-dealers be involved. And unfortunately, from a consumer protection perspective, we've seen a lot of downsides of that, one of which was just in the last few days, that the 29,000 clients of Celsius were doxxed by their own government in the bankruptcy filing. That's now those 29,000 folks in the Celsius bankruptcy have all their crypto holdings because the creditors of a company, they're required to be publicly disclosed in a bankruptcy. If that had been a bank or broker dealer, the consumer privacy would have been protected, and those 29,000 people who are now absolutely targets for hackers and possibly even physical issues for their physical safety. It is just really unfortunate that it worked out that way, and I would come back to say, if we actually had banks and broker-dealers that were supervised, a lot of what happened in the crypto crash would not have happened, and those 29,000 people would have had their privacy protected.
Okay, Ryan, this is a perfect sort of segue to you. I mean, you too are a very shy person, and hold your views very quietly on these things. I mean, and you've offered some pretty pointed critiques, interestingly, of both regulators as well as the industry. When you look at the volatility over the summer, do you have any perspective as to where both industry or government failed? And also, when listening to Caitlin's response and views, are there any lessons that you're drawing, again, from looking at the behavior of either the marketplace or the regulatory community?
Well, as you noted, I'm pretty shy, but
you are totally shy.
I think historically, I've been doing this for a while. I've been calling balls and strikes, both, for a long time. And many of my issues with some regulators, not all, but some regulators, not even full regulators, some individuals that I think are operating in bad faith, has to do with a lack of common sense and like the approach, I think, that matters. I don't think that there are many people, professionals within crypto, that would argue against consumer protections, that would argue against transparency of reserves, that would argue against disclosures of certain insider transactions. I've been working on my company for 4.5 years, and that's what we've done. We've basically built the first principles, Edgar-like database for a lot of these crypto assets. So like Caitlin, put my money and time where my mouth is on this. I think the issue comes down to what battles are being picked, and are the regulators, particularly in the US, going after the good actors because they're coming in and essentially penalizing good behavior and engagements so that they can claim more territory and more turf as part of the jockeying that's going on in DC over who's going to have ultimate oversight of the crypto markets? Or are they actually trying to uphold their missions? The SEC's mission is protect investors, promote fair and efficient markets, and ensure that there's transparency and fairness. They're 0 for 3 when it comes to crypto, right? This current chair is not getting engagement with the industry because he's the hammer that's looking for a nail around every single corner. Now, this is not a universal statement about the SEC staff. There's a lot of folks there that have been working on these problems for a long time. Commissioner Peirce is the obvious notable exception. She's talked about safe harbor provisions and what could kind of bottoms-up disclosures look like and kind of how can we regulate the edges of these networks or regulate in a very common sense way and kind of share territory and share oversight. And I think that's missing from a good chunk of the conversation right now. So, I will pick on the SEC again because I'm shy, but you look back at Terra, Do Kwon got subpoenaed at our conference last year, as you know. They subpoenaed him over a rounding error of an experiment that his company was involved in called Mirror. They didn't talk to him, they didn't touch him or any of his affiliates when it came to Terra and Luna, which was the actual very dangerous asset that was created and was getting integrated in more and more of these services. So I think there is an opportunity, if there is good faith engagement on the part of US regulators, to solve a lot of these structural problems, get to the spirit of, I think, where we want to go, and then the rest is probably going to have to be ironed out through a combination of smart legislation and rulemaking.
So, Fabian, we are ultimately talking about risk, right? Various forms of risk, market risk, operational risk, regulatory risk. What kinds of metrics, and this is a question that I actually asked in an earlier panel, but since you're coming from Moody's, I think you're particularly well suited to also take a swing at. But what kind of metrics do you think are really necessary in this context to gauge things like interconnectivity and the likelihood of contagion? I'm assuming it's not just a story of leverage.
Leverage is important. No, it's not just that, but maybe just to go back to what we all said before, at least for now, there is very little contagion from DeFi to TradFi, traditional finance. And one of the key reasons for that is that the systems are not that connected. Now, we've seen signs, and you mentioned some before, of further integration of both, because TradFi players are thinking, oh, they can get cheaper and more diversified sources of funding, and DeFi players are thinking, oh, I could get broader base of collateral assets that are less volatile and more predictable. So you start to see those connections, those linkages more and more. And then you have assets that are kind of naturally also meant to be bridging the two worlds. So stablecoins being a key one that today is very crypto-centered, but there are many use cases and applications of stablecoins outside of the crypto world. You could see that as a super fast, easy, efficient way, cheap way to send money across the world. And so at that point, it's a bridge towards the real economy. And then to the points that you all made before, you're seeing like traditional structures, existing structures that are more and more exposed to crypto. You have banks, you have exchanges, you have even non-financial corporations, and of course you have hedge funds and VC funds. So you have all those connections that start to pop up. So think about observing what the risks could be, like a bank run on a stable coin, and suddenly that stable coin is backed by tons of real-world assets. The stable coin issuer has to liquidate all of that. That could create instability in financial markets. So keeping an eye on where things are, who owns and holds what is super important. So Caitlin, your point on transparency, I think it's the biggest thing. So ideally, you would be able to see all the holdings everywhere, banks, asset managers in particular, households as well, like individuals. I mean, today you don't have that many people in the US, probably under 1% with crypto holdings, but it's a real indicator that could show the risk of contagion that we should keep an eye on, but there's not much transparency. There's a lot of leverage, because it's super easy to get leverage in the DeFi world, unfortunately, but you don't really have caps on that leverage, you don't really have rules on that, and again, the point is, so you would want to keep an eye on all those indicators, but you can't really see it. The good news, though, is that technically you could, because the technology that powers that whole ecosystem is blockchain or similar technologies. So you have everything at hand. So the key thing that I think a lot of regulators and others are kind of missing is that you have the tools to see it directly from the source. It's not, you don't need to use the old templates and the old ways of doing things. You don't have to transpose the old thinking to the new. Just use what's natively available to you to make it safer and better for everybody, and especially to spot contagion risk before it happens for real.
Well, I love that point, and it's something that, I've written about, I know other people have been thinking about, which is how do you actually make a regulatory system fit for purpose, but also one that could probably serve as an improvement over the existing one. I think that there is a certain question about, at what point from a financial stability perspective is transparency too much of a good thing? There have been times in the past where banking regulators have actually tried to make sure that things weren't too transparent in the fear that could tip over a large systemically important bank. Or maybe it's good prophylactic to avoid systemic risk from building up. But I think that the transparency that people ignore gets you a long way in terms of combating some problems, although it does open up some very interesting questions, particularly if you have centralized entities that are themselves opaque operating on a blockchain, then things, as we saw, can get extremely dicey. Ryan, Celsius event, when's the next one? What do you foresee in the future?
I think on a long enough timeline, all algorithmic stablecoins, including the euro, go to zero. But that's just, you can't create stability around volatile systems for an extended period of time, right? There is a shelf life to these stablecoins, and I'm being a little bit facetious, but ultimately currencies that are stable either gradually degrade in purchasing power or you have these kind of black swan events because there's just a liquidity crisis, and then there's a kind of forced selling, and you break the peg and you never come back. That's, I think, kind of the destiny of most of these algorithmic stablecoins that are leveraged, right? Or trying to reinvent math and solve a problem that can't be solved just because it kind of defies logic. So I think hopefully the next Celsius does not happen, right? And I think what you're hearing, Caitlin and I say, are that there is an opportunity now, I think, to regulate stablecoins and regulate the stablecoin issuers, the good ones, especially in the U.S., right? The Paxos of the world, the Circles and USDCs, they're fully reserved. They've been investing in compliance for half a decade or more in terms of how these types of products could interface with the regulated financial system. And from an innovation standpoint, I think that'd be not only a healthy thing, but a good thing for the country and the US dollar, because it's going to be a technical upgrade that will help us continue to export it as a reserve currency, right? So, and I know that regulators in Europe are thinking along these same lines as well with how they've written some of the MiCA guidance to ensure that it isn't all just like stablecoins denominated in dollars, right? There is like a path to a digital euro stablecoin as well. So I think there's obviously going to be other crises in this market and the general markets. I'm cautiously optimistic that maybe at some point people will learn their lessons, that like you can't break the laws of basic supply and demand and economics. But who knows? People have short memories, so maybe we'll see this all on repeat in a few years at a higher price point. I hope not. And I think that the difference between now and that future state is that we are going to see some common sense regulation in the US, in Europe, whether we like it or not, over the course of the next few years. And I think the net is going to be positive, assuming that we get the definitions and the rules right and doesn't cripple some of the more innovative parts of this economy.
My sense is there are some people who are well at work to thinking of some ways to make sure that happens. Okay, Peter, I guess you're going to be our EU psychologist here for the moment, okay? When again, and maybe you can give us a sense as to when the volatility came to those markets, and almost coinciding in part with some of the more sensitive aspects of the MiCA deliberative process. How do how did our friends across the pond sort of view that volatility, and do you have a sense as to sort of where the Commission is thinking as to what's next in terms of addressing any future possible sources of contagion and risk in the ecosystem?
Well, there were different elements of volatility, but when it came to the volatility or the lack of stability of algorithmic stablecoins, that was very much predicted, and we felt confirmed in our conviction when making our proposal that algorithmic stablecoins shouldn't exist. If you have a stablecoin, you should be fully collateralized. That was confirmed by the facts that algorithmic coins are unstable. But we see some other elements which weren't necessarily considered in MiCA, for example, what happened to Celsius. And what we see there is what I call, and my friends in the crypto community hate me for calling it that, but I call it financial alchemy, where it's interconnected to the risk, but it's a concentration risk, and Caitlin comes to it, that we see a perversion of the very idea of Satoshi Nakamoto, who solved the double spending problem, said, look, you can't double spend, but what you can now do is you can double gear the same collateral. And that is the opposite of what he intended to do. Now, in a DeFi setup where you have to commit the collateral, that's relatively safe because you can't commit the same collateral to two different DeFi protocols. At least that hasn't yet been explained to me whether that can happen. My understanding is that that can't happen. But in centralized entities, they will take collateral, and then someone else will take the same collateral. And I said, look, for as long as the music keeps playing, that's fine. But if the music stops, someone is going to be short of collateral.
Chris, could I just have one thing
Please.
here? So I just want to amend so it doesn't sound like I'm throwing every possible kind of scenario and piece of innovation out with the bathwater. One type of algorithmic stablecoin that I do think is interesting and would be interesting to see ongoing experiments with, maybe in a sandbox or not totally integrated into the financial system, would be around like the original like Keynesian Bancor idea, right? So before the dollar became the reserve, could you create a basket like an SDR or something like that? A basket that preserves purchasing power, and some of these experiments for new baskets of stable value currencies that are stable according to a basket of some type of goods or financial assets, but not necessarily pegged to a dollar or a euro, which is essentially just a synthetic that's ultimately doomed to be subject to a bank run at some point.
Obviously, when you suggest something using words like SDR, our friends over in Washington across the street of the IMF will find that very interesting as an idea. Okay, so we're running out into our last 10 minutes, so I'm going to maybe ask you guys each a series of a question just to get your impression. And Fabian, I'll start with you. I mean, and this question is generic to the group, which is, what do you see as the most promising and viable directions to limiting the risk and contagion in financial markets? If you had your druthers.
Two things, and I may sound like that was not my point, but sure. No, 2 points. I'm going to sound like a broken record, but regulation of stablecoins, super important. You guys in the EU seem to be further ahead, but it looks like stablecoin issuers are ready for that. Like they've been working on it for a long time. So I think that's going to be key because of that bridge effect I mentioned before between the TradFi world and the crypto and the DeFi world. And the second thing is really about thinking innovatively about the way to regulate. I do think that if we apply the old templates to new stuff, it's not going to work well. So use what's out there and think within the blockchain. Be part of it. Be part of the ecosystem to do it better.
Excellent. Peter, next.
Well, hard to say. So one thing is that a lot of people say, well, you have to regulate stable coins, but that is as if stability is an absolute concept that you can regulate, for example, for purchasing power, or for value, but no financial asset is stable over time. It hasn't existed in the past, and it will not exist in the future. You can have relative stability, and that's why when we talk about stable coins, we say they have to be asset reference. They need to have a reserve and say they are stable towards the value of their reserve asset. But if the reserve asset fluctuates, then the coin itself will fluctuate with that, even if that is in currency. Now, I remember a time when the dollar was trading at its current value against the euro. Then it moved to when 1 euro was $1.55. I happened to live in the US at the time, and I was paid in euros, so that was good. And now it's back down. So over time, over this 15-year period, the dollar-euro haven't been particularly stable, yet everyone seems to think that they are pretty stable currencies. So you can link a crypto asset to another asset and call it stable, but that is only a relative concept, and we have to bear that in mind.
Just to follow up on that, only because you did mention, certain fiat-backed assets. I mean, do you feel the same way then, if in the context of CBDCs?
Well, a CBDC is a stable coin by definition, but also central bank money fluctuates in value or in purchasing power, depending on how the economy is performing, how the FX markets are doing. But people always calculate back to a reference asset, be it US dollar, be it euro, be it whatever. I think we still have a long time to go. Actually, I don't think it will ever happen that people will use Bitcoin or Ether as their reference value. So they will not say, is something stable against the Bitcoin? Is something stable against Ethereum? They will say, is it stable against the euro? Is it stable against the dollar? Now, of course, if you peg it to or denominate it in dollar, then by definition, it's going to be stable in dollar.
Caitlin?
One thing we haven't talked about is giving people in the traditional finance world a property right in their assets under custody. Because the way that the securities custody works right now, you might not realize this, but what you own is an IOU. You're a creditor of the bank. And one of the things that Wyoming did for digital asset custody is create a bailment. A bailment is a legal concept very similar to valet parking for your car. It's actually the same law. Valet parking for your car or a coat check. You're not handing legal title to your car to the garage when you park it in the garage. You're just giving them temporary possession of it. And what that means is if the garage goes bankrupt, you're not waiting to go through a bankruptcy process to get your car back because your car was always yours. And we got really far away from that in the securities industry, and I lament that. It used to be when you had, when securities were certificated, you actually had to show, and when I used to be in the insurance industry, when the examiners would come in, they'd count the paper certificates. There was never a question over naked shorting or the length of collateral chains that no one can measure. Those things just were never an issue. And it wasn't until we went to indirect ownership that it went that way. One also last point is, the central banks of the world are going to have to make a decision pretty fast, whether this is coming into the banking systems or not. Because the central banks, what they really do, yeah, they do monetary policy. That gets most of what you read about in the press. But what they really do is regulate the payment systems locally. And thanks to the Lightning Network, you can now clear US dollars that never touch the Federal Reserve. And so right now, that network is getting some pretty big network effects pretty fast. Its growth curve is much faster than stablecoins. Everyone's talking about stablecoins, but the Lightning Network can clear US dollars with zero connectivity to the Fed at all, okay? So we now have a new version of the Eurodollar problem. And the Lightning Network is, like I said, growing faster. There's an estimate that it'll clear about $1 trillion US worth of payments in 2023. And its growth trajectory is faster than the growth trajectory of stablecoins. And what this means is if this is ceded to the technology industry in its entirety, then I think within 5 to 10 years, the Fed will be completely circumvented by the tech industry. And they won't have, right now the Fed has a monopoly on domestic payments. Every single payment, including for the fintechs, ultimately clears through a bank. It's in a notcha file at the bank. And that will no longer be the case. It already is no longer the case with Lightning payments. It's really small right now, but it's growing fast. In aggregate, the crypto industry estimated to withdraw about 600 billion of US dollar deposits from the banking system. That's 3%. The 20 trillion of annualized stablecoin volume that's happening right now represents about 2% of total payments. Okay, so that all happened before this technology scaled. Once this technology scales, and I do believe Lightning is a scaling technology that brings it here, there is now a path for the tech industry to completely, and by the way, legally, because they're operating under state money transmission laws, legally circumvent the Fed. And so it's time, now is the decision time. Take a look if you're interested in more details about this at Custodia's comment letter to the BIS, which we submitted last week and which is on our website.
All right. Ryan, you can take us out of here. Okay, so how do we solve everything?
I'm gonna have a radical ask for this room and for DC in general. A little bit of common sense and humility when it comes to this new tech. And I know that's revolutionary, but I want to give a very specific idea here, and that is the concept of regulating the edges of the networks versus the networks themselves. And this is really where the dividing line and the battleground is going to be if it comes to that when it comes to policy in the US, and I'd imagine to a certain extent in Europe as well. Take the DCCPA. I know Sam's going to be speaking in a minute. The DCCPA that's being floated in DC right now is a very promising bill focused on the centralized exchanges and their oversight, and centralized custodians and their oversight, who has authority. It's a pretty good bill. The dividing line right now is going to be how is DeFi treated? How are decentralized networks treated, and where are the definitions drawn for that legislation? And it can go two very different directions depending on what the definitions are. Under one definition, you're going to solve 95% of the consumer protection problems, the stability problems, finally overseeing these platforms so you can maybe get some common sense guidance on what tax reporting should look like from Coinbase or FTX. Very simple, common sense, move the needle type stuff that could help, I think, the entire country without throwing out this entirely new innovative sector where DeFi, NFTs, some of these other alternative blockchains, other distributed networks, they're less than 2 years old, right? So the conversation that we're having right now, if you want to go back to the 90s, is Bill Gates spent a lot of time down here. Microsoft spent a lot of time down here in the 90s. Would we have been better off as a country, would the world have been better off if Microsoft was the one that was dictating policy? And that was ultimately the only game in town. You had to go to Congress or you had to go to a regulator to get permission to innovate in some of these areas. And what you'll hear is pushback sometimes, which I want to refute, is, well, if you don't have oversight over the DeFi markets or you leave this, that, and the other loophole, it's just going to be a game of regulatory whack-a-mole, and that's why we have to get the definitions right and have full oversight of these systems. The problem is that the regulators today are not playing regulatory whack-a-mole. They're full-on Bill Murray Caddyshack blowing up the golf course. And ultimately, that's going to be the difference between the US leading in finance and tech for the next couple decades or us falling behind.
All right, this was a wonderful, wonderful, wonderful panel. Anytime in which you can end a conversation on systemic risk and interconnectivity with Caddyshack is one where you know that you have really bent the regulatory curve. Okay, we're going to take a 5-minute break, and then we'll hop up with our next session. Okay, 5 minutes. 5 minutes moves very, very quickly in the land of breaks, but we had a technical issue that has now been solved. So we are now going to go. We are now going to resume our conversation. This time, Sam Bankman-Fried is going to be joining us virtually and on screen, but we also have CNBC star reporter for technology, Kate Rooney, who will be joining us again and conducting the interview. So there he is. Hi, Sam. And there she is, Kate Rooney.
Hello.
I've got to figure out how I can see Sam. I think we're going to sit here, and then we've got like 3 angles of Sam here. Good to see you, Sam.
You too. How have you been?
Good, good. It's great to see you virtually. We have a lot to talk about, and I think we've got, 20 minutes, Chris? A little less?
Sorry?
20 minutes-ish? Okay.
20 minutes.
So keep me honest on my shot clock. Just wave at me if I'm going over. All right, well, you all know Sam Bankman-Fried, FTX CEO and founder. And okay, so Sam, the name of this panel, Liquidity in Distressed Markets. You know a thing or two about that, I would say, after this year. Are you still confident right now playing this role of lender of last resort based on what's happened with prices? Is there still more to go? And are you scaling back at all, looking at your own portfolio and just digital assets and valuations?
Yeah, I can't confidently say that there's nothing more to come, and I'm sure that there's going to be something more to come. I'm sure that there's, something we haven't seen yet, but there isn't a whole lot out there that we're aware of. There aren't big things out there, remaining that we're aware of, and obviously things may change if we see, a further large crash in, markets. If we see, NASDAQ down another 40%, then all bets are off. But around these levels, around $20,000 Bitcoin, there's just frankly not as much going on in the rescue market, so to speak, right now. So, we're going to continue following through on the threads that we have been active on. There's 1 or 2 bankruptcies that are getting started that we may or may not end up playing a role in. But I think that we've probably made most of the moves that we're anticipating making, for now.
And some lessons on what happened in the spring. Anything on the regulatory side? You've spent a lot of time with lawmakers in DC. Any big lessons that Washington can learn from what happened? And did they make any mistakes in terms of not intervening and protecting consumers in a better way?
I mean, obviously there are cases where regulators ideally would have protected consumers there. And I think that, you look at some of these cases, and at the very least, there should have been more transparency. Like, putting aside for a second in question of whether, there were sort of, legal violations with the practice itself, there probably should have been transparency to users of some of these platforms, how large 3 Arrows was on them. And so as a start, that would have helped, and it would have given people a better sense of, realistically speaking, what the risk was for using these. And, why didn't that happen? I don't think that it's because, regulators got together, sat down, and said, this all seems fine. There are no problems here, no risks really, not worth thinking more about it. Like, that's definitely not what happened, right? What happened was, in fact, some of the platforms that ultimately customers lost funds from were platforms that, in fact, regulators had already been looking into to some extent, right? That there had been active investigations into. I think the problem was just one of timing. As we're sort of working towards getting regulatory frameworks in place for these, some of them blew up, and some of them blew up before regulatory frameworks could have helped in the first place. And so that, at the end of the day, I think is like probably my biggest takeaway from the regulatory side, is, there's a price of inaction. And I don't want to say this is necessarily inaction on the part of regulators, because they were working hard to get there. I think that there is sort of like a collective delay in us getting to a point where there were regulatory frameworks, but everyone, including our industry, has some role to play in blame for not being more productive and constructive on regulatory matters earlier.
Was that a setback, those events, and looking at what happened in the spring, based on your conversations in DC, did that hurt any of the momentum that you've seen and maybe make some lawmakers a little bit more cautious when it comes to approaching this industry?
So I think that because the sort of name of the game going into this was getting regulation, getting oversight, it actually, if anything, sort of, as you said, like further emphasized the case for having regulatory oversight. This isn't a case where, we've been trying to argue for less regulation and that absolutely would have been undermined by what happened. This is a case where, we've been arguing that there should be more oversight, should be more customer protection in place. And I think that this was, everything that happened was, if anything, a reminder of that and sort of further underscored that. And I think that there's an appreciation for that in DC, that this is, very consistent with, a need for more oversight for digital assets.
The word contagion has been thrown around a lot. FSOC came out with a report last week talking about potential risk for contagion and saying if the industry continues to grow without regulation or more oversight, that is a risk. Do you see any pockets of potential contagion? And as companies like FTX get into US equities, for example, and what looks like more traditional finance, is that a growing risk if we see more overlap with Wall Street?
I think that the real answer, which I think threads that, is that there should be more oversight and there should be more integration with regulatory oversight. And I think that's a responsible way to have integration. And I think that there's a lot that blockchain, has potentially to offer. I think that can help clean up equity settlement, for instance, and a number of other things. But I think it has to do it with regulatory oversight. It has to do it working constructively with policymakers. And, I think those two are going to come hand in hand.
And some updates since we last spoke, at least. The Voyager deal has officially happened, despite some delays there, and this really ended up going through an auction process. Was that the outcome you expected, and what are your plans when it comes to Voyager?
I think that, it wasn't, totally shocking. I think that, certainly there's some room in bankruptcy law for faster proceedings. But at the end of the day, this got there, and it got there on a reasonable time frame. And, I think that, we're pretty comfortable with where that ended. Hopefully we will, very shortly be able to start returning, the assets that remain to the users of the platform. Ultimately, I think, we're happy that we were able to play that role here.
Any other names you'd be looking at? Celsius is another one that's going through bankruptcy proceedings.
That's a good question. I actually haven't, done a deep dive into that recently. I can say on priors, we'll almost certainly take a look at cases like that. We'll almost certainly, want to at least be, aware of what's going on. And, I don't know whether that ultimately ends up meaning that we will, do something there or not. With all of these cases, the way that we approach it from a high level is, basically let's look at what, let's try and get a sense of what it would take to sort of solidify the business of, what the options we have are. Is there something that, is, sort of efficient in terms of the amount that we can sort of clean up parts of the industry, relative to the amount of balance sheet that, we would end up spending on it.
So people have called you the lender of last resort. There's been a lot of analogies to the great financial crisis. Should there be, going forward, some sort of crypto TARP and another lender of last resort, or some sort of backup option other than the private sector? Because FTX really has been one of the only private companies to step in here.
Ideally, yes. And people sometimes say, does it make sense for FTX to be such a large fraction of this? And I think my answer is no. I'd sort of much rather that it was more distributed, but that's not necessarily an option that we have. We sort of have to take what we're given here, so to speak. And so, really, what I think might make sense would be some sort of situation where, you had a consortium of people in the industry getting together to backstop in cases like this. And, maybe there is some fund, maybe, each of the exchanges kicked in some of the VCs kicked in some, there's a team built out. I'm sort of spitballing here, but I think a system like that would make a lot of sense. And that could act as, at least as an option, for a lender of last resort in the industry. I think it'd be healthy, and I'd be excited to see something like that built out.
Where are all your competitors? Why haven't we seen more private or public companies jump in as a backstop here?
Yeah, I mean, we've seen a few start to get involved, but fundamentally, it's a little bit of a messy thing to get involved in. Like, if you think about what has to go into it, like, these are cases where, if you're going into this with mindset of like, I want to do good deals, like deals that really look good, that I feel good about, and also the company's bankrupt, like, I don't know, are you gonna feel like great about that? Like, there's always gonna be hair on these, right? That's the name of the game. And you have to act really quickly. Like, in some of these, the biggest thing that we did wasn't necessarily even like an ultimate, amount of capital that we like spent on them. Like, in some of these, the biggest thing that we did really was to be able to, like, extremely quickly, with like no notice, give a substantial line of credit should it be necessary. And that has to be part of a holistic solution here as well. And really, solutions here end up involving a bunch of different things. And that's part of the mess of all of this. And there just aren't that many companies that are in a position where they can sort of nimbly navigate that mess.
I want to talk about regulatory arbitrage for a second. That's also something that the Treasury Department talked about in that FSOC report. You operate in dozens of different countries. Is that something you see as a potential risk to crypto, the gaps between all of the different global regulators and some of the agencies in the US? What's your take on regulatory arbitrage and what it means for the industry?
It's a good question. And, I think it's something we're really paying attention to and a little concerned about, frankly, is, as you said, look, there are a lot of countries in the world, right? There's like 200 of them. And there's no global regulatory framework, or some countries have a regulatory framework that they are comfortable being extended globally. But that doesn't mean that that doesn't mean that it can be extended globally in a that all other jurisdictions will kind of recognize that. And what you end up with then, which is messy, is a world where each country has a different level of protection. Some have very little. There's definitely more risk in some. And I think even more than that, like, one of the biggest problems is that, we're in a messy in-between period where, you have companies that are sort of doing very different levels of compliance with respect to regulatory jurisdictions globally. There isn't consistency there. And there isn't a level playing field. There isn't always protection. Some countries are good at enforcing that, others less so. And it just creates bad incentives for people in the industry as well. If if the result of getting regulated is having a product that sells less well, and like other people are not doing that. And so I do think that getting a kind of coherent global framework would be awesome. I also am not naive enough to think that that's coming tomorrow. And so maybe what I would say really at the end of the day is that, I think we're in a position where what I would love to see would be, some sort of set of frameworks that are passportable, set of frameworks where, if you have sort of, oversight in A, B, C, or D, then, then you can passport it into, basically the whole world. But that you have to have one of those, that you're not allowed to service, people without having oversight in one of these, real jurisdictions that has some real amount of oversight. That's what I would ultimately want to see. And I think that that would create a framework where you wouldn't have to separately get licensed in 200 jurisdictions, but you still ensure that these were responsible overseen actors that were participating in all the jurisdictions. In the meantime, I don't know, I guess we're getting registered in 200 countries. That's the path we're going down.
And we'll wrap up in a second, Sam. But you and FTX, and personally, you're based in the Bahamas. The company is there as well, or part of the company. Anything that could happen in the U.S. on the regulatory side that would convince you to move all of your operations here? Any chance that FTX will become more of a US-centric company based on regulatory clarity?
Absolutely, there are things that could make us more of one. Now, when you talk about being entirely one, different countries have different requirements, and some of them have requirements that we have operations in those countries. And so, we're not going to be shutting down our Japanese operations, no matter what happens, because we are regulated in Japan separately. But there are absolutely things that could, move us. We do have a U.S. operation right now. We have U.S. office. We have the Miami headquarters, but there absolutely are things that could move us from being, say, being 1/4 to 3/4, of our sort of like personnel and resources in the U.S. And the big thing there is markets regulation, right? Like we operate in exchange. That is at its core what we operate. And like it would be appropriate for us to end up seeking and hopefully getting regulation on the front. And we are applying for that with the we're working with the CFTC, working with the SEC, working with policymakers. And I think if we were able to get that, I think we'd be in a position where we would feel much more confident charging forward, as a US-based company.
Sam, we'll leave it there. We could talk about this for hours, but that's a great place to leave it. There's a lot of, I think, potential regulators and lobbyists in the room, so I'm sure they're listening closely. Sam, it's great to see you from afar, but
you as well.
Great conversation. We'll hand it back to Chris. All right, thank you guys.
Okay, you can come on. We're going to continue this conversation very, very briefly because as a professor, I like to ask some of the real experts, like Suzanne, really about the question about what happens when, to the companies Sam can't bail out. I think it's a very, very challenging question, in part because it also pushes on the contours of crypto law and bankruptcy law. So Suzanne Ulin from Latham & Watkins has agreed to just do a quick sidebar of sorts to kind of dig into a couple of the legal issues because they're currently under litigation and people are a little bit worried and as are investors. But Suzanne, thanks for dropping on after listening to Sam's conversation. I guess they mentioned Voyager. We'll just start off with some of the current questions. I mean, how are you seeing the Voyager customers? How are they faring effectively after FTX and Sam bailed them out?
Well, Sam told us that he was hoping that the Voyager customers would start getting their crypto back in their accounts soon, and he was looking forward to that. But unfortunately, he's been thwarted by the bankruptcy system and the legal framework that affects customers who are really just creditors of these networks and these platforms. And so what's actually going to happen is all the money that he's putting in he is basically purchasing the crypto assets of Voyager. They're going to get cash, and they're going to distribute cash to the creditors based on the amount and the value of the crypto in their wallets on the filing date, regardless of whether the crypto appreciated or not. So it's kind of a bad rap for the Voyager customers, notwithstanding best efforts of FTX.
All right, well, let's sort of step back then, just for those of us who are lawyers and have intentionally decided to forget everything about bankruptcy law, or for those who haven't quite learned it. Maybe you can just walk us through exactly what happens where a crypto company runs into financial difficulties and is not, in effect, bailed out.
So crypto companies have a lot in common with traditional finance companies, and what usually pushes these types of companies over is not what we call balance sheet insolvency. It's not looking at their assets and their liabilities and weighing them. It's a liquidity crisis. For finance companies, it's the run on the bank. It's just running out of cash and not having any time to manage that situation. That's what pushes these companies in, and that's what has pushed these companies in that we've seen in the late spring and summer. So it's this liquidity issue, and then once they go in, there's this huge question of who owns what. That's what makes the crypto That's what makes these cases different, is they're very difficult to reorganize when you're in the middle of a liquidity crisis, because potential lenders who might bail you out before you file don't know if Voyager owns the collateral or their customers own the collateral. And so they're not going to make a loan and try to bail out that company given that legal uncertainty.
Well, that's a curveball. That'll keep you from getting involved. Well, when you look even further back, then, I mean, how does that relate to the other trickiest issues? I mean, what do you view then ultimately as the trickiest issues concerning a crypto bankruptcy and trying to work through the issues of crypto bankruptcy?
Well, it really gets into this ownership issue, and I learned a new word this morning, skeuomorphism. All right. And so we have the situation of customers and their expectations. And so part of the problem is that these customers, the websites had the look and the feel of a financial services or a bank website. And so there was this feeling of, people were interacting with the bank. That's one half of the problem. The other half of the problem is people don't understand how banks work. People don't understand that depositors are creditors of banks. The vault in the bank doesn't have your cash in it, right? You just loan money to a bank. The bank then loans that money to other people. So the inherent situation of being a depositor is being a creditor. If you want the bank to be a custodian, you go get a safety deposit box. And you set it up as a safety deposit box, and you put your assets in there, and then you know that the bank isn't taking your grandmother's jewelry and lending it out for some, prom event or something. So it's really understanding if you are a custodial relationship, i.e. a safe deposit box, or whether you're just a bank depositor, i.e. lending your assets to another company so that company can go earn based on what they can do with those, making other loans, other investments.
Yeah, the skeuomorphism issue that acting comptroller Sue educated us all about, that is an interesting one. And actually, the irony is it even pushes back to my original question for him, which is how new is skeuomorphism in finance more generally? And you're pointing out the fact that, yes, you simplify things in ways that people may not understand in crypto, but ultimately our basic financial system is one where it's either been simplified to the extent to which people don't really understand everything that happens. They don't know when they're creditors. They don't know when they're customers. Or, there are challenges, just in terms of financial literacy, in terms of understanding, how our basic financial system works.
Well, and so that the answer in the financial system, and I always point people to YouTube, the Run on the Bank scene from It's a Wonderful Life, and Jimmy Stewart gives this great explanation of the way banks work. But it's regulation and it's insurance, right? That's how we protect people, regulation and insurance and all sorts of consumer protections. And those are absolutely absent in the crypto markets right now.
So ultimately then, are workouts even possible in bankruptcy for crypto firms?
So I think they could be possible in two ways. One, if we get the regulation, I think this sort of workout you would see is the sort of workout we saw financial institutions in the Great Recessions. It's really the regulators coming in and doing forced marriages of the strong and the weak. That's, you think of the Merrill Lynch, the Bear Stearns, those I think would be the possible workouts.
But who's going to do that? Usually the entity that does that would be, say, the FDIC or something.
Right. Absent a regulation, I think it's just too much uncertainty on the legal ownership rights and as I said, who owns what.
So are you expecting any more bankruptcies in the next year?
I am not expecting bankruptcies in the next year. Don't bet on this. But,
I'm sure someone is.
But what we saw right before these bankruptcies was we not only saw the Terra event and we saw the weakness of the dollar, we saw leverage hit an all-time high. And it really exploded in 2021 and into 2022. And the leverage in the crypto markets was exploding. And that is what causes your bear market to amplify. That is not what we're seeing now. And I would assume that we're sort of near the end of this current crypto winter.
Well, this is extremely helpful. Thank you very much, Counselor, for the sidebar. We'll take a quick break and then hop into our last decisive group of conversations that will, if you just look at the agenda, you'll know that there will be fireworks. So, okay, great. Thank you.
All right, thanks.
Quick break. Okay. We are now ready to welcome our next guest. And you can go, please try to take your seats as we roll into a series of really great conversations and as we move into the afternoon. Thank you. As many of you know, Congress is not in session right now, but yet we are delighted that nonetheless we're going to have a chance for a quick debrief with Chairman Maxine Waters from the House Financial Services Committee. She'll be joining us virtually. Chair Waters, it's so great to see you.
Thank you. Delighted to be with you.
Oh, this is wonderful, wonderful. I'll take a seat, or I'll just take it. I'm going to take my seat here, and again, thank you so much for joining us for FinTech Week. You've been with us before in the past, and both personally and on behalf of Georgetown, you know, you've just been a wonderful supporter, and thanks again so much for joining us. I guess
I'm delighted to be with you.
Great. So, you know, you have been fairly steeped in the crypto conversation, right? From stable coins to larger questions of consumer protection, to financial inclusion, something that we've talked a lot about today. You know, what's been your impression of those conversations from your chair? And really, when you think about those conversations, how do they compare to, you know, the other kinds of financial and regulatory conversations that you've had in other issues?
Well, good afternoon. And before I dive into this discussion, I want to thank you, Professor Attorney Chris Brimmer, for all of the support you have given to me and my committee, the way you have testified in Congress, at least on 2 occasions, the advice that you're giving them on all kinds of not only financial services matters, but certainly on cryptocurrency. And so I'm delighted to be with you. Thank you for inviting me back to speak at DC Fintech Week. Your passion for policy issues concerning technology, finance, and equity is so very important.
Thank you.
So, yes, my committee has led the way in conducting deep dives on digital asset products and services so that I and my colleagues in Congress can learn more about how this space is changing and to understand the impact on the broader payment system, as well as the risk and opportunities for consumers. Now, as you know, this subject is a priority for many of our members. People's views about cryptocurrency run the entire spectrum, with some believing it is the future of finance, while others believe it should be banned entirely. So as you know, as chairwoman of the House Financial Services Committee, I established the first ever task force on financial technology, as well as the first ever task force on artificial intelligence. Over the past few years, under my leadership, we've held many hearings to discuss how these new products are being used in our financial system and understand who stands to benefit and who stands to be harmed. So over the course of this Congress, my committee has convened roughly a dozen hearings on the emergence of digital assets, including stable coins and central bank groups. Democratic Committee. This group is leading regulators and to explore opportunities to develop and shape power in this area. We have already built consensus. It's 3 areas. The need for congressional action to regulate the industry, the need for robust consumer and investor protection, and the need to stay laser focused on financial inclusion. Our work is ongoing. And of course, we will continue to have bipartisan conversations on how to proceed on the best path forward.
You know, the issue of financial inclusion is obviously one that I've shared. I know you are so passionate about, and it's one that we've heard about earlier this morning from Acting Comptroller Sue as well, and something that he's emphasized. But when you talk about specific issues like, say, stablecoins, is there anything that you found to be especially important? You've mentioned a couple of larger themes, but is there something important or even something that you found to be particularly interesting when you think about how the government should best approach or regulate crypto, or for that matter, new technologies at all? Is there anything that comes to mind?
Well, as I've worked on stablecoins legislation, the digital wallets that hold them, and central bank digital currencies, I've found it is important to consider at every step of the way how these products will be used by everyday consumers and investors, especially those who are often excluded from the traditional financial system, including people of color. So if the use of digital assets is going to grow, we must evaluate how to best protect ourselves with robust cybersecurity, strong privacy protections, and safeguards to catch bad actors who may use these products to evade sanctions like illicit transactions and harm consumers and investors. So I'm deeply committed to ensuring our financial system facilitates responsible innovation. It can also play a part in achieving financial equity. The United States must remain the global leader on finance, technology, and payments. So we must create a framework that promotes courageous and creative strides in our sector that generate greater financial inclusion. So I agree with all of you that this is an exciting time for innovation, but it bears repeating again and again that we must continue to ask ourselves some important questions at every step of the way. Questions such as, are we putting the interests of the American public first and foremost, especially those communities that have been historically marginalized, those communities who have faced discrimination when trying to access financial services and build wealth? Are we promoting responsible innovation? Are we ensuring that companies operate with transparency and remain accountable to the people and doesn't exploit consumers and investors, and that it doesn't create unnecessary volatility and deepen the racial wealth gap? So that's what I think about stablecoins and the work that we're doing.
Well, I guess I'll ask one last question, because you really did emphasize questions relating to the racial wealth gap, and you like I've tried to emulate you in trying to think about diversity amongst our financial regulators, diversity in industry, and really diversity wherever decision making should be made in order for institutions to be better, for institutions to be stronger. When you're looking again like at stable coins or crypto, conversations that for the most part seem like some pretty technical and highly legal questions, why do you care as a policymaker about whether or not crypto or financial services are diverse? What does that mean for the policy conversation?
Well, financial inclusion has long been my top priority. Under my leadership, I created the first ever subcommittee on diversity and inclusion, as I'm a firm believer that diversity and inclusion should be at the center of everything that we do. I'm encouraged to see a focus on diversity and inclusion from many fintech companies, but we can't stop there. All financial companies and their leaders must walk the walk and show us that they are diversifying their leadership teams and workforce from the boardroom down to the staff level. This diversity must not only include race and gender, but also diversity as it relates to disability status and sexual orientation. Beyond internal efforts, diversity must also include creating a system that is going to help consumers who have been historically shut out of the financial services industry and ensuring they have access to genuine wealth building opportunities. That's a passion of mine.
A passion of mine as well. Thank you so much, Chair Waters, for joining us. We really, really appreciate it.
Well, you're certainly welcome. Thank you.
All right, thank you. All right, well, we're going to keep them rolling with some of the best. And making a real shift, a real pivot. I know that this community is more than willing and able to do so. And we'll be talking about crypto and illicit finance and how to make sure that our markets are as robust as possible. So we're going to start off first with Esteban Castaño, the co-founder and chief executive officer of TRM Labs, to play professor of sorts and to walk us through a little bit about illicit finance and blockchain forensics. All right, man.
Hi, everybody. Can you hear me? Yep. My name is Esteban Castaño. I'm the co-founder and CEO of TRM Labs. TRM is the fastest growing blockchain intelligence company. We build tools, software, and deliver training to help law enforcement, financial institutions, crypto businesses, regulators all around the world better fight financial crime in crypto. Today, there's one message that I want to share with you. And that is that crypto is actually a tool for fighting financial crime. And we see a lot of headlines about crypto, whether that's ransomware or hacks, and there might be this perception that it's, helps foster illicit activity. It's actually a tool to fight illicit activity. So I'd like to introduce you to 4 of our friends, Todd, Rachel, Maria, and Lisa. Todd is a compliance analyst at a cryptocurrency exchange. Rachel, a special agent at a law enforcement agency. Maria is an AML investigator at a regulatory agency. And we have Lisa, who's an investor in digital assets. Why is it the case that for these people, on the front lines, they view crypto as a tool for fighting financial crime? Why is there this gap, between, I would say the on-the-ground reality versus the public perception? So let's dive in. When we talk about illicit finance, what are we talking about? Number one, we're talking about illicit commerce. So this is people using crypto to buy illegal things. That's stolen credit card data, stolen personal information, hacking services, illegal narcotics, CSAM. We're talking about payments that are illicit in and of themselves. So, financing terrorism or violent extremism. People might use crypto as a means of payment when they conduct a ransomware attack. We're seeing, kidnappings where the payments requested in cryptocurrency. And then, of course, there's investment fraud. So people, creating investment schemes on Instagram or other platforms and soliciting payment in crypto. We also see money laundering, people using crypto to launder proceeds of both, fiat currency crime as well as crypto proceeds of crime. We're also seeing the emergence of crypto native crime. So raise your hand if you've heard of a rug pull. Okay, keep your hand up if you've lost money in a rug pull. Just kidding. So rug pulls and DeFi exploits and drainware, which is smart contracts that are designed to steal money out of other wallets. These are all new forms of crime that are taking place on blockchains. So that's what we mean by illicit finance. Now, the question that policymakers and the public have with regards to illicit finance is how do we manage the risks? One technology that is being used to manage illicit finance risk is blockchain intelligence. Blockchain intelligence is enriched data about blockchain activity that's designed to help people fight fraud and financial crime. And when you're using blockchain intelligence, there's 2 things that it can help you do. The first is to prevent proceeds of crime from entering the financial system. And the second is it enables you to follow the money and actually fight crime. Those are the 2 objectives, and those are broadly, not even blockchain intelligence, but that's broadly the objectives of our AML anti-money laundering system. So what is blockchain intelligence? You first start with public blockchain data. I think at this point, we all know the blockchains are public databases. They're transparent, at least as they're designed today. And what that enables you to do is view transactions. So if we pull out one transaction, this is what it looks like. transactions and the flow of value on the blockchain is represented with these identifiers that are random blurbs of letters and numbers that represent wallet addresses, sending money to another wallet address, and then there's an identifier for the transaction itself. If you look at this, you can't really get a lot of context. If you're trying to fight financial crime, you don't really know what is this? Is this a normal retail transaction? Is this associated with terrorist financing? What am I looking at? What blockchain intelligence does is it layers on additional data that links on-chain transactions to real-world use cases or services. So what this enables you to do is to say, here's this address. Instead of using this identifier 15K9Z, we now know that it's associated with a terrorist financing group, and exchanges and other crypto businesses can use that data to detect if they've got a deposit coming in from a high-risk entity. A helpful metaphor is like a map. You've got satellite imagery as your base layer, then you layer on the labels, and now you know where you want to go and who you want to interact with. That's basically what blockchain intelligence is doing for the blockchain. So let's talk about Todd. Todd works at this crypto exchange. He's got 3 deposits that just came in, and Todd is scratching his head saying, well, how do I know if these are associated with money laundering or fraud? When you layer on blockchain intelligence, that first deposit, you now know it's an exchange. And so Todd might approve that transaction. And I don't know why the icons aren't showing up, but that's a check box. He might look at the second transaction, which is if you trace it on the blockchain, he's able to detect automatically this is coming from a payment processor and approves that transaction. Or that third transaction, he might detect, okay, this is actually proceeds from a ransomware attack. We're going to block that transaction. So blockchain intelligence in this instance is being used to block the proceeds of financial crime. Rachel, as a special agent, imagine that there's a hack, and you're looking at a wallet on the blockchain. You see a bunch of stolen funds. What Rachel can do is trace, as the hacker moves the funds to a lot of different wallets and starts to send it throughout to different wallets, Rachel can trace the flow of funds and identify the cash out points. And that will ultimately help Rachel identify the attacker or seize the funds. And this is exactly what law enforcement and others are using to investigate crime that is happening on blockchains. Whether that's investigating an NFT rug pull, whether that's investigating fundraising for Russian military or North Korea cyber groups that are hacking crypto exchanges or large-scale hacking campaigns, you can follow the money on the blockchain to fight financial crime. Maria, she's an AML investigator at a regulatory agency. She's really interested in big picture questions like, are there any exchanges that are disproportionately laundering proceeds of ransomware attacks? And as we saw with Garantex, Suex, and Chatex, 3 Russia-based exchanges that were recently sanctioned by the Treasury Department in the US, this is very much possible to query the blockchain and derive these insights. Things like, hey, what are the top investment platforms that have Ponzi-like characteristics that are targeting consumers? You can query the blockchain and surface this information with blockchain intelligence. Or, for instance, hacks. This year, our data shows that over $3 billion has been lost in hacks, 96% of it coming from DeFi platforms. So these types of insights are the types of insights you can generate using blockchain intelligence. Lastly, Lisa, digital asset investor. I think like many people in this room, there are new services that are popping up like Chain Abuse. Chain Abuse is a public website where anyone can go and search an address and see if it's been previously associated with fraud or a rug pull or a scam. And it's enabling people to make safer decisions in this new crypto economy. So when we look at people across the crypto economy, blockchain intelligence is actually enabling them to better fight financial crime and more safely embrace digital assets. Thank you.
Okay, so now we had the presentation, and now we'll have one of the graders. EYC is coming in from the Department of Justice, who runs the Cryptocurrency Enforcement Unit. Please take a seat, and we'll get to our interview. Well, thank you very much.
Thanks for having me.
Yeah, for DC Fintech Week. I guess before we jump into questions about crypto, the transparency of the blockchain, what it means for enforcement professionals, even though you are at the center for a lot of the action here in town, you're not as familiar, perhaps, with everyone, and maybe you can just sort of walk us through a little bit your story in terms of how you got to your current position, and even more generally, what the National Cryptocurrency Enforcement Team over at DOJ is set to actually do.
Sure, and thanks so much for the invitation. It's so great to see so many people in person talking about these important issues. I think my origin story is pretty simple. I'm a huge nerd. And so at some point I decided to go to law school instead of sort of following my more quantitative interests back when I was younger. And I became a prosecutor in the Southern District of New York, which is the federal office in Manhattan. And early on, my supervisors realized I wasn't scared of numbers. So they put me on some cases early on involving child exploitation and Tor. And I became fascinated with Tor and sort of how that was being used. It's a powerful technology that can do good with its encryption, but also can be abused by bad actors in some really terrible ways. And so, from that, I think, again, my supervisors were like, you should be a cybercrime prosecutor, which is something I had never really considered. And the first big case I did was one of a multinational criminal organization that had hacked a bunch of financial institutions. And from there, I learned about crypto because one of the ways in which they were trying to, and this is early days crypto, we're talking, mid to early days crypto, we're talking 2013 to 2015 period. They needed to find a way to get into the normal financial institutions and the banking system. And so they did so by bribing a pastor, access to a credit union to help facilitate that. So that was my first sort of crypto exchange case. And then, I had really good mentors in the office, and once they went off to do other things, I took over the Silk Road prosecution, and I defended that on appeal and the subsequent defendants that came from extraditions thereafter. So that's my crypto story, I guess.
That's a pretty good. That's pretty good.
I feel like,
nerd, Silk Road.
Yeah, I mean, it was a sort of a complete accident, but a happy accident. I find the technology interesting, and obviously, cybercrime is something that I'm particularly passionate about.
Well, getting now to the team that you're leading, the National Cryptocurrency Enforcement Team. It's about a year old, give or take.
Yeah,
give or take. Maybe you can just provide a little bit of context as to sort of its creation and why DOJ felt that this specific operation was necessary and what it's intended to do.
Sure. So, I mean, DOJ's ambit is pretty straightforward. We fight crime. And criminal abuse of all different sorts. And so early days crypto, I think the earliest ways in which we were seeing that pop up were, not even just crypto, we've had other digital asset sort of abuse cases, but money laundering, especially as it related to dark web markets and abuse on Tor. And from there, that happened for a while, and we continue to do that work. I know Paul Hemisath, who's on my team, is someone I met many years ago who was also working on darknet issues across the department. We're seeing that there was an evolution in the ways in which crypto was being used and abused by bad actors, just as any technology would be. And we're seeing it pop up in all of our lines of work. So it's not just darknet markets. We're seeing it in frauds and thefts of all type. We're seeing it in cybercrime, a lot of the things that Esteban was going through in terms of his sort of explanation of the watershed. And so it is multidisciplinary in a way that a lot of other issues are not. And we thought it was really important, the leadership thought it was very important to centralize that expertise. So the way that I like to explain it is it's a team of subject matter experts. If you think about the last 10 years and the big crypto cases that were made by the department, if that person's left at the department, they're probably on our team. Districts big and small throughout the country. And we work together on what I think are the hard questions in crypto. We're trying to support investigation throughout the department, but also our own in the area of, especially when it comes to things like platform abuse, tumblers, mixers, money laundering platforms, and DeFi issues as well.
So over that arc of time, even going back to the earlier phases of your career, what changes have you seen in terms of how crypto itself is used in illicit crime?
I think it's just more widely used. And again, any technology can be abused. The internet can be abused for crime. I think the issue that we're seeing is while the sort of widespread adoption started to occur in the last 3 years. There's been a proliferation of different types of products that are out there. And they're all, these are not new criminal schemes. They're criminal schemes that are fueled by the availability of a technology that in many ways can allow for obfuscation of like those who are actually behind it, and can cause some challenges for us from an investigative perspective, especially because it's so cross-border in nature, international, that there's an immutability and a lack of reversibility when it comes to individual transactions, for instance. And so, these are becoming more and more challenging cases, and we are making sure the department is well-positioned to deal and meet with that challenge.
So when you say, these are becoming more challenging cases, can you just, what are some of the nuances involved in prosecuting a crypto crime, and the nuances that maybe distinguish it from your standard bad guy crime?
Sure. So I think there are certain things that Esteban said that I definitely agree with. In certain respects, when there's a public blockchain that's involved, there is transparency in terms of the actual transactions, but actually getting to actor attribution in the way that we do we use in our criminal authorities, we actually need to identify a person behind it. That transparency in the blockchain is only as helpful as we can rely on actors within the industry to have strong anti-money laundering, know your customer policies to actually identify who's on the other end of the address, right? It's one thing to just sort of have a ledger that explains all the transactions. It's another thing to say, and this particular address belongs to this actor. So in that sense, we really do think one of the challenges is to make sure that there are strong anti-money laundering, know your customer policies in place, not just domestically, but throughout the world. Another thing to think about is because we're much more interconnected than we were even 10, 15 years ago, writ large as a society, it's a very cross-border issue because the blockchain is everywhere and nowhere at once. You can think of a situation in which the victim is in the United States, the bad actor is in country number 1. They use infrastructure that's in country number 2 in the form of a exchange, which is incorporated in country number 3, that has all its data in country number 4. This becomes very much sort of one of the challenges that we have in all our cross-border investigations, be it cyber, crypto, or even when it comes to other more traditional finance investigations, is that the data is immense, it's all over the place, and you have to chase down those leads in a quick manner in order to ensure that we're preserving them before the off-chain information is deleted or otherwise goes off into the ether.
So there was a lot in that answer. So I mean, public blockchains can have different kinds of properties. They're obviously pseudonymous, which is what you're saying. Well, we can see the transaction, but we have to know ultimately if you want to punish an individual, you have to know who that individual or what entity is behind the transaction. There's immutability, transparency as to the transaction type. I mean, when you look at them all together in the big cauldron of properties, the bundle of crypto sticks. That I know, I made it up just right.
Okay. That's why you're the professor.
That's why I profess. That's why, and when you look at that sort of these bundle of different sort of properties with crypto assets, I mean, when you net it all out, do they create more problems or opportunities for authorities charged with ensuring the integrity of our markets?
I think that's an interesting question. I don't know if I've done the ledger on that, pros and cons. I would say it's a new challenge, especially within the criminal sphere. I mean, we have our existing authorities. We know how to follow money even through a blockchain. But figuring out whether or not the facts of a particular investigation, whether or not we can apply our existing authorities neatly onto those fact patterns is an interesting one. I mean, our laws, the criminal laws are tech neutral. There are no crypto-specific criminal statutes to date. And so a lot of this is just trying to figure out how we can find analogies about that type of criminal behavior to existing authorities and apply them to that rubric. So,
yeah, and this is just as a clarification to one line there. Mm-hmm. I mean, earlier you talked about the tumblers and the mixers and all that, and you said sort of to trace transactions on the chain. Mm-hmm. I mean, do you consider those tools? I'm sorry. The hamster in my brain is by this time it's starting to get a little slower. No, but do you consider those tools? Do they just slow you do they slow investigations down, or are some of them really, create dead ends?
You mean the mixers and uses
the
of
mixers,
and
right. I mean, to the extent to which any of these things are used for illicit purposes, from your standpoint, because you have to run these cases, you have to prosecute those cases. When you see certain kinds of things that maybe you don't like, I mean, is the general feeling, oh yeah, okay, they're just trying to slow us down, or is it more like, okay, this is really something we have to work through? Is it just an efficiency question of time and effort, or do you have deeper concerns about the nature of the technology and the threats that they pose to market integrity?
Look, I think that obfuscation tools in all their various forms cause challenges for us in order for us to do our jobs. That hasn't necessarily slowed us down. It's no different than a lot of other techniques that people have used in hiding their criminal activity for decades. I would say, what's interesting about crypto from my perspective is that you have to both be fast and patient, is the way that I like to describe it, right? So, sophisticated money launderers, for instance, will sit for a long time before they make tiny little transactions from a set of wallets to places where we may be able to chase down leads. And you got to sit there and wait and watch. And that's sort of one of the things that you need to do. But as soon as it moves to a place where potentially we could follow a lead or follow it hopefully to a place where we could seize back that money, we got to move quickly. So it's a combination of being able to both be patient but also be ready to move at any given second. That's what makes these cases interesting in terms of from an investigative standpoint.
That is actually quite interesting. I can just imagine groups of DOJ lawyers hovered over a computer waiting for.
Well, that's like shout out to all of my law enforcement agent friends who are the ones really like manning the blockchain on overnight shifts sometimes.
It's a digital version of sitting in the van, right?
Yeah, it is. It's very much. It's although they can usually do it from their home.
Okay, between ESPN. Okay, so I mean, really interesting. I mean, so when you think about the worldwide adoption of crypto, managing those risks is inherently cross-border. It's inherently international. Different countries are looking to build capacity in the space, just like we're doing here in the United States. And one part of that is having attorneys like you who have the skill set to do so, who aren't running away from the math. But what other sort of pieces in sort of public sector policy are kind of needed to kind of come together in order to fight crime?
I think that one of the things that is important to realize is that this industry has grown exponentially in the last few years. Really, I mean, like if we look at the timeline of the creation of Bitcoin to the creation of Ethereum to the present day, I mean that is an incredibly fast evolution. I think that we're sort of in a maturation phase when it comes to industry players, and some of them have recognized the importance of doing risk mitigation on their own platforms, and that they're really the first line of defense in many situations to make sure that there is monitoring of abuse that happens on their platforms. I think as the industry continues to mature, I think it will come to a point where more players will realize that it's a business benefit to do risk mitigation in a lot of the ways that we have been emphasizing with regard to things like compliance, things like AML, KYC, and knowing what's going on your own platforms. Because it not only protects the clients of those platforms, but also protects the platforms themselves. I mean, I think DeFi exploits are an excellent example of what happens when maybe code gets pushed out in a way that hasn't been completely vetted before it gets thrown out publicly. So we'll see where it goes. I would just say that this is an issue that needs to be dealt with a whole of society approach. It's not something that law enforcement itself can do and handle by itself. So we need, I think, a cooperative understanding between policymakers writ large, the regulators, law enforcement, and the private sector to work together on these issues, because everyone benefits when we can get rid of crime in the crypto space.
So you mentioned sort of making code and sort of getting it out sometimes prematurely. That was actually a theme that had popped up in an earlier panel. But certainly there have been lots of entrepreneurs who are wondering, if I write code or publish code and it's totally decentralized, and I'm not controlling it, am I liable? And there's interesting legal theories of both criminal law liability and even civil questions. I mean, do you have a sense yet as to where that goes?
Yeah, I mean, I think it's a tricky question in part because everything is very fact-driven. It's a general principle when we deal with any criminal investigation, and we have to sort of see where the facts lead us and whether or not our authorities apply, including things like intent statutes. I will say, set intent sort of standards. I will say in that regard, and we wrote about this, we've had, NCIT has written 2 reports since its inception pursuant to President Biden's order, one about international cooperation in fighting crypto crime and the other one about the role of law enforcement. And in that latter one, which just came out in September, we make the point to say, it's one thing for you to publicly state that you are completely decentralized and you have nothing to do with the code, but oftentimes when we do our investigations, we realize maybe it's not so clear. Maybe it is more centralized than you think. Maybe there is more control than you think. Maybe there is custody in ways that publicly, an entity or an individual might think otherwise. And so those are all questions that are sort of hard to answer in the abstract, but certainly those are the types of things that we're looking at with the onset.
Yeah. Which is... So I'm just a dumb securities law lawyer, but there are some interesting ideas that you may find in like even the automation, high frequency trading space that are kind of interesting ideas. Okay, so we've talked a little bit about public blockchains. We've certainly talked about the degree to which you can or cannot sort of follow the money. Do you ever think to yourself how the public sector can really use blockchain data just generically to more effectively fight financial crime?
Well, I think it's examples of blockchain analytics like what Esteban spoke of. Those are the ways in which you can sort of harness the potential of the public ledger to figure out whether or not you're mitigating risk on your own platforms. I think that is an important step. But again, that's only limited so far as there is availability about who is behind those ultimate clusters of data, the entities that hold the true keys as to who is responsible for XYZ from a criminal perspective. So we really need to work together on those issues in a cooperative fashion.
So, okay. I have a suitcase full of unmarked bills running around, okay? It happens all the time, and
I don't know what circles you're hanging out in.
But hey, DC Fintech Week, and you when you're thinking about sort of cash versus blockchain based transactions and all, pure curiosity. You've been around, and you're a senior person over the DOJ. When you talk to even some of your more senior colleagues who've been around and had to fight, the pure cash transactions and the like, you guys ever get into debates, which is worse or which is harder or which cash versus
No, because
digital?
I think for cash, this is the bottom line with cash. It's large and heavy if you want to be transacting in the volume that you can see with crypto. Crypto, you can have a hard wallet stored on a tiny USB that oftentimes when we are trying to find, that little drive, it requires an incredible search of a premises. It requires, like electronic dogs sniffing around to figure out where that is. You can't hide that much cash. Like, it's just not the same. So that's part of the reason why, we need to be, from our perspective, we need to understand how easy it is to have large amounts and volumes of money be stored in very small physical data, devices, and figure out how we can identify them so that when you do a search of a premises of a purported criminal, and you find one, you know what to do with that, or you can look at a computer and know exactly what to be looking for. Those are sort of some of the things that we're trying to make sure everyone understands throughout the department and some of the challenges we face.
That was actually super interesting. Because I had a conversation once with someone from Treasury, and they were talking about asset seizures and even selling seized cryptocurrencies and the problem of how do you even liquidate some of your holdings because of the volatility in some markets that by the time you sell it, it's at a completely different price, and trying to go to a judge to get the liquidation in time is there's a certain kind of process.
Yeah, it's easy for us because for the most part, the default is the same for all properties. So we just wait until the end of the criminal investigation and for the judgment to be in place in order for us to be able to liquidate that. So that oftentimes will dictate when that occurs. You can get sort of exceptions to that rule, but that's the general rule.
Interesting. So what are your priorities for the next year? What? Feel free to break news. Any. Trust me, everybody else is. But where do you want to go? Where do you see as sort of your points of emphasis strategically? Where do you think more attention where you think more attention is needed in terms of being directed by DOJ?
I think that, so we recently launched the Digital Asset Coordinator Network, which is 150 dedicated prosecutors who will serve as their office's respective first lines of contact when it comes to digital asset issues. That's important for us just because there's so much work to be done that we need to make sure that we have available resourcing and subject matter experts throughout the field in order to help their respective offices. So I'm very focused, and the team is very focused generally in capacity building within the department, but also with regard to making sure that our foreign law enforcement partners are well equipped to handle this because it is a global problem. And we're basically only as strong as our weakest link on these questions. You can't just be hoping in the 11th hour when you're dealing with a sophisticated crypto investigation that your law enforcement partner in name X country that's never done a crypto case is going to somehow figure out how to do that. And so that's one of the things that I know all of law enforcement, especially the NSET, is very focused on is capacity building within. And in terms of our own sort of strategy, we're really looking at the multiplier effect cases. So as I mentioned, things like mixers, tumblers, and money laundering platforms are important because they have a multiplier effect. They facilitate all sorts of criminal activity of different sorts. And so by making sure that we are addressing and disrupting that activity, we can sort of writ large hopefully lessen the impact of crypto abusers on the American public.
Can I just get that last little piece, on the capacity building question? I mean, being a professor, I can't help but find that kind of interesting. The challenge of making sure that personnel are trained and understand the specific infrastructure and challenges and opportunities posed by blockchain-based infrastructures. How, realistically, how long does that actually take? I mean, right now we have an industry obviously that's moving very, very quickly, and talent is drawn to different, different areas. It's often to the private sector. How does that capacity building in your mind? How do you get the most out of getting the most out of capacity building?
I think most people who join the department, I hope, and law enforcement generally, they're there to serve the American public. If you're in a case and you're investigating it and you're a dogged investigator, you're not going to just put your head in the sand as an ostrich would. Once you hit some sort of technology that you don't understand, it's about figuring out, hey, has anyone in the department seen this before? Has anyone dealt with these issues and these challenges and figuring out where that resourcing might be? We've now, for instance, had multiple rounds of successful, I think very successful public announcements relating to seizures of cryptocurrency in ways that I think most people in the American public would not necessarily have known we're able to do. And we want to make sure that everyone is sort of well positioned to do that. Now, look, people leave the department to go to the private sector, but I think the way to deal with that issue is to make sure that everyone is equipped with the tools. I mean, I want to be in a position where if me and the entire NSET decides to somehow peace out and move to the Bahamas and hang out with the folks that are down there, that there is an entire generation of new prosecutors and investigators who understand this technology are not intimidated by it. We're all learning every day, but we need to make sure that people understand exactly where the resources are to make sure that they're on the cutting edge as well.
Well, the very fact that you said, wheneber you see a new technology, you have to sort of figure it out. I was, of course, thinking about the wire and cell phones.
Oh, yeah.
I
actually rewatched that during COVID.
I totally did. So well, and anyway, EYC, thank you so very much for joining us and for giving us a little peek in as to what the DOJ is doing. Thank you so much.
Thanks for having me.
All right, thanks. And shame on anyone who did not know the reference to the wire. Shame. Okay, so now we're going to move into our next panel with three real leaders in blockchains: creators, founders, people who are developing really the latest systems. We're going to have Charles Hoskinson, the CEO and founder of Input Output and of the Cardano blockchain, and the co-founder of Ethereum. We're also going to have Kevin Seknicki, the Chief Operating Officer of Ava Labs, and Stani Kuluchovi, the founder and CEO of Aave. So I guess you guys can come on over. And is Kevin? Okay, excellent. Kevin is here. And hopefully we have Stani. Excellent. Sure.
Ladies and gentlemen, it's time
So this is a real treat because you don't really get people together to really talk about blockchains, to compare blockchains, and to really think about the future of blockchains. Stani, nice to have you, by the way. Thank you for joining. I'm going to just jump right on in it with Kevin. I mean, this has been a big year for blockchain law, but also blockchains. Obviously, the merge has gotten a lot of attention. But what do you see as a technologist as some of the major sort of developments in the space? Are there any particularly big breakthroughs of the year?
You guys hear me?
Yes.
Okay, perfect. Technologically speaking, I mean, there's a lot, I would say. There is obviously still a lot of work being done to fundamentally scale these systems. But I think that's been ongoing work, and it's going to continue being ongoing work for the next couple of years. It's been ongoing work for certainly the past couple of years. At Avalanche, we've done a lot of work. Cardano, a lot of work in this area as well, of course. But I think something technologically speaking that's going to become more and more apparent in the next couple of years is I think blockchains is, it's no longer kind of early technology. It's starting to become a little bit of a mainstream technology in a lot of ways. And when you become mainstream, it becomes very difficult to be on the fringes. And so now you have to play in a much larger stage where regulatory environment plays a role into how we build technology. And so we're entering this era where I would say that every single big blockchain and naturally blockchain developers are going to have to develop systems with this in mind, which is how do we build systems in a sustainable way that enables all these financial innovations to come along, in a sustainable way, in a responsible way. How do we enable privacy in a way that is responsible? And there's a lot of technology to be introduced there, from homomorphic encryption to ZK snarks and all kinds of fancy rocket science. So there's a lot of work to be coming in this in the next couple of years on this kind of stuff.
So you're excited?
Very much so, yes.
Okay, Charles, I mean, how about you? I mean, obviously there's been a lot of talk as to what are the major breakthroughs. I mean, we've had people talk about, advancements on Lightning. We've had people talk about the merge. But where do you stand? I mean, where do you see the real tangible sort of technical areas of progress have been made? And what do you think it'll mean for crypto?
So right now we're trying to exist with the consequences of scale. So we have this kind of homogeneous model that everybody is their own blockchain, everybody has a full copy. This is the idea that Bitcoin brought. And that's not really feasible when you think about overuse. If you have millions of users year after year, you end up having blockchains that are in the petabyte scale or yottabyte scale. So how do you preserve this concept of inclusive accountability, meaning that you don't have a full copy of the blockchain, yet you're able, when an event happens, to verify it with the same trust model as if you did? So you see a lot of advancements in zero-knowledge cryptography, entire blockchains like Mina or was it Cello is another one. And we certainly have technology like Mithril as to others to accommodate that. So it's a big, broad conversation, and you see it in conversations like roll-ups, recursive snarks, these things. And that's one super important area for the consumerization of cryptocurrencies, getting them to work on your phone without compromising the integrity. Another big area of research is on the governance side, where people are saying, well, if these are truly decentralized systems, they shouldn't have a management team, or if there is a management team, they should be elected or in some way and represent the people. So how the heck do you handle that? Do you do it off-chain through some sort of external social consensus, or do you do it on-chain with an explicit voting? And this is most represented with DAOs, these types of things. And we're having all kinds of regulatory conversations of what are these? Are these unincorporated associations? I think you've been a pioneer in kind of writing legal wrapper papers and these things about it. So it's a fun concept, but from a technological viewpoint, it's actually forcing a rediscovery of old things like Eros theorem and old voting lore and political science that people argued about in the 19th and 20th century, just given kind of a different light above and beyond normal shareholder theory, which most voting organizations subscribe to. So I'd say those are the two big ticket items that are driving technology at the moment for regulatory and feasibility reasons, above and beyond environmental concerns. It's probably the third and last driver that's had a big impact, where people are starting to say, well, maybe we should have systems that don't require all the energy of a nation state to operate. Is there a better way of doing that? And what are the trade-offs in terms of decentralization and control that are required for that to happen? So this is the old proof of work versus proof of stake or other thing debate. But it's very fertile. Tons of competition, tons of great papers, tons of great work. Avalanche is doing it, Algorand is doing it, of course we do it. And it's just fun to see the convergence of the minds and good progress all around.
Can I just follow up on one point that you made there in terms of the research? Because both of you guys are talking a little about the research, experimentation, like, how does research sort of in blockchain technology, how does that translate to the actual, product? What does that sort of life cycle look like?
Well, it depends on the actor. Some research means that you follow a process, you go through peer review, you painstakingly implement the protocol, and then you bring it out slowly and methodically, and some people do that, like we and Algorand and others. For other people, they just ignore the research and they end up like Luna. So, so it just depends. There's a broad spectrum of options you have there, and this is why the regulatory conversation is starting to work its way in, because every time there's a failure of process, usually it ends up with a hack or a semantical issue, which ends up in the loss of value. There's been over $35 billion worth of hacks. There's been ecosystems that have entirely collapsed because of fatal fundamental economic flaws and so forth. So the question is, are the incentives right in the industry? Because right now the problem is the incentives are move fast and break things, gather as many customers as you can and get paid up front. And so as long as you have that, that's a failure that the market can't correct. So regulation is required in that case. And so it's invited a very uncomfortable but probably necessary conversation given the scale of the industry.
That comment for some earlier talks with some of the regulators, I think that's a very interesting observation. Stani, thanks again for joining us through the internets. When you look at the progress that's been made in the last year, I mean, obviously you're active in the DeFi space. When you think about blockchains, you can have all kinds of progress when it comes to processing power, when it comes to maybe environmental issues or the like. But how exactly do those changes in terms of blockchain infrastructure ultimately impact the suite of services that can be operationalized via smart contracts and protocols? I think it's a useful thing to kind of walk through, particularly for a Washington, D.C. based audience.
Yeah, and first of all, thanks for having me here. I'm calling from actually from Colombia, Bogota, where the DevCon, which is a conference the main conference in the Ethereum community that is happening here, where thousands of developers are coming together and sharing progress updates. I think for the past maybe 2 years, what I have noticed is that we've moved kind of like into the idea of understanding that basically blockchain could be used in various different kinds of industries to basically seeing a lot of innovation in finance. And actually a kind of like a space event was born in the ecosystem called decentralized finance, which means that you can interact with different kinds of financial protocols as a user with certain type of a benefit. So for example, typically decentralized finance, you get the transparency that is in the that comes from the public blockchain. So you can see, for example, how much a particular stablecoin is minted, but also in which different kinds of protocols it's actually at the moment residing at. Also, you have this smart contract based execution, which means that you don't need to trust counterparties or paper-based agreements, which builds more efficient execution. And also the fact that because these protocols are open source, it means that these communities can ongoing basis improve the protocols. And I think wanted to touch base on the idea that when the space is very open, it means that anyone can come any part of the world and actually innovate and create better financial applications and also non-financial applications as well. And that means that you have a lot of interesting experimentations going on, but some of these protocols are actually building for scale. So in the same way as the internet was built in the first place. So for example, we today are using IP protocol or HTTPS protocol without actually thinking about it. And the same way, some of these more battle-tested, more serious DeFi protocols could actually scale in the future. So where's always innovation, there's always different kind of experimentations, and it really creates kind of like atmosphere where these communities have to actually come together and create different kinds of rules to self-govern and ensure that all the kind of like incentives are aligned between different communities, not just inside of decentralized finance or the Web3 space, but also outside of broader finance, for example, and when it comes to more consumer-facing approaches in the future. But many of the technology has been also improving. So, for example, Ethereum recently did the merge, which means that now it consumes as a blockchain 99 point whatever it is less energy at the moment, which is also quite incredible achievement. And proof of stake, just moving from proof of work to proof of stake, which is kind of taking more over the way to validate blockchain transactions. So all of these different protocols that are built applications and the underlying infrastructure is getting better and progressing on Ethereum. Same for in Avalanche and also in Cardano, and there's constant progress and more scalability as well coming. So it's looking definitely positive from here, from the developers' perspective.
Right, Charles. Just to sort of follow up on that, how those developments sort of spill over into actual sort of products, and there are still, it is a process. I mean, as you said, you have to test things, you have to research, gather data, and if you're being a responsible actor, you're doing it before you sort of release things into the wild. But there are sort of persistent questions that arise even when you release technology that may be fine, but evolves in a way that market participants sort of change. Different kinds of market participants may become more dominant, and there's a concern that on many networks that validators can sometimes have privileges in a network. That there's always this persistent concern about perhaps front-running transactions when mining blocks. When you think about that problem, of privileged actors on systems that just over time could become more privileged. Is this like an intractable problem with decentralized networks? How do you think about how you can engineer responses such as to prevent those developments?
So in general, you can't. The best you can do is just come up with models that have some degree of simulation and reproducibility and give you some assurance and confidence that the design that you have against the adversaries you're worried about is correct. But it's like asking, can I build the perfect automobile or the perfect airplane or these types of things? The answer is no, but the more homework you do, the lower the probability it is that you'll have the windows like suddenly blow out or the engine just suddenly stop and everybody crashes to their death. So part of that is having well-regulated markets for quality. So regulation and insurance are examples of forcing factors that force people to think about these things. And then part of that is also having brisk competition and strong consequences for failure inside the system. And then overall, the market starts developing best practices over time, notion of quality over time. And eventually you do converge to a relatively safe, stable system. The bigger issue, I think, is hidden trade-offs. So when people think that the goal is, for example, throughput, they may be willing to sacrifice decentralization for that. And you end up just replicating a centralized system, but you don't realize it because you're saying it's decentralized, or something like that. And there needs to be better enumeration of the trade-offs that people are engaging in, and what corners are they cutting in order to actually ship a functioning product, and in which cases, what have they introduced that is actually not in the ethos that people believe? It could be privacy considerations, censorship resistance, it could be control, these types of things. And there's a lot of stuff in the industry at the moment that's quite brittle, and people aren't aware that it's that brittle.
Kevin, one of the features of DLT networks is obviously rich availability of data. We talked a little bit about that on the previous panel, and information. Now, while this can be certainly of use, as we heard, in the world of supervision, you have these privacy, security concerns. Anywhere you look on crypto Twitter, you'll see those concerns as being expressed and cited as a kind of a hindrance for adoption. But are there any privacy solutions that you think could be viable that strike this balance between transparency and security, that can still allow the network to scale and to develop? Or is this just, or are we all condemned to just debating
no,
this
I don't think we're, actually, it seems like you're asking a simple question, but you're actually asking a much deeper question than that. Because asking whether it's just privacy, should we have it or should we not, it's really going to the question of, fundamentally, what does it mean to build a good blockchain system? It's like, what does it mean to build like the perfect car, as Charles said? Well, first of all, you have to define what does perfect mean. What is the feature set that we want to build in this technology, right? Like, go take the example of the internet. We want to build this network globally of machines that can communicate and share information. Well, what are the properties that we want from it, right? Do we want people that use the internet to be KYC'd every single time you use your machine? You have to show some digital passport? Or do we make it much more easy to onboard, let people scale up the systems, and build something that is neutral, that we can have security systems built on top of it, but otherwise the base layer is very neutral? Same exact questions you have to ask for a blockchain systems. And I don't really think at this moment that anybody has the right answer to what it means to build a perfect blockchain system. We're kind of iterating, figuring out what do users want. And so the question of privacy for a blockchain system really is, is that something that is built into the protocol? Is that something that is orthogonal to the protocol and it's kind of like a secondary thing that you build on top? That's a really deep question, and it's a question of that's going to take years to iterate through and figure out how to build a really reliable, really secure, but ultimately probably neutral infrastructure. That's really important. If we want to build something global, it has to be neutral. It has to be infrastructure that anybody can develop on, and that's critical. But, of course, as Americans, I think it's not controversial for us to ask the question or to expect some sort of financial privacy. I think that whenever you take out a loan at the bank, I don't think you want that information to accidentally leak out. And by design, blockchains are both the strength and weakness is that everything is available, transparent. It's a strength because it means that everybody can develop on them. They're neutral, and that's great. It's a weakness because now any accidental leaks of your address, your pseudonymous address that you have, say, for example, Aave, which is a fantastic lending product, you use it, and then accidentally that address gets leaked. Now all of the lending history that you have ever done, and supposing that, for example, Aave becomes an institutionalized product that even has, mortgage lending or something like that, something advanced. Yeah, we'll talk about that. That could possibly leak. So obviously, we expect some sort of financial privacy there. But how we do that in a responsible way is an open question. There are technologies that enable us to provide some privacy, right? There is ZK technologies. But at the end of the day, I would probably say almost boringly and disappointingly, some of the best privacy technology right now is maybe like centralized exchanges, which allow you to send funds there. If you have any address that potentially is compromised identity-wise, and you want to have a fresh start, send it to a Coinbase, bring it back out, and so on. versus something like a tornado, which has a significant amount of problems in and by itself. So it's an open question. I don't know that anybody has any answers here.
Okay, so it is really a privilege to have some of the leading technologists here sitting next to each other. So here's a bit of a spontaneous question, because as founders, I think it'd be curious for many of us to know. I'd be curious for me to know. I mean, when developing blockchains in the space, are most of the entrepreneurs, when I hear about these different kinds of trade-offs, right, they are questions both of either values or commercial interests, right? Like trying to build something that's going to be commercially successful, or it may be something that's a little bit more speaks to values. Now, in TradFi world, I think the commercial part of it is deemed to be more the presumption. Like you want to build something that's going to sell, that's going to be effective. You don't want the regulators on your back, but so you'll try your best, but ultimately you're trying to figure out a way to sell something, right? Certainly, if you look at crypto Twitter, you can't really tell sometimes, is it about selling something or is it about a kind of a values statement? I mean, harking all the way back. So, I mean, when you guys, either you yourselves or when you listen to some of your other peers and trying to navigate this space, do you get a sense from the community of leaders, is this a values question or is it a commercial perspective? And we'll get to Stunning in just a second, but I did want to follow up with you, Kevin and Charles.
Yeah, I mean, that's an incredibly good question. It goes to the root of what I said, which is that there is no good answer to how to build the blockchain system, kind of like going like how to build the internet, because weirdly enough, there is a lot of pullback from the value side that conflicts with the commercialization side. And it's a very powerful dichotomy that exists in crypto. It's very unique to crypto. It's not particularly so prevalent, I would say, in other industries. Other industries have much clearer mandates, but in crypto, it's not the case. In crypto, some people really want to just build super fast blockchains that anybody can validate and they're trustless without regards for much else. And some people really, really care about making sure that those blockchains can somehow be replicated on very low-end devices. That's a value question. That's not really optimizing for speed or performance. That's just, I want to make sure that this blockchain runs on my smartphone, right? Which is a really tough question, but it's value-driven. And there is ongoing now a 10-year plus war within crypto literally trying to answer this question, and I don't think anybody has an answer. I think every single blockchain has different values, but I do see actually a trend, generally speaking, that most blockchain systems are going towards more like the let's just build things that are reliable and fast and not care so much about narratives or something like that. So it's somewhat of a commercialization aspect going on right now.
Charles, what do you think?
Well, the nice thing about being an asshole that nobody likes is you can just be blunt with everybody and tell the truth. Nobody cares about values in this space. And nobody cares about values in technology at all. If you poll 100 people and say, are you concerned that Facebook and Google and all these other guys and Amazon are invading your privacy? Oh yeah, very concerned. And they say, Alexa, what's the weather today? Hello, microphone in my bedroom. We all have Facebook pages. We all use social media. We all use these things. So the reality is that the value ship has sailed a very, very long time ago. The minute money got involved, values went out the rainbow. It was very values-based in 2010, 2011. I remember those days. They were great because nothing was worth anything. You had to pay for your own beer. But on the other day, we had these utopian ideals of reimagining and reinventing society. But the magic of blockchain technology is that it forces you, if you design it the right way, to pay attention to values, much like constitutions force nation states. You don't write things down like freedom of religion and freedom of speech and these types of things, due process, because you're trying to remind people in the future. You write it down because you know for a fact that somebody in the future is going to try to violate it. And similarly, the point of blockchain technology is to constrain future users, future developers, to accept the fact that the system is going to have actors for their own personal interest are going to try to manipulate that system and break the system, whether it be printing more money out of thin air like central banks do or violation of your privacy. Just going back to the privacy question, privacy and confidentiality are completely different concepts. and they're often conflated with each other. So anytime you talk to things like bank secrecy or GDPR or a regulator, oh, you have a right to privacy, except for the times you don't. When you talk to the Monero people or the Zcash people, these things, they say you have an absolute right to privacy. Totally different concepts. One is totally acceptable under the law, and we all can live with. The other one is not, and is at arms with the commercialization of technology. And lo and behold, you see the people embracing confidentiality are getting a lot of traction, a lot of VC money. The people investing in privacy, true privacy, their market caps are quite small, their traction's quite small, their liquidity is drying up in that respect. So I never think it's a values versus commercialization. And betting against people's self-interest, the things that make them money, the things that pay the bills, get them a higher status in life, you're always going to lose 10 times out of 10. So that's why you remember to write constitutions down. You remember to force into the protocol some acknowledgement of human rights. And if you get it right, they just have to live with that, just like we have to live with consequences of TCP/IP, which creates a free and open internet. Had they get a do-over, they would have written it totally differently. But it got too big too quickly.
That was actually pretty amazing, and that was pretty amazing. I'll have to think about that, and I'm sure Twitter will too. But no, I mean it really is a very yeah, it's everything. So Stani, okay, Stani, let me bring you back into this. Okay, so getting back to DeFi, you know. Is especially when you look at some of the volatility that we've seen. We've already had conversations with Sam Bankman-Fried earlier, and also with wonderful lawyers from Latham & Watkins on like crypto bankruptcy and what happens. You know, when you try to untangle some of the volatility over the summer, is that for all the ambitions of decentralization, you still have applications, centralized applications. Or excuse me, centralized actors that are interfacing in very decentralized environments, and that can create all kinds of different risks. But I guess this highlights a more general issue: is that applications can entail serious elements of concentration, and even as we push for decentralization. Decentralized environments can still end up de facto dependent on very centralized intermediaries. I mean, why do you think this is the case, and are there solutions to this? What's needed to preserve decentralization in not just from an infrastructure standpoint, but also from a participant standpoint?
Yeah, I mean, especially when it comes to the concentration and centralization. I think to acknowledge that we only see it when we have transparency. So, for example, with the public nature of the blockchain, we were able to actually pinpoint where there is actually pockets of centralization or concentrations of capital. And that's the first step to actually create a system where we pinpoint those issues and can actually talk about it within these different communities and act upon it. And I think when it comes to the centralized providers, I think it was a very good example why DeFi exists in the first place, and why there are people who are actually believing quite a lot on the technology and the benefits it has. So when I started 6-7 years ago to build decentralized finance, I had the option as well to create centralized services as well. But I truly believe in the idea that, if you use smart contracts, you could actually mitigate some of the executional challenges, and also you have the transparency and create a network which is relatively very liquid as well. And what we noticed during the past months, so these decentralized protocols were the only, I would say, kind of like places where the centralized lending providers were actually repaying their obligations, because you really can't bend on the rules of the smart contract. So well-designed systems are something that really serves the whole ecosystem. And I think it goes back to the previous value discussion. So, the ethos behind the blockchain is decentralization. So if we pinpoint a lot of concentration for example, in node validation, the community members are starting to actually flag that as an issue, and we're thinking how to solve these challenges. And this is what's happening, for example, in terms of the Ethereum staking pools, and there's sort of discussions about, how to avoid too much of concentration into particular staking pools. So I think the fact that you see everything and DeFi is an aquarium gives the visibility to see where you can actually put the effort and pinpoint those issues and act upon, compared to centralized finance, or where you have less visibility, for example, in traditional finance. So I think one of the benefits that I personally think has been very something that's brought a lot of success for decentralized finance is the aspect of transparency, and that helps to pinpoint the issues and act upon as a community.
All right, so let's jump from that to the regulatory issue. After all, this is Washington, D.C. and DC Fintech Week, and I see you, I know the regulators who are out there, and obviously we have the regulatory community. But Kevin, I'll jump to a regulatory question for you. Now, regardless as to whether or not you think a certain law is good or bad, so we're going to bracket this, people. Are there any kinds of initiatives that you're hearing about, regulatory, legislative, and I'll actually ask both of you this. Anything that you think is going to be particularly important or will have a particularly defining impact on blockchains, not just DeFi, but blockchains themselves. Is there anything that you're hearing in terms of regulatory supervision, when it comes to policing powers? Is there something that you're hearing that, good or bad, you think is going to just be very significant for the space? Kevin, I'll start with you.
I know I'm in DC, but thankfully I don't deal too much with regulation for a reason. I'm a technologist. That's outside my purview. Generally speaking, obviously I'm hearing a lot, being at sort of like what was coming out in Europe, what's coming out in the U.S. publicly. There's a lot. I think there's some great stuff happening on the European side. MiCA, I think, just got announced, like that they're making some great moves. At the end of the day, what matters, probably a more kind of like a meta discussion, is to look at the past and how past technologies that are of similar nature to blockchain got regulated, and to draw inspiration from those, right? Like TCP/IP stack that built the internet. Would the internet be in a better place today if it was built with strong regulatory oversight from the very beginning? Maybe. There's no way to know. Certainly, though, the internet has been an incredible value add to the world. It has transformed the world. And certainly, if I was in a committee to redo the internet, I would vote all day, every day to redo it in the same way. Let it free, let it build up, and then build systems on top of it to protect users. Same exact thing. I would hope gets enacted on the regulatory side. I don't know exactly. I'm not, again, a regulator, so I don't know. But I would probably hope, at least. And I'm sort of somewhat seeing these discussions, but not particularly as explicitly as I'm making them here. But that would be like the big thing. Take a look at how the internet got built and replicate that same strategy.
Charles.
I was in the same position as a technologist. I knew absolutely nothing about regulation, compliance, or all these other things. But we've all become forced as an industry to become pretty knowledgeable about this stuff out of necessity. Just like I bought a bison ranch, and suddenly I know a lot about bison. Go figure. And so you learn what you do. And the situation we have right now is we don't have a taxonomy. There's at least 9 different types of tokens. They all are probably going to end up being regulated differently. The legislative branch has yet to act, and so now we have regulations through enforcement. And case law is kind of giving us occasional guidance of what's a security, what's a commodity, what the disclosure regime needs to look like. And we're all feeling around in a dark room. Now, this is a temporary state of affairs. This year, we probably could have gotten something done, but I guess that whole like losing $9 trillion in the stock markets and threat of nuclear war and this very contentious election and so forth, getting in the way of that. You know, it's one of those ain't got no time for that type of things. So next year, we'll get it done, one way or the other. And there, we'll probably have this Hegelian dialectic occur where the executive branch, through the executive order, has made a statement about what they feel should be done. And the legislative branch, through things like the Digital Commodity Exchange Act and the FIA and other pieces of legislation, has proposed a collection of approaches. And they're just going to smash into each other in some way. And the composition will probably depend on whether there's a blue wave or red wave or a mixture of either House and Senate. And then something will get passed. Now, maybe that's good, maybe it's bad, but it's something. It's something that we can work with and we can deal with. I, years ago, invited Vint Cerf to a conference that I put on. He was one of the creators of the internet, him and Bob Kahn, over at Stanford when they were back at ARPA. And I asked him a single question. He spent over an hour, trying to answer the question. I said, if you could do the internet differently, if you got a do-over, what would you do differently? And he opined for a long time. But the thing is that you don't get a do-over with these types of technologies. And what kind of makes them special and magical is working with the scarcity. The design space is set. Whatever the law is, we receive it. And once it's been decided, it's been decided. Then the question is, how do you optimize around the facts of life? How do you optimize around that reality? Elections have consequences. And the good news is that we as an industry have invented a lot of really cool technology that I think we can have our cake and eat it too. You probably are going to see a term next year, regulated DeFi. This idea you have something that's decentralized, but it involves using DIDs and other things to do compliance so that DEXs don't get captured and banned. You're probably going to see these legal wrappers for DAOs that give some agency to some managerial group, but allow people to vote and participate without liability and so forth. You're probably going to see all kinds of new confidentiality technologies that get invented. And what they do is allow you to have selective disclosures, and in some cases involuntary disclosures, but still preserve overall transactional privacy for the type of system. So that age of compromise is going to force quite a bit of innovation and quite a bit of work, but actually it'll move the industry to the next level. And that's what's going to get us from a $1 trillion industry to a $10 trillion industry. That's what's going to get us from where we're at to where we'd like to be, ultimately. It's fun and exciting. It's at times frustrating, but it's any given Sunday. You just wake up and you fight the game that you want to play, not the one you want to play, but the one you have to play.
So Charles, I will now forever love you, along with Nick Carter, for the only people in my years of ever doing anything to mention Hegelian dialectics in the middle of a blockchain conversation. So, for that, you will always, someone who majored in German, and you'll have a special place. Sandy, we only have 1 minute left, but for you, and tomorrow we have Mairead McGuinness, the Commissioner of the EU, coming through as well. But I know you're in Bogota, but I know that you're out in London. What regulatorily do you think is going to have the biggest impact? 50 seconds.
Well, I really think in terms of the regulatory part, so it really depends on when we look at decentralized finance, there's different kinds of I would say protocols, and they have a different function, right? So it really depends on that side. But I think where the value actually is to understand what these protocols are and what they mean to the users, to the communities, and to the public. And effectively, I think regulating on the kind of like a more decentralized layer is maybe not the most efficient. I think it's more efficient to kind of regulate the kind of ports to the ocean, might be those centralized exchanges or whatever is providing services on top of the infrastructure as well. So I think that might be the most effective way to regulate the space and provide value for the end users.
Great. Well, thank you. Extraordinarily interesting panel, gentlemen. Extraordinarily. Thank you so much for coming. We'll have our finale with Brian Brooks. Oh. Very good job. Okay. So we started our conversation with one comptroller. We will now, Mr. Brooks, DC Fintech Week, calling Mr. Brooks. Yeah. We started everything off with one comptroller. We are going to end with another for our finale for the day. To have a, we pride ourselves, exactly. Oh, it's fantastically fantastic. We always pride ourselves with individuals with, who are shy. And so we decided, to end it with you. Do you have remarks?
I'm great.
Please take a seat. Okay. And thank you so much, Brian, for coming on. I know you made the trip. It is truly appreciated. Truly
It's my pleasure. I'm going to try and be the friendlier controller, and we'll see how that goes.
Oh, okay.
Yeah.
Well, I mean, this morning there was some lightning.
I was with him right after you were.
Okay. Yeah, there were a couple of zingers there. Okay, let's just do a little bit of recap because you've testified before and you've spoken before on quite eloquently about different sources of opportunity and risk in the space. Obviously, just looking back, there have been many attempts to prognosticate over the sources of volatility that we saw earlier in the year. You're a student of financial markets as well as crypto markets. How do you view those sources of volatility comparing as to sort of traditional or earlier bouts of volatility? In fact, perhaps even more controversial, very frequently references are made to make analogies to, say, the 2008 financial crisis or the Great Depression and certain sources of volatility there. When you look at the volatility of our crypto markets in the last couple of months, what's new? What's interesting to you? What's different?
Well, Chris, it's a great conversation. And let me just first of all apologize that I'm the guy standing between you and the bar. Okay. But I'm going to tell you that Chris and I made a pact earlier that I have the authority about when you're allowed to go to the bar. So if you stay, and if you give us 20 minutes, you can totally go to the bar. Otherwise, it's canceled. So you got to listen. Right?
That happy hour?
It's off. So
it's completely off. It's completely off.
So Chris, exactly.
So you get there.
So your question is about what's going on in these markets and what are the factors influencing it. And so let me just begin by sort of asserting that there are a couple of lessons from both the dot-com bubble and from the financial crisis that I think are really applicable here that nobody ever talks about. So let's just think about the financial crisis for a minute. One of the things we learned from the financial crisis is it actually does not take much to blow up an entire market. So a lot of people have this memory, and I know we have a lot of students in the room who you might be young enough that you don't even have a memory, you just know what you've read about it in books, about what caused the financial crisis. And many people believe that what caused it was massive failures in the banking system or mass defaults in subprime mortgage or whatever. And the truth is that the entire financial crisis was caused by a very slight uptick in mortgage defaults inside of the Fannie Mae book, and the maximum amount of mortgage defaults that at the peak of the financial crisis was 5.4%, and that ended the world. So in a world where you had 95% of mortgages paying on time, the world came to an end. So what's the analogy with crypto? The analogy with crypto is you have a couple of interesting little side projects that most people didn't even pay attention to. You had Celsius, you had Terra Luna, you had Three Arrows Capital, which honestly I had never even heard of until I had dinner with that guy in the Bahamas. And those things blew up. Those things collectively represented maybe 2% of crypto market cap, and Bitcoin fell 80%, right? It's just like the financial crisis. Very small things can cause confidence runs. And so that you have that happening in a macro environment where the Fed is doing the right things on inflation, but as I've said a million times, Bitcoin really is a counter-inflationary asset. And people say, how can you say that, Brian? Because inflation is high and Bitcoin's low. The answer is because policy is hawkish on inflation. So in the same way that equity markets are making predictions about future cash flows when they're buying and selling stocks, it's not about how well Apple did today, it's about my prediction of how they're going to do next year, and that's when I start selling. Same thing in crypto. The Fed is on a warpath against inflation, and well, they should be since they caused it. It's good for them to do something about it, but what it means is Bitcoin is going to be low, and Bitcoin's most of crypto market cap, so that's a bad thing. And then you have this regulatory circumstance where I'm not going to say that I'm right and the other guy's wrong or anything, but you do have a crowd in power today who is overtly hostile to crypto, and let's make no mistake about it. This is, in fact, a political issue the leadership in power at the moment is devoted to reining this in, if not destroying it. And a number of things I've heard, even just in the last 24 hours of DC, convinced me of that. So that whole environment is really negative. What it does mean, though, I'll just say this, is, and I mentioned the dot-com bubble as kind of my metaphor for this, the good news about this is, the charlatans, the scammers, the speculators, they're gone because they're bankrupt. Well, they're not all bankrupt. Some of them, like Doe, are actually on the lam. But the ones who at least live in the United States, they're all bankrupt. And what's left are the people who are building projects that actually solve fundamental problems. And so the real value gets created from here, much as, in the wake of the 2000 dot-com bubble, what did you get? You got Google and Amazon, right? And that's what's coming now. So that's the good news.
The very features of the technology are interesting, particularly when you think about automation, right? And in a really very real way, crypto is becoming a field of applied automation. I mean, but what makes it then different from an opportunity standpoint and/or from a risk standpoint of other areas in which you see applied automation and learning, machine learning?
I mean, look, I'll just give you an example, because this comes from my own crypto journey, and everybody's got their little journey. But before I'd ever heard of crypto, so I was not one of those guys who was buying Bitcoin in 2010. One of the reasons it's so hard to live with myself is because I have a lot of friends who were buying Bitcoin in 2010, so that's a head fake for you. But I was a banking guy, and I got really interested in fintech in the mid-2000s. Fintech is an example of applied automation that, it takes a really kind of crummy, slow, uninnovative, incumbency-oriented industry, and it makes it, a little bit better. I mean, fintech, I believe, has the prospect to make banking 30% better, and that's not trivial. Crypto, however, has the opportunity to fundamentally change the manner in which value is exchanged in the world, and fintech does not have that ability. Fintech will reduce your credit losses a little bit, it will increase your throughput a little bit, but you are still reliant on a heavily vertically organized industry called banking, where the whole industry is based on this bank's balance sheet and its trading counterparties and certain other things. The promise of crypto, is to solve some of those vertical integration problems by creating decentralization. This is why it's so maddening that the industry is being tarred with Celsius and Three Arrows and everything else, because those guys were just hedge funds run amok. They weren't decentralization. They had nothing to do with crypto in the sense of creating decentralized networks. And so my belief about what happens from here is, again, back to the dot-com bubble analogy, the promise is not in the tokens. The promise is not that crypto can magically earn you 18% interest. That's not the promise. That's a scam. The promise is that we can avoid the brittleness and the errors and the negligence and the graft of a centrally managed financial system. And there are people in this room building those kinds of projects. That's the promise.
I mean, can I just follow up on that really quickly?
No, I think we're done here. These guys want to go.
It's like, no, we need drinks. No, let me my question. Brian Brooks, and the question, or one of the issues, particularly with Celsius, is where you have that hedge fund, the centralized actor operating in a decentralized space, and because of its centralization, and there's some opacity because you don't know what's doing off-chain, and it's harder to figure out what its positions are, except for its identifiable positions on-chain. I mean, do you have any sense, when you look at this future of attacking those pain points that you've already articulated? I mean, you still have sort of centralized actors. So, how do you see the future evolving, given that?
Well, so I'm going to give you a handful of examples of real-world problems that are actually getting solved through decentralization. Okay, so let me just start with my favorite real-world problem, which is what I refer to as the payments tax. So everybody here, participates in the payment system. You all pay your mortgage, you Venmo your friends, you go and you swipe your credit card at the Starbucks. We all participate in the payment system. The American payment system is insanely expensive. The cost of our payment system, Chris, is equal to 2% of gross domestic product. So just think about that for a second. Think about all the things that happen in the economy: housing, healthcare, childcare, transportation, energy, and the payment system consumes 2% of GDP. That's insane. And it's especially insane when you find that in the UK and the EU, it's 25% of that. It's 50 bips versus 200 bips in the United States. And why is that? It's a problem that was created here in Washington. It's a problem based on our system of financial regulation, which says that only banks and no one else can access the Federal Reserve payment system. That is not true in Europe. In Europe, you have the concept of e-money companies. So like Coinbase has access to the Bank of England's payment rails. Coinbase cannot access the Federal Reserve payment rails. Only Wells Fargo can, right? And so when you look at the way that all of this works, there's this enormous friction. The point of stable coins is to settle payments away from the Federal Reserve so that we take that 200 bips and we reduce it to 0. That's an actual problem that all of us pay for every single day. I mean, baked into the cost of your Starbucks coffee. And I have a lot of complaints with Starbucks, which I'm happy to describe at the bar. I really do. Starting with the elimination of the pink sweetener, which does piss me off, I'm not going to lie. But they did that because the payments tax is so expensive they can't carry my favorite sweetener anymore. Part of your coffee cost, probably 10 cents of your $5 latte, is because it costs that much for interchange, and that's all because of this problem. Crypto solves this. Another problem, Chris, that you and I've talked about before is credit discrimination. We live in a country where the fact of the matter is black people pay roughly 10 basis points more than white people do on every single credit product, from mortgage to personal loans to credit cards. And why is that? Because there's inaccuracies baked into the credit scoring system. I mean, there are a lot of reasons, but one is minorities tend to have credit scores at a lower rate than white people. And I don't mean they have lower credit scores. I mean, they tend to have a score at all at lower rates than white people do. And the traditional system has no ability to capture their creditworthiness. Along comes DeFi. And it uses algorithms to capture all data that exists on chain to assess your individual creditworthiness. And suddenly you squeeze some of that out of the system. I mean, these are real problems. They're not pay me 18% interest. That's bogus. But these other problems, they really exist, and decentralization really will solve them.
So decentralization does create, I think you maybe caught the end of Charles Hoskinson's conversation about governance. You know, when you have decentralization, it creates both a practical and in some instances, sort of legal question as to what governance mechanism should be deployed. Have you given that very much thought, and particularly since you know a thing or two about governance? I mean, like how do you attack that particular pain point?
Well, I mean, so first of all, what I would tell you is governance means a lot of things, but in the blockchain world, the idea that in order to participate in the alterations and changes to the underlying source code, you have to spend tokens. That is a huge feature. You know, some people think it's a bug. It's a huge feature. It's a security feature, and it ensures that only the people who have a stake in the system, and not hackers and not third-party intermeddlers, right, are governing the system. Think about what that could mean for things far outside of crypto networks, right? So if you have networks powered by crypto tokens, but they start governing things like homeowners associations, because we will eventually have real estate tokens. Or imagine if they started governing actual elections, so that there was no longer any question at all about whether this ballot had been cast twice or whether this really was Chris Brummer voting, right? We know for sure because he spent his governance token, and once he spent it, it was burned and gone. The confidence that gives you in these communities of people who otherwise don't know and trust each other is really critical, which brings me to the last really important point, which is, you know, we're living in a country right now where trust is at the lowest it's been in history. We're 4 weeks out from midterms in a world where whoever loses is probably not going to trust the results. There will be litigation all over the country, at least in 5 Senate races around the country, all about, is this really who won or not? And what date was that ballot really submitted, and was it really this guy or not? We have the ability to eliminate that, probably not today. We still have to build some of this. But when you look at some of these networks that have governance tokens separate from the traded token, it turns out to be a very powerful way to have legitimate outcomes and to manifest consent among people who don't know and don't trust each other.
That's a mic drop. Thank you so much, sir, for coming to join us. Sorry. You can go get your drinks. We will see you tomorrow. There's a happy hour. Only if you've already enrolled, you can go. Otherwise, it's going to also be full. Tomorrow, I guarantee you, if you were lucky enough to get tickets for day 2, it's actually going to be bigger than this. It will be. So I'll just leave that there. All right, bye.
rocks like this.